because there has been a regime change in terms of the leadership at the Reserve Bank, in terms of the ecosystem as well. While we did have a slightly troubled rupee in December as well, the growth was not seen as that weak. Now there is a fear of softening growth. There is less fear of inflation because in December the last number that we had was October at 6.2. Now as we look ahead, the inflation number is expected to be tame because of a good Rabi harvest, as well because crude prices have fallen. So all told, we are expecting a lot from the policy this time around. Joining me is my colleague Ritu Singh from the Mumbai studios, and Ritu has done her poll, so best placed to tell you what's the market expecting. Ritu.
Well, at this point, Latha, the 25 basis point rate cut is priced in. 70% of our respondents said that is a given. The big question mark is what RBI does on liquidity. Again, the cash reserve ratio is not something most of the market participants believe that RBI will tinker with just yet. They've just cut it by 50 basis points in the last policy, and it's too big a tool to just use in a period of no crisis, really. Apart from that, yes, there are expectations that the RBI will give some comfort on liquidity. A lot of the respondents that we polled said whether they announce more OMOs, maybe longer repos, or perhaps, an incremental CRR cut for NRI deposits. All of those things they'll watch out for. And of course, very importantly, what RBI indicates as to the new LCR norms kicking in from the 1st of April. Are those going to be pushed away? Project finance rules, ECL, like you were talking about. Those are, that's the commentary that the market will really watch out for. The total quantum of rate cuts in this cycle, the expectation is 75 to 100 basis points, larger than previously because, of course, the helping hand that growth really needs from the RBI. Stance change is not really expected in this policy. The tone also more or less even. And as for the macro forecast, the GDP growth forecast at 6.6% is likely to be brought closer to NSO's 6.4% level. But the CPI forecast unlikely to be changed.
Okay, fair point. At 4.8, I think it has all that is needed in the price. And if anything, the December inflation was lower than what the market expected. Let me invite our guests. We are joined by Lakshmi Iyer of Kotak AMC, by Kaushik Das, the Chief Economist from Deutsche Bank, Indranil Pal, the Chief Economist from Yes Bank, and Parul Mittal Sinha, the Head of Treasury at Standard Chartered Bank. Ladies and gentlemen, it's an even house. Welcome to the show. Let me start with Parul. Before I came in, there is this chatter that there may be a stance change as well. What are you going with? And if there is a stance change to accommodative, what may that mean for the markets?
Hi, Latha. Thanks for the question. So yes, there is a lot of excitement. I think more excitement about the stance this time because market is fully along the consensus lines that 25 basis points of repo rate cut will be delivered. Now, if the stance is changed to accommodative, that would signal that RBI is actually looking at a bigger cycle than a 50 basis points of repo rate cut. So that will allow and give the confidence to market to move rates further lower from where we are today. Mind you, markets have already priced in almost 65 basis points of rate cuts cumulative in this cycle, if I look at the interest rate swap pricing. So a accommodative stance change will give market the confidence that the cycle, the interest rate cutting cycle is bigger than the 50 basis points cut. So that's one. And looking at the polls, nobody is voted for a stance change, and therefore that will give a big impetus. RBI has already delivered a lot. They have shown their hand to the market and given the liquidity through OMO purchases, through buy-sell swaps, through secondary market OMO purchases as well. So a stance change after giving all those measures will really give a positive boost to market sentiment.
Okay. Thanks for that, Parul. Let me get the economists in. Kaushik, what is your expectation that they may do to boost credit growth? I'm only asking you all outlier questions because Ritu has already given you what the poll is saying, what the big market expectations are. The worry at least in government has been that credit growth at one point in November was below nominal GDP growth. So do you think they may go to the extent of reducing the risk weights on bank loans to NBFCs, for instance? Can it go that far to boost credit growth?
Hi, Latha. We are expecting a 25 basis points rate cut and commitment towards more liquidity. And you need both of these measures, both rate cuts as well as more liquidity measures to ensure that the transmission of rate cuts feed into the credit channel and the real economy. And these things normally take 2-3 quarters lag to happen properly. So RBI has already waited for 24 months, almost 2 years, before doing anything from the last rate hike. So this is an opportune time for RBI to start cutting rates and also keep on talking about liquidity so that short-term rates stay aligned to the repo rate. I don't see risk weights changing right now. I'll be surprised if they go that dovish, because April is the big monetary policy where they'll get more time, and probably that is the opportune time to announce more changes to macroprudential norms. Not right now. At this moment, what you require is probably commitment from RBI to continue with the liquidity measures. They've announced most of these measures. I don't expect a CRR cut. I'll be surprised if they give a CRR cut. But a 5 billion, USD buy-sell swap is a possibility, beyond what they've already done. And, the OMOs continue till 20th February. So for the March OMOs or April, I don't think they announce right now, but they say that they continue with the liquidity measures, which I think both liquidity and rates coming down will be important for credit channel to pick up. And we should also think about the next 3 quarters, 4 quarters inflation, not just this year's inflation forecast. If you've seen, RBI has given an inflation forecast of 3.8 for FY26 and 6.7% growth for FY26 in the December monthly bulletin. We want to see whether those forecasts for the growth gets revised down to 6.5 or something, or the inflation, whether they remain at 3.8. So if you're having 3.8% average inflation next year, you could easily have 50 basis points rate cut and probably more. But at this stage, we want the 25 basis points rate cut, more dovish commentary. But if you change the stance to accommodative, remember, it's not just a rate signal. What will also happen is that RBI will have to align the liquidity stance along with the rate stance, which would mean that the short-term rates need to be between the SDF and the repo rate. I don't think RBI is ready to do that at this stage. So probably the stance change comes more in April rather than right now.
Okay, a very quick question on the rupee. I mean, Indranil, would the Reserve Bank want to give a signal that we will move to surplus liquidity? The argument on the other side is that that will make it easier for speculators to short the rupee. And we are still in a slightly tense situation on the exchange rate. While one likes some orderly depreciation, you don't want speculators to take advantage. So your guess on what they may say about liquidity. Will they say adequate, enough? We will provide enough liquidity. Will they say I will keep it surplus? Thoughts?
Okay. Since my fellow economists started off with the expectation of the rates, I think I stand away from the crowd today to say that I am not expecting a rate cut. And I think you have raised the right question in terms of the currency and the tail risks that are there in terms of the policy prescription from the Federal Reserve and what it does in terms of the supply chains and therefore the overall inflation atmosphere globally and including India. So that's one belief that I have, that they will actually sort of tend to stay up. Secondly, you did raise a question about credit growth, where I also tend to differ in the sense that at 80% credit deposit ratio and the average for the historic average being at 74-75, I'm not sure whether a credit push without a deposit side increase from the banking sector that makes any sense from an RBI's perspective. Therefore, coming down to the liquidity, I think the RBI has done significant amount on the liquidity. If you look at on an historical basis, in the fourth quarter, liquidity generally remains on the tighter side. The incremental tightness this time is obviously on the account of the currency sale that has happened, which actually continues even today because of the external atmosphere being volatile. And to that extent, there can be more liquidity measures, but I am not sure whether immediately within the policy they do something. Because the last OMO happens, which is the liquidity measures that they had announced in the last policy. That is on the 20th of Feb, and they'll possibly be wanting to wait and see what happens to the liquidity and do it beyond that. In terms of the system liquidity, I think they have done a good job to keep the TREPs and the weighted average call money rate at the sort of signaling rate. And they will continue to do that. And they have been very effective in doing that through the overnight VRR. Plus today we have a 56-day VRR, which also is a very positive signal in terms of the liquidity. My sense, therefore, is they will look at a more neutral liquidity position, which broadly should be in the range of -50 to a +50. And I don't think they will do very aggressive anything at this point in time, because anyways, from April onwards, we are expecting liquidity to correct itself and sort of with government expenditure and all the stuff.
Okay, Indranil Pan, what is your expectation as far as some of the macro indicators are concerned? GDP at 6.6%, what sort of revision, if at all, do you expect there? And CPI at 4.8, unlikely to be changed?
I think the inflation obviously for this year is unlikely to be changed. We should be looking at the inflation expectations from the RBI for the next, for the quarter hence that they put out. Yes, Kaushik did point out about the bulletin and the sub 4% that they have projected. Whether they continue with that and bring that up in the public space more openly is something that we really need to look at. Growth may be a shade lower. They have a 6.6, the government has a 6.4. So I think there is a bit of a chance to reduce it. But more importantly, what is the growth projection for the next year, given that the economic survey has pointed out to a 6.3 to a 6.8?
Lakshmi, what kind of indicators will you be looking at from the governor to indicate what happens beyond February, since this 25 basis point rate cut is already priced in? What sort of indicators or what words will you look out for in his speech?
Ritu, I'm more worried about the fact that if at all, contrary to the popular belief that there is going to be a rate cut, if the rate cut doesn't happen, that will have broader implications for the market. So should it be a status quo with a benign outlook saying that we are ready to act? I think we are more of that camp right now, rather than giving a rate cut and probably, sounding slightly more hawkish, because we are not in a deep rate cut cycle. We are in a more shallow rate cut cycle. So I think those are going to be the specific cues that we would be watching out for in this policy. That's going to be very critical. And mind you, see, markets do tend to be exaggerated at certain points in time, as Parul rightly alluded to. The swaps are, the entire yield curve is crunched at under 7% or just about there. There's nothing wrong about it, but we need to be mindful that we are slightly more vulnerable right now to external shocks, given the fact that commodity prices are rising relentlessly. And we are price takers for most of these commodities. So I think durable liquidity could be one area of watch out. We've already seen a slew of liquidity generation measures, which is good for the markets. And I think that is where one could see probably some more nuanced action likely.
Okay. Parul, I wanted your view on Forex. Actually, you are the Forex trader in this group. Do you think if he will sound very generous on liquidity? If he does, do you think there can be more shorting? It becomes cheaper to short from a Forex angle, and someone who is worried that the rupee should depreciate but not in a disorderly fashion. What may be the constraints?
Yes, I think the FX world and the way dollar rupee has behaved over the last few months, that can weigh on the sentiment of MPC. So while the rates market has been very exuberant and expecting and wanting more, I think from RBI we will see a more balanced approach. Not give extra liquidity boost to the market, not change the stance, be more neutral and retain the ability to react to market movements. The external factors that are impacting the overall dollar moves, the dollar strength, which is going on in the broader global markets, that has implications for us through dollar rupee channel as well. So dollar rupee has depreciated by almost 3.5% since the last MPC. And that has knock-on effect for both inflation and growth prospect, positive for growth, but is slightly inflationary for the economy as well. So RBI will We don't expect RBI to be extremely positive or give an extra boost on liquidity. We don't expect the stance change to go to accommodative. We think RBI would want to continue and retain the space to react to developing market conditions. To just give some context, right? So US rates had gone to where they are today. They were almost 30 basis points higher in January month itself, 2 weeks ago. Oil has come down dramatically from the highs seen. So the level of volatility we are seeing in global markets, we have to be careful and we have to pay attention to that. And given the governor is also new, I don't see a reason why they would want to bind themselves to a defined path by changing stance and committing to a much larger.
The Monetary Policy Committee met on 5th, 6th yesterday, 7th today of this month. You are all aware that the governor's statement after the MPC meeting contains the resolution of the MPC with regard to the policy rate and stance. It also contains announcements and measures which have a bearing on the monetary and regulatory policies. The Monetary Policy Committee resolution is, of course, of interest to a large number of people from various walks of life. It impacts the lives of virtually all citizens of the country. The resolution also provides the rationale and the thought process of the MPC, and therefore is of relevance to businesses, economists, academicians, and the finance world. Apart from these MPC-related announcements, the governor's statement has become an important medium for the Reserve Bank to highlight its priorities on which it would like its regulated entities to focus their energies on. It is an opportunity to point out areas of concern and challenges for the stakeholders to address their attention to. It is an occasion for the Reserve Bank to articulate its views on critical areas of interest. I will continue with this practice of a detailed statement after each MPC committee meeting. Now, before I come to the resolution of the MPC, kindly allow me a moment to reflect on the experience of the flexible inflation targeting framework. You are all aware that this inflation framework was put in place in the year 2016 and it was reviewed in the year 2021. You are all also aware that this is a monumental change in the monetary policy history of our country. And so I thought it fit that I reflect on the experience of the flexible inflation targeting framework. Well, I believe that it has served the Indian economy very well over these years, including the very challenging period since the pandemic. The average inflation has been lower post the introduction of this framework. Moreover, CPI has mostly stayed aligned with the target given under this framework, barring a few occasions of breaching the upper tolerance band since its inception. We in the Reserve Bank and the Monetary Policy Committee will continue to improve the macroeconomic outcomes in the best interest of the economy, using the flexibility which is embedded in the framework, while responding to the evolving growth inflation dynamics. Moreover, we will strive to further refine the building blocks of this framework by making advances in the use of new data, improving nowcasting and forecasting of key macroeconomic variables. We forecast, you are aware, growth, inflation, etc., because this is actually a forward-looking policy. And so we'll continue to do that and develop more robust models. On the regulatory front, I would like to mention, and especially there has been a lot of media attention with regard to some of the proposed regulatory changes pertaining to liquidity coverage ratio, expected credit loss framework for provisioning by banks, the prudential norms governing projects under implementation. We will continue to strengthen, rationalize, and refine the prudential and conduct-related framework. I think this is very important in the overall interest of our economy. The interest of the economy demands financial stability and consumer protection. Our mandate in the RBI is to enhance both of them. At the same time, I would like to emphasize that the economic interest also warrants increasing efficiency in the economy, and this too is our duty. We recognize that just like there are no free lunches, regulation to enhance stability and consumer protection too is not devoid of costs. There are trade-offs between stability and efficiency. We will keep this trade-off in mind while formulating each and every regulation. It will be our attempt to strike the right balance, keeping in view the benefits and costs of regulation. I also want to reassure all stakeholders that we will continue with the consultative process which the RBI has been doing over the years in this regulation-making process. The suggestions of the stakeholders are very valuable, and we will continue to give serious consideration to them before taking any major decision. We will also ensure that the implementation of such regulations is smooth. We will give sufficient time for transition, and where regulations have major implications, the implementation will be done in a phased manner. Coming to the global economy, the global economic backdrop remains challenging. The global economy is growing below the historical average, even though high-frequency indicators suggest resilience, along with continued expansion in trade. Progress on global disinflation is stalling, hindered by services price inflation. With receding expectations on the size and pace of rate cuts in the US dollar has strengthened, bond yields have hardened, emerging market economies have witnessed large capital outflows, leading to sharp depreciation of their currencies and tightening of financial conditions. Divergent trajectories of monetary policy across advanced economies, lingering geopolitical tensions, and elevated trade and policy uncertainties have exacerbated financial market volatility. Such an uncertain global environment has posed difficult policy trade-offs for emerging market economies. The Indian economy, though continuing to remain strong and resilient, also did not remain immune to these global headwinds, with the Indian rupee coming under depreciation pressure, as you would have noticed in the recent months. At the Reserve Bank, I would like to assure all of you we have been employing all tools at our disposal to face the multi-pronged challenges. With this backdrop, let me now come to the Monetary Policy Committee resolution. As I mentioned, we met these last 3 days, concluding today. And after a detailed assessment of the evolving macroeconomic and financial developments and the economic outlook, as I mentioned, we are forward-looking, the MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. I repeat, the MPC unanimously decided to reduce the policy rate by 25 basis points from 6.5% to 6.25%. Consequently, the standing deposit facility, SDF, the SDF rate shall be at 6.0%, and the marginal standing facility rate, also called the MCF rate, and the bank rate shall be 6.5%. The MPC also decided unanimously again to continue with the neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. I shall now state the rationale for the decision in brief. The MPC noted that inflation has declined, supported by favorable outlook on food and continuing transmission of past monetary policy action. It is expected to further moderate in 2025-26, gradually aligning with the target. The MPC also noted that though growth is expected to recover from the low of Q2 of 2024-25 this year, it is much below that of last year. Last year, you are all aware, it was 8.2%. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. And accordingly, the MPC decided to reduce the policy rate, by 25 basis points to 6.25%. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. With this now, I come to the assessment of growth and inflation. First of all, growth. As per the first advanced estimates, real GDP growth for the current year is estimated at 6.4%. The numbers were released by MOSPI recently. This is a softer expansion after a robust 8.2% growth last year. Going forward, economic activity is expected to improve in the coming year. Agricultural activity remains upbeat on the back of healthy reservoir levels and bright Rabi prospects. Manufacturing activity is expected to recover gradually in the second half of this year and beyond. Early corporate results for Q3, and we have more than 50% of the results now as we speak. It indicates a mild recovery in the manufacturing sector. Mining and electricity are rebounding from monsoon-related disruptions in Q2. Business expectations remain upbeat, as evident from the PMI Manufacturing Future Output Index. Services sector activity continues to be resilient. PMI services, however, declined from its recent peak. On the demand side, rural demand continues to be on an uptrend, while urban consumption remains subdued, with high-frequency indicators providing mixed signals. And we are aware, we got the Nielsen survey report also just yesterday. Going forward, improving employment conditions, tax relief in the union budget, moderating inflation, together with healthy agricultural activity, bode well for household consumption. Government consumption expenditure is expected to remain modest. Higher capacity utilization levels, robust business expectations, and government policy support augur well for growth in fixed investment. Continued buoyancy in services export will support growth. Global headwinds, however, continue to impact uncertainty to the outlook and pose downward risks. Taking all these factors into consideration, the RBI has estimated that real GDP growth for the next year to be at about 6.7%, with Q1 at 6.7%, Q2 at 7%, Q3 at 6.5%, and Q4 too at 6.5%. The risks are evenly balanced. Coming now to inflation, headline inflation after moving above the upper tolerance band in October has since registered a sequential moderation in November and December, standing at 5.2% now. Going ahead, food inflation pressures, absent any supply side shocks, should see a significant softening due to good Kharif production, winter easing as we witness every year in the vegetable prices, and a favorable Rabi crop prospect. Core inflation is expected to rise but remain moderate. Rising uncertainty in global financial markets, coupled with continuing volatility in energy prices and adverse weather events, presents upside risks to the inflation trajectory. Taking all these factors into consideration, CPI inflation for the current financial year is projected at 4.8%, with Q4, the current quarter, at 4.4%. Assuming a normal monsoon, CPI inflation for the financial year 2025-26 next year is projected at 4.2%, with Q1 at 4.5%, Q2 at 4%, Q3 at 3.8%, and Q4 at 4.2%. The risks are evenly balanced. I will now come to the external sector. India's current account deficit moderated from 1.3% of GDP in Q2 of last year to 1.2% in Q2 of this year, 24-25. According to the World Bank, India, with an estimated inflow of $129.1 billion, continues to remain the largest recipient of remittances globally last calendar year 2024. The current account deficit for this year is expected to remain well within the sustainable level. As on 31st January this year, I may inform you, India's foreign exchange reserves stood at $630+ billion. This provides us an import cover of more than 10 months. Overall, India's external sector remains resilient as key indicators stay robust. I would like to mention over here, and especially because there has been commentary in the media about the Reserve Bank's exchange policy. Well, the Reserve Bank's exchange rate policy over the years has remained very, very consistent. Our stated objective is to maintain orderliness and stability without compromising market efficiency. The Reserve Bank believes in the market efficiency of the markets that we have in India for Forex. Accordingly, our interventions in the Forex market focus on smoothing excessive and disruptive volatility. It does not target any specific exchange rate level or band. The exchange rate of the Indian rupee is determined by market forces, and we will continue with this policy. Coming now to liquidity and financial market conditions, I may state that after remaining in surplus from July to November 2024, system liquidity as measured by the average net position under the liquidity adjustment facility did turn into a deficit during December 2024 and January 2025. This drainage of liquidity is mainly attributed to advanced tax payments in December 2024. You are aware there are quarterly advanced tax payments to be made, December being that particular month. For the advanced tax payments for Q3, that did have an impact. Capital outflows, again, one has witnessed some capital outflows because of various reasons. Forex operations, and a significant pickup in currency in circulation as we witness every year in January. It has been, however, I would like to mention over here that we have observed that some banks are reluctant to on-lend in the uncollateralized call money market. They are passively parking funds with the Reserve Bank. I take this opportunity to all the banks to urge them to actively trade amongst themselves in this uncollateralized call money market, so as to make it deeper and vibrant for better signal extraction from the weighted average call money rate. The Reserve Bank is committed. I want to assure everyone that the Reserve Bank is committed to provide sufficient system liquidity. We have taken a number of steps in this regard, and we will continue to monitor the evolving liquidity and financial market conditions and proactively take appropriate measures. I repeat, proactively take appropriate measures to ensure orderly liquidity conditions as may be required for the system. And when I say liquidity, it means not only transit, overnight liquidity, but also durable liquidity to meet the requirements of the system. I now come to financial stability. The system-level financial parameters for the scheduled commercial banks continue to be healthy. The credit-deposit ratio for the banking system at the end of January 2025 was at 80.8%, broadly similar to that on 30th September 2024. Bank liquidity buffers are sufficient, though the net interest margin moderated, return on assets and return on equity are robust. The system-level parameters for NBFCs too are very healthy. I also take this opportunity today to mention that the Reserve Bank has been observing Financial Literacy Week annually since 2016. This is with the purpose to enhance financial education in our country. Last year too, we did this campaign. This campaign was focused last year on empowering youth adults. This year, recognizing the critical and multifaceted role of women in society, this campaign will emphasize on women's role in financial decision-making and household budgeting. I sincerely urge all banks to actively participate in this campaign on the theme Financial Literacy, Women's Prosperity. It starts from 24th of this month. Now, before I conclude, I shall be announcing some additional measures. Necessary directions and circulars for these shall be issued separately. First of all, on digital security, the rapid digitalization of financial services has brought convenience to all of us, at the same time efficiency, but it has also increased exposure to cyber threats and digital risks, which are again getting sophisticated day by day. The surge in digital frauds is a matter of concern. It warrants action by all stakeholders. The Reserve Bank has been taking various measures to enhance digital security in the banking and payments system. Introduction of additional factor of authentication for digital payments is one such measure. It is now proposed to extend this to online international digital payments made to offshore merchants who are enabled for such authentication. Second, the Reserve Bank shall implement the bank.in exclusive internet domain for Indian banks. Registration for this domain name will commence from April this year. This will help avoid banking frauds. This will be followed by the fin.in domain for the whole of the financial sector. The banks and NBFCs, I would urge them to also continuously improve preventive and detective controls to mitigate cyber risks. They must develop robust incident response and recovery mechanisms, reinforced through periodic testing for operational resilience. Third measure that I am announcing today, over the past few years, we have expanded the suite of interest rate derivative products available to market participants to manage their interest rate risks. We shall now, to this suite, include forward contracts in government securities. This would facilitate long-term investors, such as insurance funds, to manage their interest rate risk across interest rate cycles. It will also enable efficient pricing of derivatives that use government securities as underlying instruments. Fourth, to enhance access of retail investors to government securities, the Reserve Bank has taken a number of steps earlier. There's another step, that I am announcing today, and this pertains to expanding the access of NDS Home, our platform for trading in the secondary market transactions for government securities, to non-bank brokers who are registered with SEBI. A number of them are registered with SEBI. They will also get an opportunity now to participate and trade through the NDS Home, the electronic trading platform of RBI for government securities. Fifth, in view of the various developments in financial markets and market infrastructure over the past few years, we shall be setting up a working group with representation from various stakeholders to undertake a comprehensive review of trading and settlement timing of markets regulated by the Reserve Bank. There are some 5 such markets which have different timings. The group shall submit its report by 30th April this year. To conclude, considering the existing growth inflation dynamics, the MPC, as I mentioned earlier, while continuing with the neutral stance, felt that a less restrictive monetary policy is more appropriate at this current juncture. The MPC will take a decision in each of its future meetings based on a fresh assessment of the macroeconomic outlook. We are committed to conduct monetary policy and take such measures as appropriate, which are timely, carefully calibrated, and clearly communicated to facilitate conducive macroeconomic conditions that reinforce price stability, sustained economic growth, and financial stability. Thank you, Namaskar, and Jai Hind.
Okay, as expected, there has been a rate cut and not a CRR cut. But that is just one of the things that the governor announced. I think we have to concentrate on what he said first, a flexible interpretation of the flexible inflation targeting. I think that's an extremely important statement he's making, and that also means what is missing is aligning the CPI to the target of 4% is a phrase that was repeatedly there last year and in previous policies. That is absent, and what they're saying is a more flexible interpretation, which means perhaps that they will not be that strict about 4%. That's a very important revelation of his thinking. The second one, that they're going to look at the, blocks, the fundamental blocks of forecasting. So I think the forecasting models are going to be looked at again. I think the second biggest takeaway for the markets, especially the stock markets, is that the regulatory framework comes with a cost. That when you want stability and inclusion, it will also mean a lesser efficiency. Basically, you take away money for LCR, you take away money and lock it in government securities for SLR. For these purposes, the priority sector, that also takes away from efficiency. So my sense is it's a veiled way of indicating that LCR is not going to be effective on April 1st. We will, of course, ask him that in the monetary policy. On CRR and liquidity, he has only said he will give as much liquidity as needed. There is no indication of surplus. Very clearly, we will take proactive steps but he's not saying surplus liquidity, which means liquidity as and when needed is the message that's coming. So my sense is it's very clearly on regulation. They will go soft. Flexibility of the flexible inflation targeting will be more adhered to, and there is going to be a redefinition in terms of the macros. They're going to make it smoother or perhaps more accurate. Then I think a very big takeaway is that many banks are unwilling to lend in the call market. They lend in the repo market, not in the call market. There is a fear in the market, in the banks, that if you borrow from repo and lend in the call, then the auditors will ask questions. I think he's, telling the bankers, please come and lend in the call market. Auditors will not ask questions. I think that's again a very, very big signal that banks were waiting for, and I'm glad it has been given. But basically for the markets, a 0.25% rate cut and a more flexible interpretation. I would interpret that as almost accommodative, but the stance is still neutral. Let me get to the experts before I come to Ritu, who will have more things to contribute. Upasana, what would you surmise from what you have heard? Do you expect a rate cut in April, for instance?
Yes, of course, Latha. I think it's a very much in line with expectations policy across the board, if you look at. Just want to highlight one thing that, as you mentioned, the flexible inflation targeting. I think earlier we were in doubts whether we will have to wait for 4% to be achieved before an action is taken. I think today's emphasis on flexibility of inflation targeting kind of provides cues on the fact that if inflation is broadly looking ahead in line with 4% target, then growth can be considered as a primary objective. And in this environment, when the growth inflation dynamics was looking fairly benign, I think this was the perfect time for RBI to have acted. And I think more than that, on the second leg is the liquidity angle, wherein the liquidity stance has to be more or less in sync with RBI's policy stance. They have already acted ahead, and that kind of had sets the stage for a repo rate cut. So, the liquidity easing measures which have been announced, and we believe that there will be more coming, but they will have to be on a wait and watch mode. Clearly, they will have to be watching that closely. But liquidity will be playing a much more important role going ahead now that RBI has delivered that 25 basis of rate cut, which was broadly in line with what I think everyone in the market was expecting.
No, but since he says more flexible, are you expecting April cut?
Yes, Latha, we are cumulatively looking at 50 basis of rate cut. So with one gone, I think we have now one more rate cut to go, and it is better to go ahead with back-to-back rate cuts, because the room, I think, for incremental rate cuts more and more will be limited.
Okay. All right. Just coming back to all of you, let me get Kaushik's first thoughts and then go to Ritu. Kaushik, what were your key takeaways, and more importantly, what next?
Hi, Latha. This is, I think, excellent policy decision to cut 25 basis points and don't go overboard on liquidity. RBI has already announced liquidity measures. Governor mentioned the word proactively and stressed on it. So as and when it is required in March, after the OMO purchases are over, if they feel like they need to give more, they'll definitely give more OMO purchases, or FX swap, another 5 billion. All those will be coming. As I told you in the expectations part, that I don't expect CRR to be cut, so they haven't touched. At a later point, if it is required, that may be seen, but I don't think CRR will be required, given that in May RBI will give a very big dividend, 2.3, 2.4 trillion to the government of India. That will also add to liquidity as the government spends. The other thing that caught my attention, and I liked the fact, is that the governor stressed on the part of being monetary policy being forward-looking. So you do not need to wait for 4% inflation to start cutting. You have to start in advance seeing the runway. And if the runway is showing you that inflation will average about 4.2 in the next fiscal year, even at say 6% repo rate, your real policy rate is still 1.75 positive. So I think RBI has done the right thing. April, there's another rate cut for sure. And after that, I think the stance will change to accommodative, simply because after 50 basis points rate cut, RBI may not want to reduce the repo rate too much, because the Fed has only cut 100 basis points. But if you still want to give some bit of easing, that time you can bring in more liquidity and drive an effective easing by driving short-term rates closer to the SDF rate. So the short-term rates can fall to 575 with the repo rate staying at 6%. And that is how you achieve that, by changing the stance to accommodative, because once you change the stance to accommodative, the liquidity stance also has to be aligned with the rate stance. And in that scenario, you can only pause or cut rates, and then short-term rates need to come to the lower end of the corridor.
Yeah.
That's my view.
Yeah. Yeah. Very important to note that the rupee has actually not moved much. Before the policy started, I noted the rupee, it was 87.46, now 87.48. So despite the fact that the rate cut has come, it's largely priced in and there isn't any further reaction. Let me invite the biggest banker in the country, SBI's Ashwini Tiwari is also joining in. Mr. Tiwari, good morning. Thank you very much for your time. Can you tell us the key takeaways from a banking point of view? They've asked you all to lend more in the call and not keep away. No questions will be asked by your auditors or by the supervision department. Also, more derivatives for insurance companies, to hedge longer term G-Secs. More retail participation, can come into the NDSO markets. Those are also been announced. But from a banking point of view, what's your takeaway?
Good morning, Latha. Thank you for having me. I think the rate cut is broadly in line with our expectations and our house view. So no surprises there. The balance point, which he talked about, balance between policy and growth, I think that's very welcome. In terms of banking, I think you already listed out the things which has been there. But the only thing I would like to correct is, it's not that we are not participating in the call money market. We are very much there. And this gives a far more flexibility, the derivatives which have been announced. And more importantly, the cyber things he talked about in the bank domain, we are engaged with them and we'll work with them. I think RBI is very geared up to protect customers from digital frauds. And therefore, overall, in terms of having a whole of system approach with RBI and the government, this is also a step in the right direction. So overall, I would say that the takeaways are that the banks should continue to be cautious, yet be focused on lending and doing the job which they are supposed to do. So that way, the RBI has made our job more simpler and given us the enablements.
But very quickly, Mr. Ashwini Tiwari, a 25 basis point rate cut you had factored in. What does that mean for banks like yourself? Your external benchmark linked book is less than a third of your total assets. But broadly, what do you expect now going forward, the impact on your business thanks to these cuts and the indication that RBI is going to be forward-looking, target the band and not the 4% central level, leaving more room for rate cuts going forward? What will that mean for banks like you?
So generally, when the rate cut initially happens, the deposits get repriced with a lag because the people are, especially in TDRs, are locked in. And the loans, especially this 1/3 you talk about, the external benchmark linked rate, that will be changed immediately. So in the beginning, there'll be some margin pressures, but going forward, as we realign our deposit rates also in line with the rate cut, this will settle down. And we have always given a NIM guidance of between 3.1 to 3.3. This quarter, we were a little lower, but we expect to get back there soon. So therefore, for us also, we'll have to realign a little, both in the deposit and the lending rates as we go forward. And it will settle in after some time.
So, Mr. Tiwari, the market analyst interpretation was that your NIMs will be impacted by 5 basis, which is the least amongst all the other banks. HDFC, ICICI all have like 6 or 7 basis. Yours is 5 basis. Is that a correct calculation?
No, I really
have not because of the rate
calculation. No, I have not looked at that calculation which the analysts have done. So therefore, I can't comment on that. But my basic point is that we'll realign as we go forward by adjusting our deposit rates and also the lending rates. So to look at the rate transmission and also to look at where our margins need.
Mr. Lakshmanan, what did you make of the governor's very, very calibrated comments coming in on the liquidity front? Not promising ample liquidity, but just making it very clear that they will proactively manage it as and when required. Are the markets going to be disappointed, or was this factored in? What were your additional takeaways from his speech? Mr. Lakshmanan, I think you're on mute.
My apologies. No,
yes,
so this was definitely as per the predominant market expectations. If you look at the markets and the response thereafter, markets have not moved much. you would note the currency level, but importantly, the OIS levels, the G6, of course, the yields have moved up a bit. But overall, this being a predominant expectation, I don't think market is disappointed by any means. And in many manners, the way RBI had alluded to supporting liquidity even much before this policy, as well as the governor's speech over here, has given enough confidence that liquidity is clearly a focus, and they will not let the markets down should there be a liquidity requirement at all. So overall, I don't think there is anything beyond balance that has been spoken of by the governor's MPC, and I think market would gradually move into an April expectation, potentially for a rate cut. Of course, keeping the inflation dynamic expectations, and of course also looking into how the global macro is developing. With a rate cut expectation coming by, maybe the rates may smoothen down a bit. But overall, I think there is not much to be either overly euphoric or disappointed about.
Okay. Well, the call rate has already fallen, obviously. It's now at 6.35, midpoint between 625 and 650. And I would assume it will eventually go to 6/4. As Mr. Tiwari says, we have no objection to lending in the call. But, call volumes are in 5 figures. They are in thousands, 10,000s of crores. Whereas the TREPS volume is going to 1 lakh crore. So clearly you are preferring the collateralized lending market and not the uncollateralized lending market, and the governor is requesting you all to lend more over there. Call has come down naturally because the repo, the MSF rate, everything would be down by 25 basis. Shobit Mehrotra is also with us. Shobit, lots of announcements for your market actually. You all can now participate in the NDS home, and there are also these derivatives available. How does life change for you all? What is also your call on the 10-year bond yield?
Yeah, thank you, Latha. I think initial reaction of the market on liquidity measures has not been too positive. I think market was expecting a change of stance to accommodative. If RBI is confident of providing liquidity, then might as well go ahead and change the stance from neutral to accommodative. So that has been a little bit of a disappointment. I think market was also expecting some more forceful measures on liquidity. So rate cut without liquidity being in surplus on a durable basis may not lead to good transmission. So if we want, transmission of rate cut to happen in the economy and growth to improve, I think it has to be accompanied with far more liquidity to be provided to the system. I think from that point of view, I think market is a little bit disappointed from the policy. I'm not too confident also on the next cut happening in the April policy. There was a lot of reference to global headwinds, uncertainty, global financial markets, volatility. So if that were to increase, I think RBI may choose to wait and watch and then go in for further deciding on the rate trajectory. So I think confidence of the market may be a little bit shaken post this policy. I think change of stance could have been done. More forceful liquidity measures could have been provided. The transmission of rate cut would have been far better. But unfortunately, that hasn't happened. So let's see what kind of measures come out after this 3 or 4 measures which RBI has announced on liquidity, whether we continue to see more of those or, we have to wait and system has to go again into negative and deficit and then something comes up. So I think a little bit of a proactive approach would have helped the system far better.
Well, absolutely take your point. The stance remains at neutral, not accommodative, and no overt promises of ample liquidity at all. But Mr. Ashwini Tiwari, quick question to you about the initial comments made by the governor. Very, very clearly stated that they will give sufficient time for transition when it comes to big changes, in policies and guidelines, and where the implications are large, the transitions are going to be done in a phased manner. Now, what is your reading of these statements in the context of the LCR rules kicking in from the 1st of April? Of course, then there's also the ECL transition and the project financing norms. You think the governor's indicating that, that timeline may be extended?
We really can't interpret on what RBI wants to say because all these 3 have been around, these draft notifications have been around for some time. And we have already given our inputs to RBI on what we think about each of these and what the improvements could be. So therefore, we will wait for RBI to actually announce a date as to when they will implement. And if and when decided to implement, then clearly the window of implementation will be adequate, because some of these like ECL and all will need substantive IT changes and system changes, which will require a long time. So therefore, and of course, the additional provisioning which will be required. So I think the time factor which the governor is saying, we will see how that happens, because we will wait to hear from them finally as to when they want to implement this.
Okay. No, Mr. Tiwari, but I think Ritu is asking a very relevant question. For the first time we are hearing the Reserve Bank say that regulatory intent for higher financial customer service or for financial stability like CRR, SLR, LCR, while they have serve a purpose, they come at a cost. We've never heard the Reserve Bank say that, and certainly not on the policy day. So is it a reasonable bet to assume that it won't be April 1st, LCR rules?
No. As banks, we don't bet on any.
We will ask him. We will ask him on your behalf.
Please ask him. So we will wait for.
No, we will ask him on your behalf.
No, thank you for that. But we will wait for the formal announcement. Because we will be ready. I mean, we'll make ourselves ready if and when this is announced. So right now, I don't want to conjecture on it.
Okay. I want to follow up on what the Federal Bank Treasurer, Mr. Lakshman, is saying, that they could have been more generous with liquidity. They could have indicated an accommodative stance. I think that will be kudos to the Reserve Bank, that they have maintained the continuity from December. It is not looking like it is another, Reserve Bank altogether. It is the same economy and it is the same caution. So, Kaushik, your thoughts? Do you think that the market would be disappointed in terms of the governor not being very generous in his liquidity statements?
Latha, I think the governor gave a lot of assurance that he'll be proactive. So RBI is watching this liquidity situation very closely. I don't think, you need to get everything on one day. Obviously, markets will want as much as they could get. But there's a sequencing that you need to keep in mind. So October, we changed the stance to neutral. December, we had a CRR cut. And then we had more liquidity measures before the rate cut. So you had the rate cut. Don't expect everything on the same day. So on April, you'll get another rate cut. And along with that time is the time when you should change the stance to accommodative. Because at that time, once you had a rate cut, you will not have a rate hike, right? Neutral means you can hike, you can cut, you can pause. But now that you've had a rate cut, April would be a good time when you say, I can either pause or I can cut rates. And that is the time to announce a rate cut and give the accommodative stance. After that, people will take a bet whether RBI will cut more than 50. I'm in the camp thinking that RBI will not cut more than 50 unless the Fed does more than 100 basis points. And it doesn't look like the Fed will do anything immediately. So you could get an effective easing after April. And that you can achieve through more liquidity coming in and driving the short-term rates to the SDF rate. Then your accommodative stance on rates and liquidity will be at sync. And that is why I think, RBI, once the OMO purchases are done for February 20th, which is the last one, for March, if RBI sees more tightening, suppose RBI sees, as Shobit was saying, they will go ahead and, announce more OMO purchases or FX swap in March. Why announce today for March when you have 90,000 crore of liquidity is still yet to come? VRR is there today afternoon and then 40,000 crore more of liquidity. So you'll have to just wait it out. And it's not like RBI has to announce everything in the next April policy. They can come in between as well as far as liquidity is concerned.
Okay. Let me just pose one more question on similar lines to Upasana. Upasana, are you getting a sense that they will be niggardly or they will be very, very careful with liquidity? Or you're getting a sense that they will provide adequately? For the banks at the moment, the policy is negative. That is, the repo rate has been cut. And so at least between 5 and 7 basis points, there is an impact on margins. And they cannot, pass on they will not pass on the rate cuts to the non-EBLR loans at all. Do they have enough comfort on liquidity from a banker's point of view?
I think to begin with, he did mention that proactively he will provide durable liquidity as and when required. So, and already as Kaushik mentioned, there are a lot of measures which are yet, this week, next week, we have the OMO purchases, we have the, VRR 56 day, all of that is still pending. So, RBI does not have to wait for a policy to announce liquidity easing measures. And at this point, February, in terms of durable liquidity, because of the measures which have already been announced, is looking kind of comfortable. So I think it's only in March where we start seeing again, even frictional liquidity tightness because of advanced taxes, cumulative year-end tax collections and all of that. So the scope for liquidity easing measures coming in March is much more. At the same time, the disappointment which probably markets are getting because of no change in stance, this is not warranted at this point because liquidity is tight. And in this environment, they could not have changed the stance to accommodative when for that, they will have to do much more aggressive liquidity easing. When the global environment is so uncertain, I don't think it is the right time or opportune time to go all aggressive across all the board, across all the spectrum. So they need to necessarily look at every aspect and go slow. Liquidity, I don't see any reason why markets should be worried about. RBI is providing and they will continue to provide. They will need to provide as well. And I don't see any reason why the statements anywhere were cautious. They were all comforting to the market that we are there and we will be proactively looking at durable liquidity.
Okay, comforting, not comfortable, as Lakshman wants. He just wants an assurance or even actual announcements of liquidity, probably expecting FX swap announcements or, OMO auction announcements. But for all you know, Mr. Lakshman, they may come even by end of day or, very soon. Just a last word from Malhotra that I wanted. Malhotra, Shobit, you don't think that the NDS home market entry that you all are getting is big deal?
So it's already there with us. As mutual funds, we have access to NDS home. I think what he mentioned was certain brokers registered with SEBI will get access to NDS home. Yes, it will improve liquidity in the market. Anyways, government bond market liquidity is very good. The NDS home platform is a great platform for trading by banks, insurance companies, mutual funds. So we are already there on it. Insurance companies, banks, everybody is already on it. Now there'll be some additional brokers coming onto it, which perhaps may lead to some bit of improvement in liquidity, maybe in some, off-the-run securities and, that kind of a demand could get channeled through these brokers on NDSO.
That's right. I mean, RBI said that they will allow access to SEBI-registered non-bank brokers to NDSO, like you were clarifying. But Kaushik, if you look at the fine print again, it was a very quick, 30-minute speech from the governor, very short compared to what we're used to seeing. Any additional takeaways, anything we've missed talking about that you also want to hear in the press conference detailed?
Yeah, so you can ask if you get the opportunity with what kind of real interest rate the RBI is looking at, forward-looking policy. If you remember, under the previous regime, they had specified 1.4 to 1.9% positive real rates for, kind of deciding how much rate cuts can happen with respect to forward-looking inflation. Whether any thought, has changed at RBI with the growth numbers that we've got, are they willing to look at lower real interest rate, which could then, make up room for further rate cuts? I'm sure RBI will not give you that answer, but you could, kind of ask that question. The other thing is that I think the forecasts have become very realistic now. The growth forecast is at 6.7, which is on the higher side of the economic survey band of 6.3 to 6.8. At Deutsche Bank, we have a forecast of 6.5% growth for next year, but this is more or less in line. On 28th February, that the CSO will give the October-December GDP number. So those things can change. But generally, the growth number is pretty realistic. And inflation at 4.2%. Also, I think it's very realistic. We have a 4.3% forecast. But the positive real rate, whether anything has changed at RBI, that could be a good question to ask.
Sure. Just very quick forward-looking summaries from all of you. Upasana, starting with you. At 4.2% sort of CPI, outlook for the rest of the year, 6.7% GDP. What is the total quantum of rate cuts you're expecting in this cycle after the 25 basis points?
Maximum 50, but we are at, we can say 25 to 50.
25 to 50. Okay, Shobhit, what is your expectation?
I think my expectation is for a shallow easing cycle. I think growth number of 6.7 is still a little bit on the higher side. If growth disappoints by a big margin, only then we would probably get more than 50 basis points. But my sense is I don't think April will get back-to-back rate cut. Perhaps in the later part of the year, we'll get the second cut.
Sure. And very quickly, Mr. Lakshmanan, what is your sense, total quantum of cuts?
Yeah, well, largely the growth number dependent. 2 rate cuts for sure, maybe a third one, should the growth numbers be disappointing.
All right. So not a very steep rate cutting cycle is the expectation from here on out after the 25 basis point rate cut. On that note, Kaushik Das, Upasana Bharadwaj, Shobhit Malhotra, Mr. Tiwari, of course, Mr. Lakshmanan, thank you very much for joining us here and helping us parse through this very important policy. We've kick-started the rate cut cycle with an expected 25 basis point rate cut. On that note, from Latha and me, it's a goodbye and thank you very much for watching. Latha, to you for your final comments.
Well, I think the Reserve Bank Governor has played for continuity excellently well. Continuity and change beautifully blended. Continuity in terms of, that phrase which I was looking for is there, to align inflation to target. It's there, so very much keeping with that continuity that we are focused on the target, but giving himself that room by saying that we will concentrate on the flexible part of the flexible inflation targeting, also adding that regulation should also not take away too much from efficiency. I think it's a brilliant blend of continuity and change. For the markets itself, at the moment, the disappointment is there's only a rate cut. There is not that much of an assurance on liquidity or on the next rate cut by changing the stance. But I think that may be clarified in the upcoming press conference. That's what we will wait for, whether there is more generosity in the way he tackles the liquidity questions and whether there is more accommodation in the way he tackles the interest rate questions. Excellent policy, I would say, and excellent use of language. With that, it's a break now, over to the stock market coverage and how the markets have interpreted it, and at 12 o'clock, back to the Reserve Bank.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV 18, now streaming live 24/7 on YouTube.
Tensions between employees and management at Samsung's Sriperumbudur plant just outside Chennai have surfaced yet again. For well over 24 hours now, over 100 employees, we're told, have been staging a sit-in protest at Samsung's plant just a few meters from where I'm standing. In fact, this line of company buses and these barricades have been erected by Samsung so as to prevent members of the public and observers, much like myself, to see what's been going on through the gates of Samsung's plant just a few meters from where I'm standing. Now, the issue is simply this. A few days ago, 3 members or employees rather of Samsung's plant were suspended after allegedly engaging in activities deemed detrimental to the interest of Samsung's operations in India. However, employees of the plant, a section of them, and members of the Samsung India Workers Union claim that this suspension was not on account of disciplinary action or disciplinary reasons, but simply because they were affiliated with the Samsung India Workers Union in the first place, also claiming that Samsung does not want any employee to be actively engaged with this recently established workers' union. Now remember, this isn't the first time that issues or a face-off between Samsung's management and employees have cropped up. In September, nearly 1,100 employees of this very plant staged a protest outside plant premises, claiming for better privileges, more representation, better pay, and
You're watching us here on Trading Hour. I'm Mangalam Malu. With me is Reema Tendulkar. In case you've just joined in, the important news of the day. The Reserve Bank of India has cut interest rates or repo rates by 25 basis points for the first time in the last 5 years, though they've maintained their stance, and the announcements around liquidity were also fairly calibrated, much against street expectations of a lot more liquidity to be given. Seems like the RBI is balancing out its action with commentary itself. The MSF rate, etc., have adjusted on account of the reduction that we've seen in repo rates. What has the market made of this? Well, not too much on the good or the bad side. The Nifty is marginally in the green after ending marginally in the red in yesterday's trading session. The Nifty Bank was marginally in the green yesterday and now is marginally in the red. The good part is the mid-cap index is doing a lot better as stocks are coming off the lows that they hit yesterday. I'm Mangalam Malu. With me, Reema Tendulkar. Hi, Reema.
Hi. I think the two key words from the RBI this time is one is flexible and the other one is forward-looking when it comes to inflation targeting, because that sets the stage for, Sanjay Malhotra's, term as the RBI governor. And economists are quick to point out that perhaps in April also a rate cut is coming. But finally, I think, Mangalam, we can say, thank God it's Friday, right? Like, this has been a long week because it was a continuation of last week, the budget in the middle squeezed in. So finally, done for the week.
Notwithstanding the results, the slew of results.
Especially on the consumer front. Yeah, a lot on the consumer front. But we're wrapping up this week. Well, you've still got about 4.5 hours to go. But we're counting down. And for the week so far, it's been a gain of close to about 0.5% on the benchmark indices. Banks are soft today. The Nifty Bank is down about 0.2%. But for the week, it's already clocked in about a 1.5% gain. Ajay Srivastava, Managing Director at Dimensions Corporate Finance Services, is with us on the show as usual. He always joins us unfailingly on Policy Day. Ajay, your first words, wise words?
Good morning. I had no wise or unwise, but he has done what he was brought here to do, is to give this symbolic cut. I think we all knew the RBI governor, the X1, did not want to push in, which is very correct decision. There is no reason to have pushed in a very symbolic rate. It's not that the banks are going to cut down the interest rates of anybody at this point of time. It's not that the people who want to put money into the bank as deposits are going to be happy if they cut down anything. So I think it's been a pure symbolic gesture if you ask me to say, okay, we want to cut down the rate. Now, why do we cut down the rate? Because inflation has not gone down. The liquidity situation is tight in the market. The rupee, the parity with the US interest rate is worse compared to last year. So if you look at the parameters of why he's done it, I think the whole market knows it's symbolic. Okay, let's push one more button and see if the growth comes in. But I think, we are more focused on the results which are coming through. We are more focused to see what's going to happen to the rupee dollar gap, which has now opened up for people who borrowed in foreign currency. And largely speaking, as you see, the market is very, very indifferent to this 25 basis point, because I don't have a terminal right now here with me, but I don't think the yields have gone down at all based upon this rate cut. So, symbolic rate cut, Be happy that there's so-called rate cut, but nothing much will change in terms of stock market, my friend. Results will still count, and what happens in the US and the Europe markets is going to make a difference to us. So it's not going to bring FIs back in a hurry, certainly. That's the problem.
Yeah, Ajay, thank you very much. I wanted to stay back to understand from you, how you understood the policy. Thank you very much for that excellent wrap. And your point about yield is well taken. It was at 6.65 before the policy cut. After the policy cut, it went to 6.69 because the expectation was maybe he will say accommodative stance. He didn't. He only gave a cut. So it's exactly where it was yesterday, 6.69, the 10-year bond yield, that is. But, if you can tell us how you will interpret it as a bank investor, in case you are holding a bank share, how would you look at it? On the one hand, the repo cut will mean the external benchmark loans will have to be marked lower. So there is about a 5 basis point drop in NIMs for most of the banks. But the governor is also promising more liquidity. He has told them that he is happy with the credit deposit ratio. I mean, in approximately those words. That is, you don't have to, scrounge on credit anymore. He's also said that he wants them to lend actively in the call. So regulation should not be all about prudence. It should also look at the efficiency cost, giving the impression that the LCR is definitely pushed out. It will not start on April 1. Is all this making you bank positive?
I think the fundamental flaw in all this, Latha, is that people who invest money in capex, in the private capex, look at 0.5, 0.25% interest to make a differential to the project. They don't. Believe me, they don't. None of them look at it. Yes, interest cost is relevant, but interest is a very small percentage of your capex cost of any large project at this point of time. What they need for is the demand will go up. What they need for is there is a requirement of credit in the market. That's where banks' fortunes are made. Now, we all know the story of unsecured credit. That segment is gone. We all know the story of mid-cap companies. Most of them, a good part, have raised equity in the last 2 years, which the QIPs are coming through, the IPOs have come through. Requirement of bank loans has gone down in the system of the credit-worthy bank who could have been lent the money to. Banks have a fundamental problem. They got people who want to borrow who they don't want to lend to, and the people who they want to lend to don't want to borrow from the bank. There's a fundamental, and it's a spin-off of what happened in the equity market. Our companies capitalized it so well.
Okay, may I ask, just as a counter, I agree with you that a large part of the unsecured loan constituency is hurt, but there is one borrowable constituency which has now 1 lakh rupees more in its pocket because of lower taxes. So while capex cycle may not have started off in the way in which one would like it, the retail borrower has more, the potential retail borrower has more money in his pocket, and therefore instead of taking an EMI of 90,000, he can take an EMI of 1 lakh, because there's 10,000 more rupees by way of tax giveaways. As well, banks have been told to lend. Credit deposit ratio is fine, is what the governor is saying. And he's saying that we will give more liquidity. The neutral question is, what is your attitude to banking stocks? Are you attracted to banking or NBFC stock now?
For the last 2 years, we've told you we have not held a single bank stock. We don't hold the banking index at all, zero. And the reasons we just outlined is, and I will not buy the bank stocks again for the same reason. 3 reasons. 1, whom you want to lend to don't want to borrow. Number 2, look at the number of banks compared to requirement. The competition is severe for the good quality names, and therefore it's very difficult to make money in the market. Maybe the banks which have got subsidiaries, which is insurance, mutual fund, etc., will do better. But a pure banking company today really has no way to generate value for your shareholders compared to many other segments of the economy. So for an investor, I think banking still remains a no-go territory as far as we are concerned. Nothing has changed in the whole scenario as far as we are concerned, and therefore their ability to give you shareholder return excess of 15-18%, Latha, is very difficult. The growth rate is 6.6% as the RBI has already mandated. So, how do you generate superior returns for a banking company at this point of time? If I sell some product, maybe I can. But money back, commodity money, I doubt it is the place where you're going to make money for the next year or so. I may be wrong, but 2 years it has done us well. Maybe next 1 year also, banking will become a problem area. The problem with interest rate cut is the borrowers now start expecting and saying, listen, why can't you cut it? The RBI has cut interest rate. The guy who's lending, the FD guy is saying, listen, I'm not going to give it to you. I'm going to go to the X bank who's going to give me a higher rate. So banks are now caught in a worse jam. The borrowers want it to be lower interest rate, and the depositors saying, if you don't give me the same rate, I'm going somewhere else. Imagine the plight of the bank.
Okay.
Not a good place for shareholders, right?
Okay. From a shareholder angle, my final question, I'm being very unfair to Malu. I know he's bursting with questions himself. If you take a combination of the budget and the monetary policy, do real estate stocks become attractive? Do consumer durable stocks become attractive because of the BNPL, uptick that may come?
See, real estate stocks have peaked, and I think real estate prices have peaked in the market. Just like any index peaks, all these things happen. 1 lakh crore, 100 crore flats will get sold, and so on and so forth. Just like what happens in a stock market, all of us buy at crazy P's or hold on to the stocks. Real estate sector is in for a correction for the simple reason it's too overbought. Too many investors sitting in real estate, actual holding who will want to dispose it off. So if you look at the next 3-year scenario, what we have analyzed, there'll be almost 50 to 60% of real estate bought in the last 2 years will come back to the market to be sold. And you know what happens once the prices plateau in real estate? Everybody wants to sell faster and faster. So that's why we said real estate sector, not only for interest rate, leave it aside, but the reason is overbought by financial investors who will want to dispose of properties, squeezing out primary sales out of the market for the real estate developers. So it's peaked, my friend. Unfortunately, if you're still there, whoever gets out, if you're an investor in the share, you're good enough. But I think for the next 1 to 1.5 years, real estate prices, underlying real estate stock, have peaked and will show a decline in our view. Maybe wrong, but that's what our view is.
All right, we take that point, Latha. Thank you for those questions. A lot of them we thought of. You'd asked. We will wrap it up on just one note. You said that you are not looking at the RBI policy or anything. It's the earnings that matter the most. Of the earnings that have come by so far, what is it that you liked in particular? Any sector which you think is on the cusp of a turnaround?
I won't say turnaround because it's already grown up. I think the hotels have surprised on the upside to say the kind of resilience they're showing, and still the rates in the market are absolutely phenomenal. I think that's one sector which has given us a great comfort that for 2 years time frame, you're in a good sector by and large. As a whole hotel, 6-7 companies listed, so you don't have too many choices of that, but also means that the segment is fairly concentrated. So hotels is one. Aviation is definitely the second one, which has surprised to the strength. Yes, there is issues on rupee dollar, which will keep coming in, but I think the demand supply is going to be in favor of these companies. So aviation, hotels, I think is very good. Capex at this point of time has corrected dramatically. So MNC Capex companies, now perhaps the results have been good. As always in market cut down, everything gets sold. But I think the MNC Capex companies represent a phenomenal turnaround scenario for the next 2 to 3 years, in spite of government lower Capex, because they supply to a different part of the industry. And the last one is, I think, auto ancillaries. I think they will be doing well. And the final one where we have a large holding is commodities. With rupee at 88, 89, now they can price their commodities 5% higher than they could last year, even if volumes are same. And that all that 5% will go to the bottom line. So I think commodity companies, there are very few in this country, will reap a huge bonus dividend in the next 12 months. Nothing to be done, just thanks to rupee dollar.
Indeed, the weakness in the currency has made the domestic companies far more competitive. That point is well taken. Thank you very much, Ajay, for joining in. He likes hotels, he likes aviation. They've surprised him with the kind of resilience across the last few years. MNC Capex companies, and then you've got commodity names. Get into a break, and that gives us a cue to talk about commodities on the other side of this break with Manisha Gupta.
Tensions between employees and management at Samsung's Sriperumbudur plant just outside Chennai have surfaced yet again. For well over 24 hours now, over 100 employees, we're told, have been staging a sit-in protest at Samsung's plant just a few meters from where I'm standing. In fact, this line of company buses and these barricades have been erected by Samsung so as to prevent members of the public and observers much like myself to see what's been going on through the gates of Samsung's plant just a few meters from where I'm standing. Now the issue is simply this. A few days ago, 3 members or employees rather of Samsung's plant were suspended after allegedly engaging in activities deemed detrimental to the interest of Samsung's operations in India. However, employees of the plant, a section of them, and members of the Samsung India Workers Union claim that this suspension was not on account of disciplinary action or disciplinary reasons, but simply because they were affiliated with the Samsung India Workers Union in the first place, also claiming that Samsung does not want any employee to be actively engaged with this recently established workers union. Now remember, this isn't the first time that issues or a face-off between Samsung's management and employees have cropped up. In September, nearly 1,100 employees of this very plant staged a protest outside plant premises, claiming for better privileges, more representation, better pay, and also representation by way of a union which Samsung said all that while that it was averse to forming in the first place. However, following the Madras High Court's intervention, Samsung India Workers Union became a registered union under the Tamil Nadu Labour Department, thereby ensuring that some of these workers' demands pertaining to representation by way of a union was summarily met. However, these issues clearly have not been laid to rest, simply on account of the recent suspension of those 3 employees. Now the issue is simply this. While these employees claim that they were suspended for their affiliation, Samsung in a statement has said the employees in question violated the company policy and have been suspended temporarily and will be subject to appropriate disciplinary action following a formal inquiry, end quote. Now while it's a case of he said, she said between Samsung and its employees, the fact is that these outstanding issues between Samsung and its employees don't seem to be going away anytime now, given the fact that both the employees and the management seem to be heading in different directions with regard to what they expect of each other pertaining to both representation and a basic disciplinary expectation.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC.
Welcome back. A couple of mid-caps doing extremely well. Yesterday, we told you about how ITC's cigarette volume growth surprised the street on the upside, right? Well, that stock is seeing a bit of profit booking, or perhaps, you know, the sentiment of other things weighing down on the stock with regards to weak FMCG consumption, etc., is keeping that stock under pressure. The positive of ITC's cigarette volume growth is actually rubbed off on Godfrey Phillips. Over the last many quarters, some 8 or 9 quarters, Godfrey Phillips has actually grown faster than ITC when it came to cigarette volumes. So could that be the case this time also or not, is what the street is betting on. That stock up around 8% on a day when the mid-caps are doing a lot better as well. But the RBI policy is done with, the rupees weakened. What does all of that have to do with commodities? Manisha joins in on a roundup of that. And Manisha, you're also looking at gold.
Well, I am, yes. We've done an all-time high of 2880 an ounce, and we've come slightly off those kind of levels right now, but the markets are not really giving up because every decline has led to a buying opportunity in India and various other international markets as well. Well, the US president's aggressive trade policies is the major reason for that. And then the street is also looking at global central bank buying, which in last 3 years has been above $1,000 and 1,000 tons rather. And if you look at the last 15 years, the global central banks have been net buyers in case of of gold. The World Gold Council report also tells you that in 2024, the global gold buying has been at a record high. It has been up 1%, but 4,900 tons is what global markets have bought. And apart from that, there also was a Citi report overnight which says that they are preponing their $3,000 an ounce target for gold, and they expect the gold prices to hit 3,000 in the next 1 to 3 months itself. I also want to take you through on what various global central banks really have done in sense of revision in forecasts for their gold prices. When you look at HSBC, Deutsche Bank, Macquarie, well, all of them believe that gold prices could be between 2,600 to 2,800 on the higher side. 2,900 is what ANZ has put it out as well. JP Morgan believes 2,800 to 2,900 is where the gold prices could be trading within. And then you have this complete bandwagon which believes $3,000 per ounce is in the coming, and that is Citi, Goldman Sachs, UBS, Bank of America, which believe that there is more steam left in gold and you could be looking at higher highs from here.
Well, 3,000 doesn't seem so far away when you're already at 28.64. Thank you, Manisha, for that. Get into a break. Before that, let's get you the Growth Code, a special initiative by Grow and CNBC TV 18 designed to provide you with valuable insights and strategies to navigate the market and make informed decisions. Today, we'll unpack the risks of speculative trading and the lessons learned in the aftermath of the infamous 2001 Ketan Parekh scam.
Speculative trading creates artificial demand and can inflate prices, often resulting in market bubbles. But one small prick and the entire illusion vanishes in an instant. Speculation is the reason 90% intraday traders end up with net losses.
Speculative trading dominates the market despite its risk is because of the lure of quick gains, lack of common sense, and there's obviously a lot of greed as well. Time after time, we have seen this cycle repeating. Right now, the money at stake is far higher and is of great concern at the moment.
The 2001 Ketan Parekh scam exposed the perils of unchecked speculation. Fueled by insider information and excessive leverage, Parekh manipulated stock prices to siphon off over 40,000 crore.
One of the biggest things that happened in Ketan Parekh scam was a kind of a narrative that got built. The hype was built so much that it ended up brainwashing the retail investors and traders. The biggest problem here was that while they were investing, the pump and dump scheme was happening simultaneously.
The crisis forced a reckoning, with the market regulator implementing sweeping reforms. Circular trading was abolished. A central fraud registry was created and stock options were introduced for the first time.
The scam definitely highlighted the risk of speculative trading and thereafter shifted the investors' focus to relatively safer and established companies. Investors became far more aware of the risks in speculative trading and the pump and dump schemes. Though the markets post-2020 also need similar kind of awareness.
While the scam helped correct systemic issues, traders also learnt about the risks of speculative trading. Learnings from the Ketan Parekh scam helped India build a stronger, more resilient market.
TV 18, now streaming live 24/7 on YouTube.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV 18, now streaming live 24/7 on YouTube.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV 18. Now streaming live 24/7 on YouTube.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV 18. Now streaming live 24/7 on YouTube.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV 18. Now streaming live 24/7 on YouTube.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV 18. Now streaming live 24/7 on YouTube.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV 18. Now streaming live 24/7 on YouTube.
Very smartly, 5 million added in Q3. Thirdly, the India mobile revenue. So on and whole, you take the revenues, you take the, you take the volumes, you take the realization or the ARPU, and revenues have gone up by 5.8% ahead of what peers have done. And also what the street is taking note of is that the price hikes took place in July. So Q2 and Q3 benefited from the price hikes, and we've seen a near 17% jump in the revenues, which basically means the entire benefit of the tariff hike has flowed through into the revenue. They've not lost anything due to down trading or just losing subscribers on the network. So that is a positive. The entire price hike seems to have been absorbed.
Take that point, and the stock is understandably up around 5% on that data. The other one on our radar is NCC. It's on the back of its third quarter numbers. Sudarshan, how did the numbers look?
So NCC has reported a weak set of earnings. It has missed EBITDA estimates by almost 10%. Margin has missed estimates by more than 100 basis points. But more than weak earnings, what has caught the attention is cut in FY25 guidance. Now, FY25 revenue growth now seen at 5% versus earlier guidance of 15%, and margin is seen at 9.25% versus guidance of 9.5 to 10%. Also on debt level, gross debt has seen a sharp increase. As of December 2024, gross debt was rupees 2,400 crore versus 1,700 crore that company had reported as of September 2024, and it's because of the delay in one of the payments related to JJM. And after this, JM Fin has come out with a note. It maintains buy call but has cut target to rupees 330. Also, it has cut FY25, 26, 27 EPS estimates by somewhere in the range of 12 to 27%. So weak earnings and guidance cut, and because of that, you are seeing a big fall in NCC.
Quite the accident of the day, 10% down on NCC now. But let's get to Upasana now for PG Electroplast. Stock is up 5%.
Well, the company's reported good set of numbers above street estimates, and mind you that the company has raised its FY25 revenue and profit guidance. Now, company says that the growth momentum in the product business continues to remain very strong, which has led to a strong performance, especially in the revenue. Now, company has reported a revenue growth of 82%, which was led by product business, which grew 1.4 times on a Y-on-Y basis. Now, company says that it is seeing a good momentum in RAC due to channel filling in the anticipation of strong summer season and clocked a growth of over 1.8 times in Q3 FY25. Coming to the numbers now, revenue stood at 968 as highlighted earlier with an uptick of 82%. Gross margins expanded by 110 basis points at 21.6. EBITDA margins also stood above the street estimates at 8.8% with an expansion of 90 basis points. And lastly, PAT also saw an uptick of nearly 1.1 times at 40 crores. Now, coming to the guidance of the company for FY25, company has overdone a 7% upward revision in the revenue guidance at 4,550 crores now, and 12% increase in PAT guidance at 280 crores. For FY25.
All right.
So all in all, strong set of numbers.
All right, Upasana, thanks a lot for that. But Reema, Indus Towers is also something that you're watching.
There's news.
Yes.
So the company has acquired 16,100 towers from Airtel and Bharti Hexacom, and they'll be paying about 3,300 crore rupees for this. Now, Citi says this transaction is favorable for the company. One, because the capital will be used for the core operations. Secondly, the company will be funding this by debt. So it does not in any way change the dividend payout plans. Remember, the street is hopeful now that the Vodafone Idea issue has been sort of resolved. They're getting money from Vodafone Idea. The company will pay a hefty dividend of 18 rupees in Q4. So that thesis remains intact. And plus, according to Citi, valuations are fairly reasonable, which is why they have a buy call. So they've acquired towers, which is core competence for the company. And it doesn't change the expectation of a dividend payout.
All right, we take that point. That's Indus Tower up around 3%. But the accident of the day, the other accident of the day is Bikaji. Why is that? Because inflation's eaten away the bhujia. Why is that? Again, if you look at the numbers, 14.5% growth in the company's top line, but that hasn't done much for the bottom line. The EBITDA is actually down by 26%. Gross margins have compressed around 257 basis points. And the underlying volume growth is just around 3%. So what explains this revenue growth? The company had to resort to price hikes. Remember, there was a fair amount of inflation that we've seen in edible oil and potato, as well as besan, which are the key ingredients of the bhujia that the company makes. And we have EBITDA margins down from 12% to sub 8%, and the net profit on the back of that down 40% itself. So inflation eating away the bhujia, and that in turn eating away the returns on the shareholders, down 11% for that stock. But we take a short break, come back, put the spotlight on M&M and LIC ahead of their third quarter numbers.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV 18, now streaming live 24/7 on YouTube.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube.
Tensions between employees and management at Samsung's Sri Perumbudur plant just outside Chennai have surfaced yet again. For well over 24 hours now, over 100 employees, we're told, have been staging a sit-in protest at Samsung's plant just a few meters from where I'm standing. In fact, this line of company buses and these barricades have been erected by Samsung so as to prevent members of the public and observers much like myself to see what's been going on through the gates of Samsung's plant just a few meters from where I'm standing. Now the issue is simply this. A few days ago, 3 members or employees rather of Samsung's plant were suspended after allegedly engaging in activities deemed detrimental to the interest of Samsung's operations in India. However, employees of the plant, a section of them, and members of the Samsung India Workers Union claim that this suspension was not on account of disciplinary action or disciplinary reasons, but simply because they were affiliated with the Samsung India Workers Union in the first place, also claiming that Samsung does not want any employee to be actively engaged with this recently established workers union. Now remember, this isn't the first time that issues or a face-off between Samsung's management and employees have cropped up. In September, nearly 1,100 employees of this very plant staged a protest outside plant premises claiming for better privileges, more representation, better pay, and also representation by way of a union which Samsung said all that while that it was averse to forming in the first place. However, following the Madras High Court's intervention, Samsung India
Welcome back. Let's put focus on the numbers then. Today, the big one from the Nifty is M&M, expected to release its third quarter numbers. Sudarshan joins in to tell us what the street expects. Sudarshan, we already have the volume data and we also have the Vahan data that you painstakingly put out every month, much ahead of everyone else. Let's hear you talk about the numbers as well.
So if you ask anyone which are those 2 segments in the auto sector which have been performing well, and those 2 segments are in passenger vehicles, it's SUV, and second is tractor segment. So which company is the leader in both these segments? M&M. So you can see in the volumes. YOY for auto, volumes of M&M have increased by 16%, and for tractor segment, volumes are up 20%. So on the basis of strong volume growth, we are expecting a healthy set of earnings by M&M for Q3 FY25. Profit is seen rising 29%, revenue may increase by 21%, EBITDA too can see a rise of 37%, and margin may increase by almost 200 basis points. It may come at 14.5% versus 12.8% that company reported in the same quarter last year. Also, realization may see a rise on YOY, but sequentially it may see a minor dip. Now talking about the commentary, what exactly we would be looking in the commentary. First, what is the status on overall demand if there is an uptick in the last few months, and what would be the target for FY25, basically estimates for FY25. For tractor segment, considering the demand growth in last few months, if there is any uptick in the estimate for FY25. And lastly, for EV, recently the company has made launches for 2 to 3 new products. So how has the demand been panning out over the last few months?
Thank you very much for that. And this dominance in SUVs and tractors is really showing up in the stock price. 85% up in the last 1 year. 250% up in the last 3 years. And even if you look at a CAGR return over the last 5 years, which is starting the time of COVID, it's been a 41% stock price CAGR for M&M. But we will get into a short break on that note. On the other side, we'll invite the management of Gulf Oil Lubricants. The stock is up 5% post Q3 numbers. We'll get chatting.
This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies,
Welcome back. Gulf Oil Lubricants. The stock is now in an upper circuit, 9% only buyers, and the stock has crossed its 200-day moving average with the up move. Good numbers. Revenue growth up 6.5% quarter on quarter, nearly 11% on a year-on-year basis, and margins at 13.6%. Ravi Chawla, CEO and MD of the company, is now with us on the show. So for the 9 months, Mr. Chawla, you've done about an 8.5% top-line growth. Correct me if I'm wrong. You had earlier shared a guidance of 12 to 14% for the full year. So, how is Q4 likely to shape up for you? And can you achieve at least a 12% to 14% revenue growth for the year?
Well, for us, we try to grow 2 to 3x the market. And as you know, the last 6 months have been challenging. We are seeing, of course, some headwinds, but also some recovery happening. The macroeconomic conditions in Q3 have been quite challenging. But happy to share that, we are going 2x the market. And we have, as you reported, 8.5% in revenue. Our AdBlue, which was going slightly soft, is now picked up in the third quarter. And overall, I would say our growth trajectory is continuing to be good, as you can see in the Q3 results, which is an all-time high for us in terms of revenue and in terms of our EBITDA, which is 122 crores. So overall, the demand conditions, in spite of being slightly, coming back, I would say, but we've been able to do well. And we continue to 2x the market, at least in terms of our revenue and volumes.
All right, that's incredible. You've been guiding for 2 to 3x, Mr. Chawla, and now you've done 2x in tough conditions as well. So let's get some other details out as well. If you could give us a sense of volume growth in the third quarter, and also if you could break that down up for your consumer business and your industrial B2B businesses.
Yeah, so we have 10% of our business which comes from factory fill, which is the new vehicles, commercial vehicles. So as you know, that is going through a bit of a, I would say, low in terms of that. So that has got impacted. If we take out that, we are actually growing close to 9-10%. And the balance 90%. And if we take our overall, our B2C ratio is about 55% and 45 is B2B. So that's intact. And if you look at that, yes, we've seen segments like, for us, the motorcycle segment is doing well. That's high double digit. And the industrial and what we call the infrastructure segment, these have started picking up again, double digit growth. So overall, I would say the factory fill has impacted us, but we are seeing some shoots coming in, and hopefully with all the, the budget announced, middle class and others gaining, and we see the trajectory going up. And the fourth quarter for us is generally a strong quarter because we have, though we have achieved our highest ever, we hope that the fourth quarter this continues. And this is usually where our distributors and other such, promotions end and a lot of push happens. And of course, the brand is also very strong. So distribution things come to play. And overall, our B2B businesses are doing well, and OEM is also going to pick up. So I think it augurs well in terms of our fourth quarter.
So what was the absolute volume growth for you in this quarter? And did you gain market share? Where does it stand at?
Yeah, so I forgot to mention it. You started with that. We did 38,500 in terms of lubricants, which is a 7% growth year on year. And this is the highest ever we have done. And sequentially, earlier used to be about 37,000 in most quarters, the best quarters so far, now 38,500. And I think that's the volume growth we have. And AdBlue also has picked up, I would say around 36,000 is what AdBlue is. So that's again a good growth for us, 13% odd. So overall, I think 13% year to date in AdBlue. So overall, good numbers coming in Q3. And I think what we've also shown that how resilient our business model is in spite of the headwinds, and of course, happy to see early signs of demand recovery.
So 7.5% volume growth in Q3. Considering Q4 is stronger, what could be the volume growth in Q4? And also you've said exports have done well. What was the growth?
Yeah, so exports is quite high. I would say more than 20% growth in exports. And that's good for us. We're exporting to more than 25 countries for our 4 or 5 of our OEMs. And yes, 2x of the market. Whatever happens in Q4, demand conditions are 3 to 4%. We are hoping we can do well on that and try to do better than that also.
What is the export contribution now? 20% growth, and is that sustainable, or do you see it with rupee depreciation? We should see higher growth.
So exports is mid-single digit. It's not that high in terms of volume, but doing well. And yes, good prospects on that. As we see the Indian OEMs going, and also a few other, we would announce a few more partnerships with OEMs for export shortly. So I think that also augurs well for us, looking at India as a good supply place also.
Where does your market share stand at right now versus the start of this year? Since you've been growing faster than the market, we just want to get that number out.
So normally, we have different segments, so it would be segment-wise. But as a benchmark, if we are growing 2x the market, we would generally gain about 0.5% market share or, 0.4, 0.3%. Certain segments, obviously, we try to do better. Industrials and others, we are less than 5% market share. So segments like diesel engine on motorcycle, we have higher share, close to 9-10%. And of course, amongst OEMs in the private sector, we are a lead player. So it varies, but benchmark wise, if we are doing 2x the market growth, we would gain about 0.3, 0.4% market share.
Any price decision?
Yeah, sorry.
Any price decision taken in Q3 or you plan to in Q4?
Well, we have to wait and watch on the foreign exchange because we do import our base oil and low crude we expect it to be steady. I think we have some adjustments we do in our trade schemes, etc. But we'll have to wait and watch the next couple of days to see what is going to be the impact on the forex.
Right. Are there any downside risks to your margins or any upside triggers? Because the downside risk would be your base oil being imported, and the upside risk would be premiumization along with the crude oil prices itself being range bound.
Yeah, so we've been saying 12 to 14%. Happy to share last quarter was towards the higher end. And of course, it's affected. We have a lag time on the increase in the base oil. Forex, of course, also impacts us. But we've also been focusing a lot on our premium product ranges, which are less than 10 today. But we are trying to grow that 2 times. So if we are growing 7%, we would like to grow 2 times that. And that's happening successfully. So I think it's a mix of managing that. But I think we are quite committed to the 12 to 14% band as of now. And of course, we'll have to wait and watch unless there's something which is going to really, but there's a lag time, and then the recovery also happens in the B2C market. The prices go on. Then the B2B business is more, PVC led and also contract led. So I think we are good for that 12 to 14%. Happy to do more, but obviously depends on the competitive scenario also.
All right. On your battery business, you were looking at around 300 crore in the next couple of years. Where does that stand at? And Tyrex as well. You were expecting to, double that revenue and turn EBITDA positive. So what's the update on that before we let you go?
So on Tyrex, which is primarily into DC chargers, the fast chargers for the EV market, happy to share that, as you mentioned, we are looking at doubling the turnover and more. We are well on course with that, but they've got 8-10% market share, and we're happy to say we're 1,800 DC chargers installed. So we are on track to double that in terms of turnover, and obviously the market is going to grow. On the battery business, happy to share that again we are growing, but we do have the 300 crores. I think is more of a longer term vision for us. We are at about, I think, around 75-80 crores annually on that. But last quarter has been good. We've also, we used to import most of the batteries. Now we are getting some local sourcing done. And that is a business which also helps us in terms of our synergy of our distribution. And that's really where we are. Right. And that's more of a medium-term vision, the number you gave. Yeah.
Take that point. Thank you, Ravi. Always a pleasure speaking with you. Wish you good luck for the remainder of this year as well. And 2 to 3x is your guidance, always above the market, gain market share and stay margins between 12 to 14%. Take a short break, get you more on the markets on the other side. Well, we are seeing some recovery for the Nifty right now, up around 50 odd points, 90 points up for the Sensex. Trent is one of the stocks which was under pressure in yesterday's trading session post their numbers, but now showing some bit of recovery from the lows. The auto pack is doing extremely well. So we have Bajaj Auto, M&M ahead of its numbers, as Sudarshan said, Hero MotoCorp doing well too. So we'll wrap up on this edition of Trading Hours. Stay tuned. Halftime report comes up next, but it's not just halftime report. You're also looking at the RBI presser or the press conference of the new RBI Governor. We'll get you all that and more in just a bit.
With adverse weather events pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and this growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade.
Hello and welcome to Halftime Report. The Reserve Bank of India has just announced its monetary policy, and the Reserve Bank of India top brass, including the new Governor Sanjay Malhotra, are all set to address the media after the announcement of that 25 basis point rate cut, widely anticipated by the market. The markets were expecting a bit more on the liquidity front, where RBI has chose to play cautious given the uncertainty in the global macroeconomic environment. We've also seen the CPI forecast for next year slightly lower than this year's 4.8% at 4.2%. The GDP forecast for next year is seen at 6.7%. So lots of cues to watch out for. We have the Reserve Bank of India governor that will shortly be addressing the media on various questions. I think we'd also want to know more on what the governor says about the LCR, the ECL, the project finance rules, all these guidelines that are about to kick in over the course of the next few months that require banks to keep aside additional capital. Whether or not that is deferred, we'll have to watch out for. But take a look at the governor.
Shri M. Rajeshwar Rao, Shri T. Ravi Shankar, and Shri Swaminathan J. We also have with us Executive Directors Dr. O.P. Mal and Dr. Rajiv Ranjan and other colleagues from the Reserve Bank. To begin with, as is the practice, I'll request Governor to make his opening remarks. After that, we'll have the question answers. Governor, sir.
Well, good morning, good afternoon, and welcome to this press conference. I already made my statement, which we have also uploaded, and I'm sure you would have already gone through it. I do not have anything more to add. The MPC resolution, the rationale for it, and some of the other additional measures that we have brought in are very clearly communicated over there. So I think we can directly move towards the Q&A. I think that will give more time for all of you to ask additional questions. So we can begin, I think, with the Q&A directly.
Thank you, sir. Just before we begin, a couple of announcements as always. I'll request you all to please wait for your turn and restrict to one question per person. And if time permits, we can always go back for the other one. So you can see my colleagues on the aisle with mics in their hands, so they will give the mics to you. So please speak in the mic so that people outside can also hear you. So there are 27 participants from the media today, and with your permission, I'll call out their names. I'll request Latha from CNBC to ask her question.
Thank you, Governor and Deputy Governors. Sir, I just want to first clarify a language part and then my question. Because in Para 7, where you are announcing the rate cut, you say that the MPC remains unambiguously focused on durable alignment of inflation while supporting growth. So inflation first, then growth. In the immediate next paragraph, you are saying the growth inflation dynamics open up policy space for the MPC to support growth while remaining focused on aligning inflation. So should we read this as deliberate or casual? And the question I have is, rate cuts normally get passed on when liquidity is surplus. So would your stated policy be to keep liquidity surplus in the interbank system or just adequate? Thank you.
So let me come to your second question first. I think that was attempted in the statement also that we made. And you would have observed in the last couple of months and even before that, that it has been the endeavor of Reserve Bank to provide as much liquidity as is required. And when we say liquidity, as I also mentioned in my statement, it is both, overnight as well as durable liquidity. We have taken a number of steps. You are aware, that we introduced, perhaps for the first time, a regular pre-announced every day overnight repo rate operation. So this was primarily to
give confidence to everyone that this window is always available insofar as the transient or the overnight liquidity is concerned. Even for the longer term durable liquidity, we have announced steps of about 1.5 lakh crore, some of it which have already been put into operation. 20,000 crore of OMOs have already been done, another 40,000 crore later on. Today, we are going to have a 56-day VRR for 50,000 crore. We are always watchful. We'll be nimble. I want to assure that we'll be very, very proactive in providing whatever liquidity requirements are needed. That's one of our jobs, and we will do it. Coming to your first question, I really did not, understand as to what you are. Everything, every statement, every word that is mentioned in the MPC statement, and especially, the resolution, because you were pointing at the resolution, is very, very well crafted, thought out, and deliberate.
Thank you, sir.
Thank you.
Thank you, sir. Next will be Swati from Reuters.
Thank you so much, sir. So your growth forecast for next year is at 6.7%. This is yet again at the upper end of the government's range. They've given us a 6.3 to 6.8. And as we saw last year as well, RBI had to lower their projection towards the end. What gives you so much optimism on growth, especially when you're saying that, you remain neutral purely because inflation risks could come up again with the heat waves, etc. So what gives you the optimism on growth, sir? Thank you.
See, all the parameters we analyze very regularly, the high frequency indicators that we have, and whether one looks at agriculture with good reservoir levels, and I've made detailed assessments even in my MPC statement. You can go through them as to what are the reasons. Actually, they are all given over there. So in interest of time, I am just shortly, very briefly indicating them. So whether it is in terms of agriculture, whether it is in terms of consumption. Now you also recently had the Nielsen survey, the consumption numbers over there at 7% plus, augur very well, and this is the kind or the range of projections that we too have for personal consumption. And similarly, the manufacturing activity, is also kind of picking up. The PMI levels that we got were very comfortable over there. So all this gives us the optimism that we will have what the numbers we have projected. I also mentioned in my statement that we will continue to improve, our macroeconomic models, our nowcasts and forecasts, so as to be able to give as precise a number as possible. Please bear in mind that these are just forecasts. Every day situations change, and as people say, as your facts change, your opinions also change. So those it's subject to that. Thank you.
Thank you, sir. We'll move to Mr. Manojit from Business Standard.
Thank you, Governor. Thank you, Manojit. Is it fair to say that at this point in time, the priority is growth over inflation? And what could be the real rate at this juncture of growth inflation dynamics?
See, the RBI Act has given us a very, very clear mandate. Our primary objective, see, for some countries, you are aware, it's a dual objective, where very explicit dual objective to have both price stability and growth. In our case, the primary objective, that is not to say, the other objective is not important. The primary objective is inflation, is price stability, keeping in view the growth objective. So we will continuously, focus on that, trying to meet, these objectives. we will try to align the inflation with the target that has been given to us, at the same time supporting growth. At present, as the resolution also says, we felt that time has come that we can be more supportive of growth because inflation is coming down. It is expected to go down. However, it also says that we will maintain a neutral stance so that we are able to proactively respond to the evolving macroeconomic conditions. Thank you.
Sir,
Thank you.
Real rate. What could be the real rate according to you, given the current growth inflation dynamics? The real interest rate.
See, today we are at 6.25%, and the inflation is 5.2%. That is the CPI inflation. The WPI is lower, so that would give you, a real rate of about, let's say, 1.5% or so. That's what it is at present.
Thank you, sir. Moving on, we'll have Mr. Anup from Bloomberg.
Sir, coming back to the inflation forecast, inflation target again. We have 2 to 6% inflation band. You have that convenience of that band also. You mentioned that of the flexible inflation targeting, and at the same time your original target is 4% for the medium term. So just wondering, will you be comfortable if inflation remains within the 2 to 6% range, or you will want to see inflation durably settling around 4%?
Sorry, what did you say your name is?
Anup Roy from Bloomberg.
Anup Roy. I'll ask you, when you go to an exam, in that exam, the maximum marks are let's say 100. The passing marks are 40. What do you aspire for? Do you aspire to pass, or do you aspire, to do extremely well? Well, some may, like to just pass. In RBI, we like to we like to be on top of everything.
Thank you, sir. May I have Mr. Ankur from ET Now?
Hello, Ankur Mishra from ET Now. While economic survey says that 6.3 to 6.8% is the growth forecast for the next financial year, and you have taken the upper end. When I asked this question to CEA, that is there a possibility of 7% plus growth, he said yes, it is possible. I want to ask you now, as per your assessment, is there an optimistic possibility of that? And one more question, sir. Regarding the ECL provisioning and project financing norms, you have mentioned in the statement right at the front, but you also said phased implementation. Now, these implementations are as soon as from next month or 1st of April. As per the draft norms, of course, the final norms are yet to come. In project financing norms, it was mentioned that it should be 2% in the current financial year, and then in FY26 and FY27. Similarly, for LCR norms also, 1st April 2025 was the tentative date which was given. I want to understand, where do we stand here? Is there going to be a deferment, or these will be implemented? Thank you.
Your first question, whether 7% is achievable. See, these are difficult questions to answer, but nevertheless, I would like to stick my neck out and say that certainly India can, achieve 7% and plus growth rate. We should certainly, aspire for that. Coming to your second question, which is related to some of the guidelines, that we have issued, LCR, ECL, project financing norms, etc., etc. I made it very, very clear, that we will be doing a balancing act. It is not only about stability. It comes with a cost. We will be very, very conscious of the costs that it brings in, so that, we make efficient use of our resources. I want to also clarify, because you asked specifically about LCR, and we did make a mention over there that we will give sufficient time. I do not think 31/3/2025 is giving sufficient time. So certainly they will not be implemented, before at least, before 31/3/2026. That's the kind of timeline that is needed at the minimum. The draft regulations were circulated. We have got comments. We are examining them. It will take time for us to examine. You see, liquidity is important for everyone. Let's please, try to appreciate that why we are doing this. We are doing this primarily, so that there is no run, on the banks. You would have witnessed it, in 2023, there was a run on some of the US banks because they do not have, such kind of regulations. Now we have those regulations, but whether the liquidity that we have, provisions that we have, whether they are sufficient or not, that and they need to be always, continuously need to be improved. So that's why, we had provided for certain more liquidity to be kept vis-a-vis some of the deposits which we felt, would perhaps, have a higher runoff. That has been provided in these draft regulations. At the same time, we have got now comments from other stakeholders that there may be lower liquidity requirements for some of the other deposits. So we are examining that also. As soon as we are able to examine all the suggestions. And I'm very happy, to note, having come here to the Reserve Bank, that we do, an impact analysis over here. So that impact analysis will be done, has been done to some extent, but come, with the suggestions that have now come in, we are revising our estimates, our impact analysis, and we will give, a time frame as to when one can expect LCR. Similarly, the other guidelines also we will give sufficient time frame. You can rest assured, that they will certainly not be implemented as quickly as 31/3/2025 because that will certainly not be sufficient time. We do not want to cause, any disruption. We will ensure a smooth transition. Thank you.
Said not until March 26.
Yes.
Thank you, sir. Please, let's go with the flow.
Let him ask a clarificatory question only with regard to this.
Please speak in the mic.
26. It will not be before 25.
Be very, very clear. It's more than 1 year. 2 months, less than 2 months is too short a window for the banks. We realize that. And so, we will give at least 31, at least. Doesn't mean it has to be 31/3/2026. We'll aspire for that. But we want to make it very smooth. And it will also be phased. It will not be, that all the regulations, all the norms kick in from day one, which will be at the earliest 31/3/2026.
Thank you, sir. Next is Hamsini from Money Control.
Hi, sir. I'll stay put on this part around regulations. Your language also today seemed to indicate that there will be a lot more consultative process in the way that you would go about building regulations. You did clarify on LCR, but what we've also seen, especially in the last 4 years, and more so in the last 1.5 years, is certain banks and NBFCs facing ban on businesses, certain aspects of businesses. There are 2 large banks still waiting to come out of restrictive business policies. Would you rethink your approach on how you would want to target banks or work with them to rectify some of the follies? And as a clarification, you did mention about LCR, but what about on project finance and investment guidelines that banks are permitted to take in subsidiaries, etc.? Would you want to defer, or there has been request for a deferment on that as well? Would you want to consider those proposed policies also favorably, sir?
See, ECL was only a discussion paper. Even the draft is not out. So there is no time frame for implementation of ECL guidelines. Similarly, project finance, you can rest assured, I think they will need more time. 31/3/2026 is the earliest. Moreover, they need to be seen in conjunction with each other. There is a certain amount of overlap between ECL and project finance. So we are examining, because for project finance, the draft regulations were certainly published, comments have been received, suggestions have been received. We are examining them, and we'll come out with something, I want to assure all of you, that which balances the interests of the public, the depositors, the financial stability, which is very, very important for our country, and at the same time, the concerns of the banks, keeping in mind the efficient use of resources. And what was your second question? Sorry, is on, two banks, where we have cease and desist measures. See, these measures are taken after great consideration, after great thought, after giving opportunity to these entities, whether it is these banks or others. I'm not, making reference to any particular entity. And these are measures actually, of last resort. We would not like to use them, too often. This is a measure of last resort to be used in the rarest of the rare circumstances, when all other measures have actually failed. And they are again, in the interest of the public, and we'll keep, this policy going forward as well. Thank you.
Thank you, sir. Next will be Ms. Gopika from the Mint.
Thank you, Puneet. Thank you, Governor. My question is on inflation forecast. You've retained the inflation forecast for this year and next year. But have you taken into account the impact of rupee depreciation while accounting, or have you factored in the impact of rupee depreciation while calculating or looking at the forecast? And my second question is on the new Deputy Governor. For monetary policy, when can we expect the appointment?
Second question you have to ask the government, it's not for me. Your first question, yes. The latest rupee to dollar rate was taken into account while making, all our projections. So, and we also do, various sensitivity analysis. So yes, a brief answer to your question is yes, that was certainly considered while making our projections.
थैंक यू सर. अब मैं जी बिजनेस से एकता सूरी को आमंत्रित करूंगा.
गुड आफ्टरनून सर. सर, हमने आपकी स्पीच में सुना कि आपने फ्रॉड्स के ऊपर बात की कि .in होगा बैंकों का डोमेन नेम, लेकिन बहुत सारे इश्यूज हैं जो कस्टमर्स फेस करते हैं फ्रॉड्स की. अगर हम बात करें, सबसे पहले कोई रिपोर्ट करता है फ्रॉड तो उसे पैसा जल्दी वापस नहीं मिलता. दूसरा, पेस्की कॉल्स बहुत ज़्यादा आते हैं नॉर्मल मोबाइल नंबर से. बहुत बार आपने बोला है कि आप टॉपअप लोन से, होम टॉपअप लोन से, उसे पर्सनल लोन्स की तरह एडवर्टाइज मत करें. अभी भी वो हो रहा है. 1600-140 नंबर्स भी आपने बोला है ट्रांजैक्शंस और मार्केटिंग के लिए होंगे, लेकिन वो भी कोई नहीं सुन रहा. तो ऐसे सिनेरियो में क्या आरबीआई कोई स्ट्रिक्ट एक्शन लेगा बैंकों के ऊपर ताकि कस्टमर का बचाव हो इन सब सिनेरियोज में?
निश्चित रूप से हमारा पूरा प्रयास रहेगा कि जो भी हमारे ग्राहक हैं, जो जनता है, उनको अधिक से अधिक सुविधाजनक तरीके से बैंकिंग की समस्त सेवाएं उपलब्ध हों. चाहे वो बैंकिंग फ्रॉड से संबंधित हो, जैसा कि आपने कहा, या आपने कहा पेस्की कॉल्स उनको आते हैं, उसमें किस प्रकार से जो है हमें उसमें कार्य करना चाहिए, किस प्रकार से हमें उन्हें हिदायत देनी चाहिए और क्या हमें उसके खिलाफ एक्शन लेना चाहिए, वो निश्चित रूप से इस संदर्भ में लिया जाएगा. और अधिक आपने कई सारी छोटी छोटी चीजें पूछी हैं. विस्तृत जानकारी के लिए मैं अनुरोध करूंगा हमारे डीजीज को कि वो आपको इसके बारे में कुछ और, क्योंकि हमने कई कदम इसके बारे में ऑलरेडी लिए हैं, तो संक्षेप में मैं रिक्वेस्ट करूंगा स्वामीनाथन जी को और राजेश्वर राव को कि वो इसके बारे में बताएं. और आप यू कैन स्पीक इन.
Yeah, thank you, sir. Thank you. I think I'll take the liberty of responding in English.
I know you
avoid any ambiguity.
Yes.
To avoid any ambiguity. Thank you, sir. I think just to supplement on that, yes, you also mentioned about the steps that we have already taken. So as far as the regulated entities are concerned, instructions are already in place to use certain series of 140 or 1600. We also do a lot of awareness campaigns to educate the consumers how to stay away from pesky or fraudulent calls. it is also put in place from a regulation perspective, limiting the liability of customers in unauthorized electronic banking transactions is in place. The provision to give us shadow credit pending full investigation is also kept in place. And adherence to this is also examined when we do the on-site supervision. But oftentimes there are also pesky calls that emanate from unregulated entities and apps and platforms. This is something which only an active collaboration of the government, regulator and the law enforcement we will be able to work on. But this is something which we are conscious of, and we will take every possible step to ensure that the consumer's interest is protected. And wherever there has been a loss, it is our endeavor to work towards an early redressal.
Sir, I know you've mentioned a lot of things that are already in place, but since banks, even if RBI continuously keeps on saying that you have to do this, banks do not listen. Till the date, banks have advertised home top-up loans as personal loans, saying take the loan, use it for your marriage, use it for travel. Or, when you go for a loan, they insist on taking, you have to take an insurance or a credit card. Mis-selling is on rampant. So on these issues, any supervisory action?
See, there are 2-3 issues that you mentioned. Each of them, of course, the framework is certainly in place. Oftentimes, as Governor also mentioned, many of this behavior which is not consistent with the regulations, we resolve through dialogue. A supervisory action which gets publicized is only in the rarest of the rare cases where there are egregious violation or the most outlier behavior. Otherwise, oftentimes, the supervisors engage with the entities on a bilateral basis and ensure that the regulatory guidelines are adhered to. So that shall be our endeavor. You may not get to read them in the media, but wherever there is a non-compliance, on an annual basis and also on an ongoing basis, we deal with the entities, and oftentimes they all are complied with over the course of time.
Just to add to DG Swaminathan, the guidelines are already in place regarding top-up loans, what are the end use, etc. If it is given for unauthorized different purposes, it would be taken as an unsecured lending and will have to be dealt with accordingly by the bank. That is one point. As regards this mis-selling and forced insurance, RBI guidelines are already in place regarding this mis-selling issues, and we are also looking at comprehensively reviewing these guidelines. We should be trying to come out with some guidelines shortly on this area also, on the conduct of the banks in various areas.
Thank you, sirs. अब मैं अनुराग शाह से आग्रह करूंगा कि वो अपना प्रश्न पूछें.
थैंक यू पुनीत सर, थैंक यू गवर्नर. सर, जिस तरह से आरबीआई ने भी कहा था कि जो बैंकों के द्वारा इंश्योरेंस कंपनियों में निवेश किया जाता है या फिर जो दूसरी सब्सिडरीज में निवेश किया जाता है, उसके निवेश से जुड़ी हुई गाइडलाइन जो है वो आरबीआई की तरफ से कब तक आ जाएगी, और क्या उसमें हम ये भी देख सकते हैं कि जो बड़ी इंश्योरेंस कंपनी है, कोई बैंक के अंदर मेजॉरिटी हिस्सा खरीदने का भी उस तरह का प्रावधान होगा? और सर, अभी जब जिस तरह से कुछ वक्त पहले वित्त मंत्री ने भी बैंकिंग प्लेटफॉर्म के जरिए मिस सेलिंग की चिंता जताई थी, चीफ आईआरडीए के चेयरमैन के द्वारा भी चिंता जताई गई थी, स्पेशली इंश्योरेंस के संदर्भ में, तो क्या आरबीआई का डेटा भी उसको सपोर्ट करता है या फिर आरबीआई का क्या कहना है?
नहीं, देखिए, जैसा कि अभी आपको स्वामीनाथन डीजी ने बताया कि मिस सेलिंग के हम लोग बिल्कुल सख्त खिलाफ हैं. कोई भी इस प्रकार का यदि वाकया होता है, इस प्रकार का कोई भी इंस्टेंस हमारे ध्यान में आता है, तो निश्चित रूप से उसके विरुद्ध सख्त से सख्त कार्रवाई की जाएगी. आप इस बात के बारे में बिल्कुल 100% निश्चिंत रहें कि किसी भी ग्राहक के विरुद्ध यदि मिस सेलिंग की कोई भी शिकायत है तो रिजर्व बैंक उसके लिए उसके साथ में नहीं है और उसके विरुद्ध में उस बैंक या रेगुलेटेड एंटिटी के विरुद्ध में कार्रवाई होगी. कार्रवाई किस प्रकार से होगी, जैसा कि टीजी स्वामीनाथन जी ने भी आपको बताया, वो हमारे को उसके लिए ऐसा नहीं है कि हम उसको बैंक को बोलें कि हम आपका रजिस्ट्रेशन ही बंद कर देते हैं, लाइसेंस बंद कर देते हैं. ऐसा तो नहीं किया जा सकता, आप भी ये समझेंगे. लेकिन हम इसके लिए बहुत ज़्यादा गंभीर हैं और इस प्रकार की अगर कोई घटनाएं होती हैं तो उनको गंभीरता से लिया जाएगा। पहला आपका जो प्रश्न था वो था कि किस स्वरूप में जो बैंकिंग कंपनियां हैं और उन्होंने कई सारी अपनी सब्सिडरीज वगैरह बनाई हुई हैं, एनबीएफसीज हैं, इंश्योरेंस कंपनीज हैं, उसके बारे में एक मसौदा जो नियम का है, रेगुलेशंस का, वो हमने प्रकाशित किया है और उसके बारे में कई सारे सुझाव हमारे पास में, टिप्पणियां, सुझाव हमारे पास में आए हुए हैं, उनका हम अध्ययन कर रहे हैं। देखिए, जैसे मैंने आपको बताया, ये सब चीज़ों को हम ध्यान में रखते हुए उनके सुझावों को पूरा से गहनता से अध्ययन करने के बाद में ही कोई निर्णय लेंगे। मैं इतना ही इसके ऊपर मैं आपको बताना चाहूँगा कि अगर कोई कंपनी या बैंक एक और सब्सिडरी के मार्फत से वही बिजनेस, वही व्यापार करती है तो उससे जो है दो प्रकार की हमारे को समस्याएं सामने आती हैं। एक कॉन्फ्लिक्ट ऑफ इंटरेस्ट रहेगा, क्योंकि वो सेम कंपनी है तो इस कंपनी में व्यापार हो या उसमें हो तो एक कॉन्फ्लिक्ट ऑफ इंटरेस्ट है। दूसरा जो इसके अंदर में समस्या है वो ये है कि एक रेगुलेटरी आर्बिट्राज है। बैंक्स एक अलग कानून के ढांचे में कार्य करते हैं, एनबीएफसीज एक अलग कानून के ढांचे में करते हैं, तो उसकी वजह से जो रिस्क्स हैं एनबीएफसीज के वो बैंक्स के ऊपर में न आए, इसके पीछे में ये जो हमने जो मसौदा प्रकाशित किया है उसके पीछे में ये है, ये उसके पीछे में विचार है। ये बात भी हमें ध्यान है कि कई सारी कंपनियां, कई सारे बैंक्स ऑलरेडी इसमें लेगेसी इश्यूज हैं, तो वो ऑलरेडी जो हैं उन्होंने इस प्रकार की कई सारे एनबीएफसीज, कंपनियां, सब्सिडरीज स्थापित की हुई हैं। तो उनके बारे में अब हमें क्या करना होगा, क्योंकि हमने ही उनको इस प्रकार की पहले अनुमति दी। तो अब इन सब चीजों को सोच करके और विचार करके किस प्रकार से हम आगे इसमें एक सब मिलजुल करके, ताकि लोगों के जो डिपॉजिटर्स हैं उनके भी ध्यान को, हित को ऊपर रखते हुए और साथ ही साथ जो हमारे अन्य जो हितधारक हैं जिनमें बैंक भी सम्मिलित हैं, बैंक के ओनर्स सम्मिलित हैं, तो उनको सबको ध्यान में रखते हुए ही हम कोई कदम इसके बारे में लेंगे।
धन्यवाद सर। नेक्स्ट विल बी मिस्टर विश्वनाथ फ्रॉम एनडीटीवी प्रॉफिट।
Good afternoon, Governor. Thank you so much, Manish, sir. Governor Vishwanath Nair from NDTV Profit. Two things that made sort of a debut in your speech. First was the less restrictive monetary policy, which I think a lot of people expected a rate cut but weren't sure how long this is going to last. So I just want to understand from you, when you say that the MPC feels a less restrictive monetary policy is appropriate in the current juncture, is it limited to this policy or are we talking about the next few quarters? And the others, like second part which made a debut, and that's in continuation with these regulatory moves, is the cost of regulation, which I've never heard the RBI talk about. At least the RBI always talks about the need for regulation, not so much the cost for regulation. Yes. I just wanted to understand from you, so far a lot of my colleagues here have written about how the RBI is a no-nonsense regulator, you know, sort of an iron fist type of regulator. Are we changing that face at all?
No, I can't talk, about the past. It will not be correct on my part, to sit on judgment. But I would certainly say that RBI as an institution has been able to, over the years, carry out the mandate that has been given to it. And I would also like to say that I do think that the cost of regulation may not have heard of it is a different thing. But I think back, consciously or unconsciously, I think consciously, this would certainly have been a factor in determining what, they are going to do. You may not have heard it, that's a different thing. So I can't say about that. But what one can see, having been outside the RBI and having interacted with the RBI, being on board of the RBI, is that certainly, all these factors
are certainly, considered while making any regulation. So it's not only, about financial stability, it is also, about the cost at which, these things come in. I only made it very, very clear so that everyone is, assured about that. So this is one. And second, you said, whether this is policy only for this. Well, obviously, when we are keeping a neutral stance, and as was mentioned, the rationale for that is the tremendous uncertainties, that we are facing today. That does not call us, to change our stance. So our stance remains neutral. This less restrictive policy is only, for this particular MPC meeting, and not, going forward. This stance continues to be neutral. Thank you.
Thank you, sir. Next, we'll have Mr. Chris from FT.
Hi there. Thank you very much. I was wondering how concerned you are about the recent pressure on the rupee going forwards, and are you also worried about imported inflation?
Well, the rupee is the rate, that the rupee settles at is a function, of the demand and supply, number one. Number two, I would also like to say, that we should really, not be looking at, but that's, perhaps our job, and so we do it. We should not really be looking at, a day-to-day kind of a volatility. It is, more the long-term rate, that we should be looking at. And when I say this, I say this, not only for the rupee, but also for other asset classes, whether it is the Sensex or the Nifty, or whether, it is the gold prices or the asset prices. Day-to-day movements may not be, all that, important. As I mentioned, this was certainly factored in while deciding on the rate cut and the stance that we are maintaining. It was certainly factored in. That's one thing I would like to say. And the second thing is, of course, as you are aware, that a higher or a lower, or depreciated rupee certainly, puts pressure on inflation. But at the same time, global uncertainties are also, I think a higher worry, for us would be the global uncertainties as to how, that pans out. So global uncertainties, even if, the trade wars, the tariff trade wars were not to carry out, but just the uncertainty in itself is something, which is worrisome. And that, because, that has direct impact. That has direct impact on growth. That has direct impact on investment decisions. That has direct impact on consumption expenditure decisions, which get deferred. So let's keep in mind, that and a lot of, the appreciation of the dollar and the depreciation of the rupee is actually linked, to this uncertainty. So this uncertainty being the underlying cause, to a great extent, of the dollar strengthening, rupee depreciation, is not good for growth, and it's not good for imported inflation. So that is something, which we all need to be cognizant about. Thank you.
Thank you, sir. Next would be Mr. Siddharth from Informist.
Thank you, sir. Afternoon, Governor.
Good afternoon.
So, just one question on liquidity. The government's high cash balances in recent years has made the RBI's job of managing liquidity difficult. In the FY26 budget, the WMA limit has been increased substantially to 5 lakh crore. The Economic Affairs Secretary also said the government will aim to keep a lean cash position.
Which limit you said has been increased to 5 lakh?
WMA. The recourse, total recourse for WMA.
Okay.
And the Secretary also said that we'll try to keep a lean cash position, but much of the cash holdings is down to states' surplus and their investments in 14-day T-bills. I think end of FY24 it was in excess of 2.5 lakh crores. is there anything happening between the government and the RBI to discourage states from holding such large surpluses, maybe reduce the interest on these T-bills further, allow them to park it with banks, their money with banks maybe? Second, just on, you mentioned tremendous uncertainties. Does this that we face today, does this make a case for the RBI to perhaps increase its contingency risk buffer over 6.5% recommended by the Jalan Committee? Thank you.
See again your second question and first question. I'll ask DG Rajeshwar Rao to come in, because there has been some engagement with the state government which he's better aware of. So he'll answer that.
I'll take
or
that.
Mr. Ravi Shankar, he will take care of your question. Coming to your second question, see, the Bimal Jalan committee has given 5.5% to 6.5% ratio of the balance sheet to be maintained as a buffer for us. We are at 6.5%, 31/3/2024. That is, the overall framework is being reviewed, and basis that if the committee feels that there is any change, could be upward, downward. I'm not suggesting that because of uncertainties it needs to be increased. I'm not suggesting that. That is under process, and basis that we will take a decision as per the recommendations of the committee which is reviewing this. For your first question, I request Mr. Ravi Shankar to answer it.
Thank you, sir. I'll start off with a clarification. The 5 lakh crore number you are referring to is probably the usage. That is, every time something is withdrawn, it's cumulatively added. So that doesn't give an idea of the limit. The limit has remained where it is quite consistent first half and second half, and that has been adequate so far. But depending on how government's cash position evolves, those limits will be fixed going forward for the first half and second half of the year. Transient liquidity, day-to-day liquidity, changes because of many reasons, but the larger changes there happen mainly because of government cash balances. So managing day-to-day liquidity is essentially managing the impact of government's expenditures and revenues and the resulting cash balances. That is a job that we do. That is a job that we will continue to do on a day-to-day basis. As far as how state government surplus affects central government's cash balance and therefore has an impact on liquidity in the system, this is something that we have always been sensitizing state governments whenever we interact them. As you would know, we are the debt managers for state governments as well. We discuss with them on ways to manage cash as efficiently as possible, but at the end of the day, their expenditure decisions are their decisions, and the resultant cash surplus is something we have a system under which it is currently managed. So, some of it comes into auction, treasury bills that are auctioned in the non-competitive section. Some of them go as ad hoc treasury bills. So that arrangement has worked fine, and we believe that as we go forward, state governments also will be able to manage their liquidity more efficiently. Thank you.
I may supplement over here that, this is our job. We are not looking, the state governments and the central governments should be, and many of them are, managing their liquidity efficiently. And whatever support, we can give to them, that we are providing. But we are not looking at liquidity being provided by government. No, they have to do their job. They have to manage their cash balances efficiently. And we, taking that into account, we will provide as much liquidity as is required. We are not looking at the government really, to be providing that liquidity. That is not their job. That is our job, and we will continue to do that job.
Just a clarification from my first answer. You said it's being reviewed. You don't know whether the CRB will be...
I think every 5 years or so.
I think the Jalan Committee recommendations were for the period till 30th June 24. 2019 to 2024. Internally, we are reviewing the whole thing and seeing whether any changes are warranted, etc. Then internally, we'll take it up appropriately through the process, and then if we need to engage with the government or the board, we will do it at a later point in time. But the internal review is on in the process.
So this is the entire economic capital framework which is being reviewed?
Yes.
Okay.
Thank you, sirs. I'd request Ms. Sangeeta Mehta from Economic Times.
Thank you, sir. Sir, given that rate cut will immediately bring down the home loans and all the loans that are linked to EBLR, that is given. How, in your assessment, when do you see the transmission of rate cut in deposit rates and lending rates, the MCLR and the other rates in the system? By when do you see that happening?
See, many of these deposit rates, etc., they are, those deposits which are already there, they are already fixed. New deposits that are going to come in, it is only, with respect to those that these changes will actually take effect. So obviously, many of them are 5-year deposits, so there will be no change, with respect to those people, who have already taken those deposits. So it will take some time, depending on, the tenor, the average tenor that the deposits already have. But it will be our effort, that we provide whatever support and liquidity is required, that this transmission happens as quickly as possible.
Not lending. MCLR?
MCLR, I think, happens, on a 6-monthly basis.
Yes.
So the last one, I suppose, most of the banks would be doing it in June and December to make it effective from January and July. So the MCLR, I think most of the banks, I think the policy is mostly to do it 6-monthly. And so come June, one should see some revisions.
Thank you, sir.
You want to add? Yeah, please.
No, I just wanted to,
please,
supplement on that. Essentially, the external benchmark linked rates are about 40% on the loan book, on which we will see more immediate impact. In respect of the book linked to MCLR, which is almost equivalent to the EBLR book, it typically takes about 2 quarters for the effect to play out, basis our past experience, because the reset periods are mostly 6 months, but there are also loans that are linked to 3 months or 1 year benchmarks as well. So typically our experience is that it takes about 2 quarters. And as Governor clarified, the existing deposits will have to be carried on the contracted rate. Only new deposits, the rates will change. So in terms of monetary policy transmission to the deposit rates, it again takes at least about 2 quarters. So that's a general trend that we have observed. Thank you, sir. Sir, with your permission, last 3 questions.
Yes.
Thank you, sir. Next, I'll request Mr. Ben from New Indian Express.
Thank you, Puneet. Thank you, Governor. My question is about the 1 trillion tax giveaways in the budget. If that really takes those who are benefiting from the tax exemption limits, if that really gets translated into consumption, what could be the impact on inflation that? Of course, the budget, from the fiscal point of view, budget is not expansionary, so that makes your job easier. But from a consumption point of view, of course, consumption is free. If those 1 crore or 50 lakh beneficiaries would be mostly from urban areas where the consumption has been lagging. So what could be the impact? Have you taken into account, or as some reports say that okay, the benefit is not 1 trillion, but it is at best it could be 25,000 crore. So it is not big enough to take into account the monetary policy, or you have looked at it and taken a call on the industry now?
All factors, as I said, have been considered by the Monetary Policy Committee in making its judgment. Obviously, the budget was announced, it was out in public, it was known, it was analyzed, and that was also taken into account in deciding about the repo rate cut. Overall, I think the budget is an excellent budget, both from growth perspective as well as I would say from the inflation perspective. especially as you also mentioned, given that the deficit has been curtailed at 4.4 and not even at the glide path rate of 4.5%. And I am especially very, very pleased to note that agriculture, you are all aware that 46%, about 46% of the CPI basket actually is comprised of food. Agriculture gets the prime focus, in this. Of course, it will help not only on growth, but in the medium to long term, it will also help us in controlling inflation. Especially like to drive your attention to the program on vegetables and fruits. Vegetables, please keep in mind, has a 6% contribution in the CPI. Fruits has a 2.9% contribution, 8.9%. There is a scheme, there is going to be a program for food and for fruits and vegetables specifically. I think the inflation pertaining to fruits and vegetables would certainly have, I'm not privy to what would have gone into their minds, but I feel that would certainly have played in their minds. Similarly, I am very happy to note that a mission on pulses again I think has a weight of about 2.5% or so, 2.4 I think, if I remember correctly. And pulses also has played a major role in the inflation that we have seen in the recent months. So there is a program there's a mission now which has been announced for pulses, and there are a number of other programs which have been announced for agriculture. I do not think that this 1 lakh crore of tax relief, I think it was very much desired. Everyone was wanting it. Now that it is there, now counter questions are being asked whether, it will increase inflation, this, that and all. I don't think, those questions are really apt. And I don't think, that this is going to have personally, an impact, an upward impact, in inflation. There is sufficient productive capacity that we have today also, the capacity utilization levels are 75%. And with this tax relief, it will only help us in our growth, and it should not have any major impact on inflation.
So can I have one clarification on the economic framework for Jaran committee? Jaran committee was an external committee where RBI had members. But this RBI is internally reviewing, or there is an external committee that is reviewing it?
Internal. It's an internal review. It's an internal review which was required to be done, which we will do because that is the time period, as DG Rajeshwar Rao mentioned, the time is over, so it was in for a due, so that will be internally.
Thank you.
Thank you, sir. Next we'll have Ms. Shyama from Doordarshan.
Hello, sir. Sir, my question is, does Trump's pro-crypto stance worry India? And if it does, then what will be the RBI's approach to it?
RBI's thinking on cryptocurrencies has been articulated very clearly, and there is no change in that thinking, because that thinking is based on what our understanding of crypto is, and our understanding of cryptos will not change because some policy has been taken by some country on it. So that remains unchanged. That is our stance. Having said that, as some of you may be aware, that there is a group which is looking at what the country's approach to cryptocurrencies will be, and that group will give its recommendations based on which decisions will be taken by the government, and we'll all follow that. Thank you.
Thank you, sir. And the last question would be for Mr. Sachin Kumar from Financial Express.
Good afternoon, Governor. After RBI hiked risk weights on unsecured loans in 2023, there has been a significant moderation in growth of personal loans. So, is RBI satisfied with the moderation in growth of personal loans, or more moderation is desired?
I think the short answer is yes, we are satisfied. I don't think more moderation perhaps is required, but I request one of the DGs, in case they would wish to, supplement.
I think that answer you have given already. Just to give a rationale behind it, it was an intended impact. Regulatory measures were taken when certain amount of outlier growth was seen in a few segments. As we had anticipated, it is the very same segments which are witnessing additional stress or slippages at this point in time and year related. So the measures were well thought out and it has had its intended impact. And as Governor clarified, this moderation is all right at this point in time. But as a regulator, we keep our watch on the incoming data. And if that warrants a measure, we will take it, taking into account materiality and proportionality. Otherwise, at this point in time, this moderation was expected and it's playing out on the same lines.
So is it correct to assume that now banks can resume higher lending on these segments?
It's primarily the business model that will be pursued by the business entities. It is not our intention to prescribe any particular rate of growth or a product mix. This varies from entity to entity, and there are well-informed boards that guide the management in terms of what should be their growth aspirations. All that what we see is that whether they are in tune with their risk appetite framework, whether any excess eating happening in the system, or any possible risk build-up is occurring or a concentration risk appearing in any particular area. That is where we would like to intervene. Otherwise, it is not our intention to prescribe any model. And just to use this opportunity to supplement to what Vishwanath as well asked. So every measure that there is an impact and cost analysis that we do, and we take decisions accordingly. So it is not that we will prescribe something which is not felt necessary.
Let me just supplement that see, we had not stopped, we had not prescribed or mandated or asked the banks or the regulated entities to stop lending. No. The risk weights, I believe, were prior to COVID, they were 125%. They were brought down post-COVID, and we saw, that there is now sufficient and perhaps more than the desirable level of credit growth. The risk weights were brought down to what they existed prior to COVID. So it's not as if, we have done something which is kind of abnormal. It is just bringing it back to what the risk weights were in normal times.
Sir, if I can ask a question in continuation to that. While I understand this 125 on unsecured is normalization, what about on NBFC, sir? Because there was a proactive increase in risk weight in order to sort of curb. NBFC is also concentrating in the sector. And today when we're talking about a growth-oriented approach, and they play a very important role in last mile credit dissemination, would you relook at risk weights on NBFCs? There as well, growth is really getting hurt.
No, maybe I can clarify, sir. See, essentially that particular segment was brought in because of the interconnectedness risk that was building up. See, NBFCs have essentially three types of resources: their own equity, their market borrowings, and then bank finance. Bank finance, which used to be about less than 30%, had gone almost close to 47% of their balance sheet as a resource. So, as I mentioned, we saw a concentration risk building up, resulting in an interconnectedness between two financial entities. So we brought certain additional risks so that gets moderated. Now if you look at it, the resources for NBFCs is more or less now distributed as 1/3 each. So again, it had certain purpose, which may not be, which is something which is holding good even today at this point in time. So I don't think there is a reason as to review any of these measures at this point in time. But as we clarified, that we'll keep watching the incoming data at any point in time. It's not our intention to stop any particular form of lending or business. It's our intention only to moderate, to ensure an orderly growth, keeping in mind financial stability.
Well, very important comments coming there. Apart from the policy, the big headline coming in is that the liquidity coverage ratio, or the LCR norms that were to kick in from the 1st of April will not be kicking in anytime soon. In fact, not until 31st March 2026. So FY27 is the earliest that we may have the revised LCR norms kicking in, which had proposed an additional 5% liquidity buffers to be maintained by banks to consider for the runoff effect because of the digital nature of banking in these days' time. So that is a huge relief coming in for financial entities, for banks. Apart from that, the governor also making it very clear that the expected credit loss guidelines, the draft for which is yet to come out, and the project financing norms, which again had proposed higher provisioning for infrastructure projects. The two are aligned, and again, FY27 is the earliest that the RBI may even look at that. But for now, the big overhang of LCR guidelines kicking in from the 1st of April, that completely goes away. So that is one of the big takeaways coming out of this press conference. The RBI governor making it very clear that they will give banks and financial entities ample time to transition when it comes to these big guidelines and big revisions in the framework. Apart from this, the very last answer again, making it clear that there's no rethink on the higher risk weights that were assigned for unsecured loans, whether that was for bank lending to NBFCs or for unsecured loans themselves. So no change there. Two big headlines coming in there. With that, let me invite our guests who are with us. Mr. Dinesh Kara, former chairman of State Bank of India. We also have Pranjal Bhandari, chief economist at HSBC, and Ashish Vaidya, the managing director and head of treasury and markets at DBS Bank India. Thank you very much to all of our guests for joining it. Mr. Dinesh Kara, first reaction from you on the LCR guidelines being deferred. How much of a relief is that, at least another year given to banks?
I think it's a very welcome move which has been announced by RBI Governor. And particularly, when it comes to LCR will actually warrant banks to invest into certain defined securities. So I think this kind of a headroom which has been given to not to implement it before 31st of March 26 will also give enough elbow room to banks to really ensure that they can orient their treasury investment policies accordingly, so that there should not be a shock at all. I think it's a very welcome move, and also in the current kind of a situation where the liquidity was at a system level, liquidity was a bit of a concern. So I think it will ensure that there is enough liquidity in the system, which will help in supporting the growth initiatives of the economy.
Mr. Kara, did you get the sense that there may be a rethink on this increased provision requirement itself, apart from deferring the deadline by another year? What was your reading of what the governor and the deputy governor said on LCR?
I think they have very clearly mentioned that they have invited the responses from the regulators, and they are actually evaluating all those responses. So I expect that it is going to be some kind of an inclusive policy which will keep in mind the responses of the regulated entities, and if at all it helps in achieving what the RBI is looking for in terms of achieving through implementing this LCR, if at all that can be achieved through some other means also, I think they are quite open for that. So this is very welcome, I would say, from the regulated entities standpoint. But yes, of course, they are having in mind the kind of changing realities, and also with the kind of digital coming into play and how the money can move in no time. So I think that's something which is the guiding factor when they are thought in terms of implementing LCR. So they will try to strike a balance between what is required for this kind of paradigm change which has happened over the years, and what ensure the stability of the system.
Mr. Kara, quickly before I move on to some of the other topics, the project financing guidelines, we of course know there's been a lot of pushback from the banks on this additional provisioning requirements for infrastructure projects. The indication again from the governor seems to be that they will be released along with the expected credit loss guidelines, where the draft has also not been formed yet. So you think that is out of the picture until ECL guidelines are drafted and consulted upon? Project finance, the additional requirements will no longer be, put on banks at least until FY27.
Yeah, because there are overlaps as it is between the provisioning which is done through the ECR and also ECL, and also with the project financing additional provisions which are required to be done. So I think they are trying to really ensure that there should not be any overlap and there should not be any excess of the provisioning which should be there, because eventually, all said and done, all these kind of provisions will have an impact on the credit cost and will eventually show up in terms of the cost of lending also for the banking system. So I think it's again, I think it's a very, very pragmatic step which has been taken, and I'm sure it will go a long way in terms of supporting the project finance initiative and the growth initiative.
Well, Pranjul, thank you all for standing by. Pranjul, what were your key takeaways, from the policy announcement? Were you at all disappointed to not hear more on liquidity? What did you make of the comments?
Yeah, I think, what stood out for me in the press conference was when he spoke about marks, do we attempt to get just pass marks or full marks? And I think in that context, I would actually give full marks to this governor, because at the end of the day, he's been able to tread this very fine line of bringing about more flexibility in existing frameworks in order to give you better growth outcomes, but not really junking all of these frameworks, working within the very frameworks. And I think that was really the master stroke. If you look at what's happening with monetary policy, he spoke about working on the flexibility embedded within the policy. So you don't really have to get to 4% inflation before you start cutting rates. But as long as your models show you that you're in the right track and you're getting to 4%, which his forecast did show eventually, you can start cutting rates already. So that flexibility, I think, will give very positive growth outcomes. And I think the similar thing we've seen for the regulatory front as well, right? He's not junking all the LCR and all of these norms that they were talking about, but he's trying to postpone them a little bit and also staggering their implementation, giving the markets better time to basically come to terms with all the big changes that are going to happen. So I would say on the whole, very positive. This is very important, because if at this point of time he had given a signal that he is not going to stick to previous old frameworks, then I would have said that people would start putting questions to the macro stability of his actions. But I think he's given us the best outcome.
All right. Ashish, Vaidya, you think this is the best outcome we could have got, deferring the LCR guidelines, saying that they will be, proactive when it comes to liquidity, giving some, as what we're hearing, more realistic sort of projections as far as growth is concerned at 6.7%, and delivering that 25 basis point rate cut that the markets had asked for. Ashish?
Yeah, I quite agree. Actually, this is probably the best possible outcome which the governor has actually delivered. It's really not important to look at today's market moves, because that will be actually driven by more of opportunistic position by traders. But I think a lot of decisiveness which the governor has already displayed before in the last 1 month while he took the liquidity measures, and the way he has gone about explaining as to what kind of forward-looking thinking and the nimbleness with which he is looking to operate within the parameters that have been defined for the RBI, I think is an excellent outcome. So I think we are really looking at it positively, and it will actually bring in a lot of stability and continuity in the market.
Okay, Mr. Soumya Kanti Ghosh, what was very interesting is the governor alluding to the flexibility provided by the inflation targeting framework, not repeating what we've been hearing through the year about getting to that 4% CPI mark before the Reserve Bank of India can act. So the RBI is going to be forward-looking. What do you make of his comments, and what we can expect, going forward from here in terms of further rate cuts?
Thank you, Ritu. I think there are a couple of paragraphs in the policy that are very well communicated to the market. I think this is the paragraph on inflation targeting which you are talking about. And I think this is basically a excellently and well-crafted communicative statement to the market, and it puts to rest about the market cacophony or the cacophony about not sticking to the current inflation targeting regime, tweaking it or otherwise, because it gives a sense to the market that the stability and continuity in macro policy, which has been the hallmark of the monetary policy in the last 3 to 4 years, remains in force. And that's why repeatedly you will see that in the press conference, the governor also pointed out his financial stability has an overarching aspect of this monetary policy. And that is possibly the reason why all these regulatory measures are now kept in abeyance, or they will be implemented as and when the time comes. So from that point of view, it's a sense of continuity, stability to the and flexibility to the policy, operating policy framework. And I think that a statement on inflation targeting, even on exchange rate, if you actually go through the footnote on the exchange rate, you will find that the 3.2% depreciation on exchange rate, which the governor talks about since the American election, that is almost synonymous with a 2.4% dollar appreciation. So what he's trying to say that the recent disturbance in the exchange rate is more a reflection of the market forces and the global uncertainty. So from that point of view, I think the policy is more about well communication and also importantly more about footnotes, which you need to go in detail to get into the nitty-gritty. And regarding the future trajectory that you have seen with inflation at 3.8% next year, growth at 6.7%, I think that opens up further space for rate cuts. And if the inflation continues to surprise on the downside, this month's inflation number could actually be a significant downside as the vegetable prices have corrected significantly. We can see more rate cuts in the offing, and that could be more than the consensus if the global geopolitical uncertainty stabilizes a bit in the next couple of months.
And what is that consensus, Mr. Soumya Kanti Ghosh? We've been getting differing views ranging from 50 basis point rate cuts to 75 to 100 basis point rate cuts in this cycle. What is your view?
No, I think if the global geopolitical uncertainty stabilizes, I think 50 basis point rate cuts, which was the mostly the consensus across the market domain, I think that could become an outlier in the coming days if we go by the inflation forecast.
Okay, and Pranjul, what is your base case in this cycle, given the 4.2% kind of an inflation outlook for the coming year?
Yeah, so look, we are expecting another 25 basis points rate cut in the April meeting, so making this a 50 basis points rate cutting cycle. And to the extent liquidity is sufficient, I think that on itself will also give us 25 basis points rate cut. So effectively a 75 basis point rate cut, if you also include what happens via liquidity. We don't think it's going to be more than this because at the end of the day, you really have to also look at global volatility. And I think our BOP and balance of payments, current account don't really support a very deep rate cutting cycle at this point of time. I also think there's going to be more liquidity measures that will be announced, in fact, as early as end April. So basically 2 weeks from now, because my sense is otherwise in March, liquidity will go back into, a substantial deficit. So my sense is that, more liquidity steps will also be announced. They won't announce today, but that doesn't mean they won't be announced because the promise of sufficient liquidity is there. And finally, many of the things and frameworks that are going into review, I think will be very interesting. I think the economic framework will be extremely interesting because over time, it will also tell us about how much dividends can the government get from the RBI.
Okay. Thank you very much. I just wanted to ask Ashish. Ashish, what did you understand about the liquidity? Did it give an impression that where they see a deficit they will give, or did you get a feeling that hence, because he said that we are looking at liquidity not just interbank but also durable, including the government's liquidity or what is with the government. Is it giving a sense that henceforth largely banks will be lending in SDF rather than borrowing? They will ensure that much surplus?
So Latha, good question. So let me give you my take as to what exactly I have understood. Clearly, I think he has drawn a distinction between durable liquidity and the transient liquidity. And that's actually very important. And if you look at his actions in the past, like last 1 month, I think RBI has come out very decisively in terms of giving liquidity to the market. I think broadly what he is really committing, and I think people will have to start to take him at real value. And that's where people will find clarity emerging as they go ahead. Not to look for immediate liquidity actions just because there's a policy or something. I think the way the RBI has conducted, very decisively, despite rupee weakening, the liquidity measures, both in terms of OMO, swap windows, I think that's great. I think markets, to my mind, should factor in about 60-70% of durable liquidity and about 30-40% of transient liquidity. Eventually, I would think that the liquidity will move towards a surplus, like the other panel members are saying, and which I completely agree. You probably get a rate cut next, and with probably a stance shift, and that really tilts the liquidity into a positive territory. So that's what broadly my understanding is. I think the governor and the RBI is completely in control and decisive in terms of how they're going to manage the liquidity.
Okay, fair enough. May I ask, therefore, Mr. Khara, so you think, therefore, that the rate cuts will get passed on? And secondly, he made a lot of reference to asking banks to lend in the interbank call market. The statement said that we are not restricting any such lending, because interbank call has hardly 15,000 crores. Sometimes the volume is very low, whereas in the tripartite repo it is in lakh crores. So is he removing any trepidation banks may have, borrow from repo and lend in call? Is removing that trepidation? Do you feel that way, that it was positive? So two questions. Do you think it will get passed on quickly? And will there be more flow in the money markets?
I think the intention of banks to participate more and more into the interbank call money market is essentially from that point of view that more and more flows should happen. And when it comes to the trap market and the call market, there is whatever differences are there in these two markets, they would get evened out. That is what the intention seems to be. And your second question relating to, the passing down the interest rate benefit reduction in repo. Repo, of course, is something which is one of the determinant, because when it comes to external benchmark linked interest, there, of course, it will get passed on. But if at all external benchmark was essentially linked to repo, then only it will get passed on immediately. Otherwise, if at all it is linked to MCLR, etc., then...
No, Mr. Khara...
Yeah, sorry.
No, Mr. Khara, he is also promising liquidity. And therefore, my question is a little medium term. Do you therefore expect that this craze for deposits, the banking competition for deposits will slow down a bit, because Reserve Bank is committing to giving more liquidity? And therefore, if not like in 1 month, in a couple of months, deposit rates will start falling?
See, actually, when you look at the banking business, they look at RBI as not at the first port of call when it comes to the deposit or the liquidity. They actually look at the bank RBI as perhaps the last port of call for augmenting their liquidity. They need to have the deposit base. Unless and until they have a stable deposit base, they cannot really plan out their loan strategies, etc., etc. So I think when it comes to deposit, eventually, the interest rate on the deposit will eventually be the function of the overall liquidity, which is stable liquidity in the system. It will not be the transient liquidity, as it has been mentioned. So durable liquidity only will influence the interest rate. That is what my take is.
Okay. No, the reason why I'm asking you is, a lot of bankers in our Ritu's and mine preparation to the monetary policy, bankers were saying that, if they tell us, give us some comfort that, okay, now we are happy with the credit deposit ratio, then we can start chasing credit. If they give us some comfort that liquidity will be there and that we are not constantly going to them to borrow, then we will have greater confidence in cutting deposit rates. This is what bankers told us in the run-up to the monetary policy, and he seems to have given both. They seem to give confidence that, okay, now the credit deposit ratio is fine. And they seem to give confidence that we will proactively give liquidity. That was the word they used. So I'm asking, will credit growth improve?
I think credit growth will improve depending upon the opportunities which are available for lending in the market. And lending in the economy, if at all there is an overall economic growth, there would be certainly, banks would be happy to lend and also generate income. That is what I would say that all bankers will think like.
Ritu?
Well, there's one more thing I wanted to highlight, Mr. Khara, was, the very last question on the higher risk weights on unsecured loans. Clearly, the indication is, yes, the RBI is satisfied with the pace of, growth in unsecured segment coming down drastically from 2 years ago. But it doesn't look like there is a rethink on, reverting back to the risk weights that were before they were increased. Mr. Khara, is that the expectation, these higher risk weights, especially for bank lending to NBFCs, are to continue, so there's no relief on that front?
Now, I think considering the fact that the kind of delinquencies which are seen in the unsecured portfolio of the various banks, but I don't expect that there would be any kind of a relaxation when it comes to the RWA for the unsecured loans.
Very much the messaging from the Reserve Bank of India as well. Quickly, Latha, you had another question to add.
Well, not question as much as a takeaway which we got, because the governor also spoke to us off the press conference, off the auditorium. So before we wind up, I just wanted to say that the first or the second paragraph, I think, where he speaks about flexible inflation targeting, I think that was an important point he made. The question was, why are you taking it up at all? There were statements, if you remember, in the previous economic survey, where the request was that food should be excluded from the target. So it appears that that statement was there to commend the flexible inflation targeting, to say it has worked well, because it's about 10 years, 9 years to be precise, and they wanted to praise the flexible inflation targeting framework. So I think that's very important. The framework is not in question. That was a key takeaway we got off the auditorium when the question was asked to him, why did you raise it at all? And he said, I raised it to commend what is a framework that has worked very well through COVID and through turbulent times. I thought that that's an additional information that was needed. Thank you very much, Mr. Khara, Pranjul, Ashish, and Shaumyu for being with us. Thank you, Ritu, as well, for going through this monetary policy framework, monetary policy analysis. It looks like it's an extremely well-balanced policy, giving inflation coming down its due share and at the same time retaining most of the caution that is merited because of the uncertain global environment. Thank you very much for watching our Monetary Policy Special.
Hello and welcome to Midcap Radar. We welcome you with M&M's Q3 numbers. The company's top line has seen a growth of about 18%. This is driven by a 20% jump in the company's auto business. The EBITDA has come largely in line with street expectations. EBITDA number at about 4,400 crore rupees, and profits too have gone up by 20.8%. These are very slightly lower than street expectations, at least on the bottom line. On the bottom line, the CNBC TV18 poll was for a growth of about 29%. Compared to that, the company's delivered about a 20-21% bottom line growth. But again, these are very strong numbers and the stock is holding up in the green. Margins in line at 14.4%. So top line growth 18%. Margins at 14.4%, and this is an expansion versus the 12.8% clocked in the comparable quarter of last year. So margins for the company are up 160 basis points, and that is driving a 21% increase in the company's profitability. Revenues in line, margins in line. Profits too are very healthy at 21%, but again, you would say maybe slightly lower than street expectations. M&M has been one of the best performing stocks. I think last year it was up close to about 80-85%, and in 3 years, the stock has given a return of close to about 250% because their SUV portfolio has been doing very well. Tractors, they've always been the dominant player, and that has been driving growth. So the volumes for the company have been very strong. I think in Q3, Sudarshan was telling us that volume growth was 16% in auto and about 20% in tractor. These are the internals. We've got the auto business numbers up 20% growth on a year-on-year basis. So, at least these are the few internals that we have right now. Auto business EBITDA seems to have seen an expansion because the top line growth is 20%. EBIT growth is close to about 37%.
Absolutely interesting numbers surely coming in, and there are going to be a lot of factors that one should watch out for in terms of commentary also, right? Like you were mentioning, volume 17% is what Sudarshan has highlighted. So keep an eye out on that. We'll also want to watch out for the ramp up that one could see coming in from the XUV 400. So what is that? Strong volumes is surely something that we're seeing coming in from the company. Auto segment, the EBIT that we're seeing is good. Agri-business EBIT is at 42% up YOY, 30% uptick on a quarter-on-quarter basis. The stock is seeing some bit of a gain and momentum coming in, and auto business EBIT also is at 9.7% versus 8.5%. So we're seeing an improvement even coming in on the EBIT front of individual segments as well. So yes, largely when we're seeing in terms of estimates, margin has met the estimates of the street, revenue is in line with the street estimates as well, and overall versus the poll, even the EBIT performance has been good. Interesting to watch out for in terms of that front.
The stock is now moving up. Yes. It was up 0.5% when the numbers came out. It dipped a tad bit, but now again it's up close to about 1.5%. That's M&M for you. Pull up a 3-year chart of M&M or 2-year chart, and you would see the kind of outperformance M&M has clocked in vis-a-vis peers because its portfolio is doing very well. You know, the XUV 500, 700 has been sold out. There's a very, very long waiting period. Tractors, it's Tractors has also had a pretty good run given the monsoons have been normal. So M&M has been on the front foot, 85% up in the last 1 year, 250% in the last 3 years. And if you look at a 5-year CAGR on M&M stock price, it's given a return of 40%. So true wealth creator in the large cap space. Gurmeet Chadha, managing partner, CIO at Complete Circle, is now with us to discuss the numbers. Gurmeet, your initial thoughts on M&M?
Hello.
Yes, Gurmeet, we can hear you. Did you have a chance to go through M&M's at least?
Yeah. So, I think a good set of numbers. I think if you see revenue, they've crossed 30,000 crore mark. EBITDA is, I think, in my view, again, an all-time high at almost inching in at about 4,500 odd crores. And there is a bit of a margin expansion. I think what is, good here is the fact that they've been focusing on, they've regained their market share in SUVs. It's back at about 20%. I think the new EV launch has happened. They've started the bookings. The response has been pretty good. I have a few clients who are very large dealers of M&M in North. I think there's a lot of excitement there. Tractors, they are gaining market share. And the best thing has been since Anish came over Yeah. Hello? Yeah.
Yes, we can hear you.
Anish came in. I think the focus on capital allocation has been pretty solid. They have cut down on loss making. JVs they had clear allocation towards how business is to be done. There was one bit of a blip when they bought some stake in RBL Bank, which Street did not like. But I think that clarification came that it was just an investment and they had no plans as such. So I think pretty constructive, and valuations I would say are modest, would not say reasonable. But I think the new EV and an uptick in rural demand could still give some legs to M&M.
Okay, so, Gurmeet, do wait on with us. We do have Sudarshan who's joining in with us, who's done some number crunching in terms of the M&M's Q3 performance. Sudarshan, what are they looking like versus the CNBC TV 18 poll? Any more highlights that you could shine on these numbers?
From the first look, it's looking a very strong set of earnings. Even expectations were elevated. Company has managed to meet estimates on all the fronts, whether you take auto segment or farm segment. So overall revenue was 30,500 crore against our expectation of 30,600 crore odd. So it's almost in line. EBITDA has come in at almost 4,400 crore. Again, in line with estimate. Margin company has managed to hold on to the levels above 14%. It has come in around 14.5%. That is also almost in line. If you talk about the segments, for auto business, revenue has increased 20% year-on-year, and even sequentially, if you look at, it's up 6%, and even EBIT is up 37% year-on-year and 8% sequentially. Agri-business, again, 21%, YOY, 26% sequentially. EBIT for agribusiness 42% up YOY and 30% sequentially. So it's telling you, as in morning we were talking about the two segments, basically SUV and tractor. Demand has been strong for both these SUV and tractor, and the leader is M&M. So led by healthy volumes, company has managed to report a very strong set of numbers for Q3. But we have to see exactly what does company say on the demand front, if the demand is sustainable, and how is the demand going on in current quarter, and how the demand has been for the recently launched electric vehicles. So these two, and last is the considering the demand for tractor segment, if there is a pickup or if there is an increase in FY25 growth estimates, because currently it has been like mid-single digit growth. So if we'll have to see if M&M says that there is an uptick expected as well. So considering all these things, first, Q3, very strong set of numbers, but all eyes would be on company's commentary related to demand.
I remember earlier this month only, right, Sudarshan, they had launched those two, native electric, purely electric born vehicles. I think it was 6BE, something on those lines.
6BEV.
6BEV, yeah. And there was so much excitement around the stock price, on the prospects and what it will do. And it was also fairly competitively priced versus peers. So have they given any indication of the bookings for that?
So I'm yet to see exactly what the company has commented about bookings, but both those products were feature-rich products. And one advantage that all the brokerages were talking about, those two products are not only feature-rich, but the pricing part was very important, and company has managed to announce the price, and basically prices were very attractive. So considering these two factors, and I feel the demand obviously would have been strong.
Okay, thank you very much for that. The key positive is that growth continues for M&M, 18% top line growth, and both the auto business and the tractor, the farm equipment business is doing well, and there is margin expansion. Margins for the company have expanded from 12.8 to 14.4% on a year-on-year basis. That's a 160 basis point margin expansion, and that is something that the street likes. I think the question now is, because of the run-up, how do the valuations stack up?
Absolutely. Let's go across to Gurmeet on that front as well. And Gurmeet, like Rima was saying, how is it going to be in terms of valuation? M&M numbers have been good. Commentary is what everyone is watching out for. But on the valuation front, does it make a good bet right now?
I think it should be more like something which is very consistent in the large cap space. It's not stretched, it's not cheap. It's 25, 30 times, and this is one auto stock which hasn't really corrected, along with Maruti. Actually has done well in the crisis. See, other thing is, if you look at its powertrain a few years back, pre-COVID, it was 72% diesel. Right now, if you look at it now, the diesel is almost 50-55%. There is EV which they are launching. There is CNG which they have included. So even the powertrain now is catering to different segments, which I think augurs well. Depending on how the landscape is changing as far as clean energy goes. And I think this new EV launch, as I said, few of the distributors who are clients went for the launch in Chennai in their R&D center and had some great feedback on that. So I think they've just started the bookings. I think immediate trigger could be how strong the bookings are. Remember when they did this all 4 SUVs back to back, which is XUV 700, Bolero. If the bookings pick up, there could be some, although I'm not commenting on near-term movement, but there could be a bit of momentum in the near term because of that.
Okay, Gurmeet, thank you so much for joining in with us and giving us insights in terms of M&M's number, what we should be expecting in terms of the stock going forward as well. But key is going to be the commentary that we're keeping an eye out on. As of now, M&M is trading almost near the day's highest point, so keep an eye out on that. Let's move on, and the battle for control over Religare continues. Supreme Court of India directs the Berman family's open offer will not close today as scheduled earlier. Ashmit is joining in with us to give us more details on this one. Ashmit, what is the latest update that you have here?
Well, clearly the confusion as far as control of Religare continues. The open offer that had been issued by the Bermans was expected to close today, which was expected to give some finality to the matter. But bear in mind that the US-based, the Florida-based businessman, the investor Digvijay Gaikwad, had moved the apex court. That hearing was today. It just concluded a few moments back. And importantly, in that hearing, the Gaikwad had essentially said that why are we asking the minority shareholders to settle for 235 rupees a share when I, Gaikwad, am offering 275 rupees a share. From therein, there were questions on technicality, and on the basis of that, essentially what the Supreme Court has directed as an interim direction is that, number one, the Berman open offer will not close today as was scheduled. The tendering process was expected to close today. That will not happen. Number two, the Supreme Court has directed for Gaikwad to deposit an earnest money deposit of 600 crore rupees by February 12th. That's Tuesday of next week. So they have time till Tuesday to make that earnest money deposit of 600 crore rupees. Third, and this is critical, the open offer that was issued by Bermans will remain open till the earnest money deadline of Tuesday next week, which is February 12th. Till Gaikwad makes that deposit on February 12th, this open offer will continue to remain open. The tender process will continue to remain open. And what happens in a situation that Gaikwad coughs up that amount of 600 crore rupees? In that case, the Supreme Court has added a fresh stipulation that this Berman open offer will remain open till SEBI takes a final decision on the Gaikwad application for an open offer. So clearly, there are a number of moving parts here. No finality yet, but for now, the Berman offer to remain open. But at the same time, the Supreme Court did make an observation that this open offer, they're doing it at their own risk, the Bermans, because should the issue get decided in favor of Gaikwad's, the words of the Supreme Court were, they'll have to cough up a lot of money.
Okay, Ashmit, thank you so much for giving us the latest update on Religare. But let's just mark the flashes at the bottom of your screen. We have Ola Electric that has reported the numbers. Revenue seeing a decline of 19%. Losses have widened further for the company. EBITDA loss at 460 crore versus last year of 301 crore. Losses also are somewhere at 564 crores versus 376 crores. So clearly we are seeing that losses are widening. There's a bit more pressure coming in, and revenues also are seeing a decline. Stock has slipped in trade and is down almost 2% as of now.
I was just going through the Ola numbers. In Q1, the company's top line was 1644 crore. Yeah. In Q2, it came down to 1214 crore. So even in Q2, there was a sequential decline in the company's revenues, and that has further come down to 1045 crore. So we've seen a significant moderation in the absolute revenue number. 1644 in Q1 comes down to 1214 crore in Q2, and now down to 1045 in Q3. The Ola Electric stock price too has taken, a bit of a tumble. Right now it's down close to about 2.5%, but its 52-week high was close to 157 that it hit on the 20th of August. So from that level, 157 down to 70, the stock has more than halved in the last, 5-6 months. And the numbers are a bit disappointing. I remember even Q2 was a disappointing quarter, but losses have widened for the company, and the absolute bottom line loss is 564. And remember, shareholders, investors are going to have another option to play the pure electric two-wheeler space, because Ather Energy has also filed its DRHP and it's readying its plans for an IPO. So, you're going to get another choice, right?
Option
if you want to play for the entire EV penetration, you want to play that story, now you have an option there too.
Absolutely, but as of now, we're seeing pressure coming in on the stock. Numbers not looking that great. On that note, we're going to slip into a very short break, but don't go anywhere. After the break, we have more numbers to talk about. Aadhar Housing Finance, they've reported their numbers. What are the outlook of the company going forward? We do have the management waiting back.
policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. This growth inflation dynamics opens up policy space for the MPC to support growth, while remaining focused on aligning inflation with the target. At the same time,
ourselves in line to the customer expansions.
Right. Good afternoon, gentlemen. This is Vinny joining in the conversation as well. Mr. Chabra, just to follow up, is that then when will they start normalizing the 12 to 13% range, which you all had in terms of margins? If your plant setup is going to get completed by the second half of FY26, post that, could we see those margins starting to see that improvement back?
Yeah. So, see, as an organization, we focus on ROAS. That's how we measure the overall financial health of the business. And we have a guidance that we should be delivering a ROAS of more than 40%. And that is what we have been delivering in the last 2 years. And even in the current year, if we get the orders for the Q4 as in line with the customer forecast, we should be able to deliver more than 40% growth. And as far as EBITDA margins are concerned, as and when these plants get into ramp-up mode, the ramp-up mode is over and the production starts, the EBITDA margin should also get better.
Okay. Anurag, what I also want to understand is that what some data points are suggesting that in Q3 seems like the EV contribution has seen a bit of a reduction. Is that a fact? And if yes, how much has it seen a reduction by?
Yes, if you are seeing that there is a reduction in EV or the electric vehicle, that is correct, and we are seeing that bit also in our revenues as well. But you have to understand that this year it's remained to be very exciting for the automotive sector because OEMs has launched many new models across EV as well as ICE, and keeping a lot of it's a heavy feature, rich feature content vehicles. So when these launches are happening, and as you have seen in our press release also, that in this quarter and the next 2 to 3 quarters in the new plants, there are both ICE and EV both. So I think it's just a matter of time. We have to see how the consumer is going to react to the new launches. And we are very hopeful because we don't never doubted our customer, and whatever they are putting the volumes to us. So I think it's going to take some time, but you will see a very positive results in coming times.
Mr. Chhabra, the 3 greenfield plants that you spoke about, which are at different stages of completion, I believe have a revenue potential of 2,100 crore rupees. Is that right?
Yeah, that's right. So when these plants reach at their optimum level in terms of their production, and if the orders are in line with what the forecast we have received from the customers, on an annualized basis, these 3 new greenfields should give us 2,100 crores turnover.
So realistically, how much of that can come in FY26 to your mind?
So it depends on the time when these get actually ramped up. So by H2 26, we expect this to kind of get at those levels, depending on the customer orders.
Okay. So is it okay to estimate that at least 50% of the potential, we're talking about 1,000 crore of incremental revenues in FY26 because of these greenfield?
Well, if other things remaining the same, yes.
Okay. Mr. Chhabra, I just wanted to understand one thing. Right now, I'm looking at the growth rate over this year, right, in FY25. For the first quarter, it was 17%, moving on to second quarter, 10%, and now the growth rate has been around 8-9%. I just want to understand, we've seen a bit of the growth rate slowing down. What is the outlook in terms of the growth that one should watch out for? Any growth guidance or number that you would give for Q4 as well as for FY26?
Yeah, sure. So as far as growth is concerned, I mean, the growth is a factor of a couple of factors. It's a matter of a couple of factors. So for example, the product mix that is there and the content in the wiring harness. So today we know that customers are preferring feature-rich models, and those feature-rich models have a high amount of content and more revenue for us. So a lot would depend on the product mix that is there, that gets sold to the consumers. And if we look at, we have been ahead of the industry. So if we look at Q3, we are 9%. We have 9% growth, whereas the PV industry grew by 3%. So we outpaced the market by 6%. Likewise, if we look at 9 months, we have grown by 12%, whereas the PV industry has again grown by 3%.
So 9-month revenue growth is about 12%. And will you, based on the early indications, Anurag, do you think you can end the year with about this 12-13% top line growth?
I think it's all subject to the volumes what the customer has forecasted. We are very positive. The way we are going in 9 months, it's already 13%. So we have to see, as Mahindra has suggested, that what sort of consumer are buying the models. So the higher the model, the higher the content, and the sales value for MSL goes high.
Okay, and just the last one, I just want to understand raw material trends and the raw material prices. They have been quite stable, right? Anurag, is there any change and any concern on that front?
I think, yeah, raw material costs are, you have seen there is not a very big change, or there is no abnormality into that.
Thank you, Mr. Chhabra and Mr. Gehlot, for joining in, and wish you all the very best. Look, enjoyed chatting with you today. We'll slip into a very short break on that note. We'll come back with more on the market. It's in the red now for all the benchmark indices. The Nifty is closer to 23,500, down 80 points. Sensex down 360.
The MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. The MPC also decided unanimously again to continue with a neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. The MPC also decided unanimously again to continue with a neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. The MPC also decided unanimously again to continue with a neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. The MPC also decided unanimously again to continue with a neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. The MPC also decided unanimously again to continue with a neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The MPC decided unanimously to reduce.
Welcome back and thanks for staying tuned in to CNBC TV 18. You're watching Midcap Radar. Quickly, let's just look at Alkem Labs. They reported their numbers a short while ago. Doesn't seem like a great set of numbers that has come in from the company. For the quarter gone by, the growth has just been of 1.5%. Domestic sales have seen a growth of around 5.9%, 6% approximately. And international sales, they have seen a decline this time of 6.2%. Margins, yes, some bit of an expansion that they're seeing coming in terms of margins. But overall, the sales growth hasn't been that good, and expectation was much higher in terms of the domestic formulation growth as well as the international business growth for the company. So obviously it's important to watch out for what is going to be the outlook of the company. As of now, concerns are coming in terms of the growth factor. Alkem Labs, that's as of now, is trading at the day's lowest point. That's a weak set of numbers from Alkem Labs. You have Century Ply also that has reported their numbers just now. Net profit is seeing a decline of 7.3%. Keep an eye out on Century Ply. Revenue seen a growth of 22%, and Century as of now is of the day's highest point. We'll wait out for more internals coming in for Century Ply. But let's move on and talk about NCC, because that's a stock that's in focus as well on the back of its numbers. They reported a weak set of Q3 FY25 numbers. So Darshan is joining with us to give us those details.
So NCC has reported a weak set of earnings. It has missed EBITDA estimates by almost 10%. Margin has missed estimates by more than 100 basis points. But more than weak earnings, what has caught the attention is cut in FY25 guidance. Now, FY25 revenue growth now seen at 5% versus earlier guidance of 15%. And margin is seen at 9.25% versus guidance of 9.5 to 10%. Also on debt level, gross debt has seen a sharp increase. As of December 2024, gross debt was rupees 2,400 crore versus 1,700 crore that company had reported as of September 2024, and it's because of the delay in one of the payments related to JJM. And after this, JM Fin has come out with a note. It maintains buy call but has cut target to rupees 330. Also, it has cut FY25, 26, 27 EPS estimates by somewhere in the range of 12 to 27%. So weak earnings and guidance cut, and because of that, you are seeing a big fall in NCC.
Absolutely, a 12% fall as of now for NCC. Now let's move on, and it's actually time for Growth Code, which is a special initiative by Grow and CNBC TV 18, designed to provide you with valuable insights and strategies to navigate the market and make informed trading decisions. Today, we'll unpack the risk of speculative trading and the lessons learned in the aftermath of the infamous 2001 Ketan Parekh scam.
Speculative trading creates artificial demand and can inflate prices, often resulting in market bubbles. But one small prick and the entire illusion vanishes in an instant. Speculation is the reason 90% intraday traders end up with net losses.
Speculative trading dominates the market despite its risk is because of the lure of quick gains, lack of common sense, and there's obviously a lot of greed as well. Time after time, we have seen this cycle repeating. Right now, the money at stake is far higher and is of great concern at the moment.
The 2001 Ketan Parekh scam exposed the perils of unchecked speculation. Fueled by insider information and excessive leverage, Parekh manipulated stock prices to siphon off over 40,000 crore.
One of the biggest things that happened in Ketan Parekh scam was a kind of a narrative that got built. The hype was built so much that it ended up brainwashing the retail investors and traders. The biggest problem here was that while they were investing, the pump and dump scheme was happening simultaneously.
The crisis forced a reckoning, with the market regulator implementing sweeping reforms. Circular trading was abolished. A central fraud registry was created and stock options were introduced for the first time.
The scam definitely highlighted the risk of speculative trading and thereafter shifted the investors' focus to relatively safer and established companies. Investors became far more aware of the risks in speculative trading and the pump and dump schemes. Though the markets post-2020 also need similar kind of awareness.
While the scam helped correct systemic issues, traders also learnt about the risks of speculative trading. Learnings from the Ketan Parekh scam helped India build a stronger, more resilient market.
Policy rate by 25 basis points from 6.5% to 6.25%. The MPC also decided unanimously again to continue with a neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. The MPC also decided unanimously again to continue with a neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. The MPC also decided unanimously again to continue with a neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. The MPC also decided unanimously again to continue with a neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. The MPC also decided unanimously again to continue with a neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The MPC decided unanimously to reduce the policy rate by 25 basis points.
Mover today, and that's because their Q3 numbers were actually pretty good. Now, if you go by just the pure numbers, on the P&L, they're not strictly comparable because now Indus Stars is a subsidiary of Bharti Airtel, and there was a line-by-line consolidation. So numbers are not strictly comparable, but let me run you through some of the key pointers in the numbers. One, the average revenue per user. That's basically your monthly bill. It's the amount a customer pays per month. And that has been steadily inching up. 5.1% quarter-on-quarter, 18% on a year-on-year basis. It stands at 245 rupees, very close to Sunil Bharti Mittal's aspiration that this number needs to hit 300 rupees for the industry to be sustainable. So it's at 245, and there's been a steady progression in that number. Secondly, the number of customers. We call them subscribers. Now, subscribers declined in Q2 because of the tariff hike. It was a sudden increase of 15-16%. Some customers fell off the network. But this quarter, subscribers have bounced back up 5 million on a sequential basis. That's positive.
So that's an important point coming in, especially for these
Exactly.
companies.
So despite the tariff hike, subscribers on a 2-quarter basis are higher. Thirdly, it's better than its peers. So the India mobile business, because Bharti has Africa, it has homes, enterprises, many businesses, but purely the mobile business for Bharti Airtel has done better than Reliance Jio. in terms of revenues, 5.8%. And fourthly, and the more important one, that the tariff hikes by the industry took place in July. So effectively, Q2 and Q3, both of them had the benefit of tariff hikes. Why even Q3? Because sometimes you have a 3-month plan, you have a 6-month plan, you have a 12-month. So that pass-through takes time. But in Q2 and Q3, the company's revenues went up 17%, which basically means that the full tariff hike has been absorbed. It's not that because of the tariff hike, they lost some customers, there was down trading, they moved to lower price. That pass-through full benefit of the tariff hike has largely taken place, and that also is a positive.
Absolutely, that's why Bharti Airtel is managing to hold on to good gains of 3 to 4% in trade. But let's move on. And LIC also is something that we're keeping an eye out on. They're set to report their Q3 numbers today. Yash is joining in with us to tell us what are we expecting this time from LIC. Yash?
Yes. Well, as far as the stock is concerned, it's corrected significantly. It's about 32% off its 52-week high. The numbers expected for the third quarter are on the weaker side. As far as new business premium is expected, that is expected to see a decline of about 23%, coming in at about 42,406 crore rupees. Total APE, that is expected to see a decline of about 18% at about 10,789 crore rupees. Retail APE is expected to decline by about 18%. Again, it's about 7247 crore rupees. Importantly, value of new business, that is expected to see a decline of 30%. At about 1836 crore rupees. Margins expected to see a contraction of about 298 to about 300 basis points. Expected at about 17.02% versus 20% on a year-on-year basis. It becomes particularly important because if the numbers do come on the weaker side, then the management's guidance for FY25, that will be questioned, and it will be very important to see if they plan to stick to that guidance of AP guidance of 15%, VNB guidance of 18%, and margin guidance of 19 to 20%. Or is there any change that comes through as far as FY25 guidance is concerned? Apart from the guidance, what will be important to see the increase in non-par share of the business, any movement in management's plan to acquire a health insurance company, and finally, the impact of surrender value regulations on their VNB margins.
Thank you, Yash, for that. By the way, markets have slipped. We've given up 23,500. The Nifty is down to 23,450. Yes, we did get that 25 basis points rate cut, but that perhaps was so widely anticipated that it's not had any impact on the markets. The Nifty Bank is now down a full percentage point. We're going to take your leave on this show. Thank you for watching. Don't go anywhere. Last 1 hour of the week coming up with our closing bell anchors.
From 6.5% to 6.25%. The MPC also decided unanimously again to continue with a neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. The MPC also decided unanimously again to continue with a neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. The MPC also decided unanimously again to continue with a neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. The MPC also decided unanimously again to continue with a neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. The MPC also decided unanimously again to continue with a neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. The MPC also decided unanimously again to continue with a neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. The MPC also decided unanimously again to continue with a neutral stance and remain unambiguously focused.
Welcome to India's #1 budget headquarters. Decoding key policies, delivering market-shaping insights, and unlocking the potential of India's growth blueprint. Beaming live from the CNBC TV 18 Motilal Oswal Budget Headquarters.
The Hang Seng trading with gains of just around 0.4%. The Taiwanese index, after the outperformance through the week, is now trading at the flat line.
Late last afternoon, she had moved the Delhi High Court. The Delhi High Court, however, had rejected her application.
You know, a 25 basis point cut is in the price. Markets are absolutely expecting it. Nifty 23,652. We've got the Sensex, which is starting at 78,240.
Then Japan looked more interesting, and also China is looking more interesting at this point in time.
Unanimously to reduce the policy rate by 25 basis points.
Nifty is marginally in the green after ending marginally in the red in yesterday's trading session.
Keep liquidity surplus in the interbank system or just adequate?
The endeavor of Reserve Bank to provide as much liquidity as is required.
Hello and welcome to a fresh edition of Closing Bell. We are down to the last hour for the day, that's today, and of course for the week, and it's turning out to be a bit of a disappointing hour for the bulls, you'd have to say. Though the RBI has delivered along expected lines, we've got that 25 basis points rate cut, but I guess, Nigel, for the bulls, it was ye dil mange more, and they didn't quite get it, so some disappointment playing out today.
Well, that's right, and I think we got a couple of other big cues, right? This evening you'll have the jobs report, and this one's going to be important to understand what's the trajectory with regard to the Fed. And the other big cue is over the weekend, and the street was believing that the BJP is going to do much better, which should be the case, but can they come out trumps is going to be important. So I think two big cues is what we're looking forward to, so maybe some bit of jitters ahead of that.
Absolutely, I take that point, but the markets completely looked through even some of the other positives that came in from the RBI policy. Yeah. Let's pull up the Nifty and the Bank Nifty. Nifty is down about 0.6%. Bank Nifty is actually falling far more. It's down about 1%. And we're not too far off from the lowest levels of the day on these indices. So that's another sort of factor of disappointment. Will there be some reversal, some recovery by the end? Let's see, we have an hour to go. Why I'm saying the markets refuse to look through any positives is that there were some positives. The RBI governor promising, number one, the fact that this was a unanimous decision. It was, a uniform call by all members of the MPC. The stance has remained neutral. Maybe some will argue that the market would have wanted to see a change in stance to more accommodative. But there was commentary on providing adequate liquidity to the market as and when it was needed, but the market has ignored that. And for banks specifically, something that the banks have not cheered is the fact that the governor has very clearly stated that any change in regulation with respect to those ECL norms, expected credit loss, or even the LCR norms, or even the new sort of norms on project financing, all of that is getting pushed. There will be more consultation around it. So nothing is getting implemented starting the 1st of April. But clearly it's not been enough. And we're seeing the market down and out at this point in time. So the banks are down for sure. But it's not only the banks. Let's look at some of the other names as well. So Nifty losers, maybe we should just pull up the whole list of Nifty losers out there. Big stocks like ITC, SBI, TCS, ICICI Bank, a lot of your big heavyweights, Reliance, Infosys, L&T. So while it's easy to blame the banks, the fact is that you can't, only blame the banks because none of the other big boys are standing up. They're not getting counted at all. So there's a lot of downside pressure coming through. ONGC is the biggest loser on the index right now. The counterweights are actually, there we go. That's the contribution chart. So that's telling you it's not only banks which are on the negative side of that list. The counterweights are coming in the form of Bharti Airtel, obviously because of the good numbers. Trent is seeing a bit of a relief rally. And then there are some global-facing stocks, metals in particular, that are doing pretty well this afternoon. So names like Tata Steel, Hindalco, they're holding up, as are global markets. But yeah, it's been disappointing for the bulls.
Indeed. Well, let's get in Mitesh Thakkar. Mitesh, what are you making of today's action? Would you hold on to that positive stance or is it breaking down? And also give us a couple of picks.
Yeah. Good afternoon, Ajay. So, I've been advocating that some kind of positive buy should be maintained on the index. And also mentioned that in case there's volatility with the event coming up, we could even see Nifty, hit and test 23,400 odd levels, close to that. Now, there was this gap which happened on Tuesday, with that positive announcement, which is between levels of 23,380 to about 23,420. That's the support pivot which I was talking about. And if that gap is not filled, then I think we should again bounce back. Maybe it will take a few more days, but we should again try and test to 23,800. So I think this is a level which should be the final threshold, 23,400, 380 zones. And as long as that doesn't break, I think, I will maintain a positive bias. The levels of the Bank Nifty are slightly lower because the Bank Nifty gap is at about 49,400, which is roughly about 500 points lower from here. So therefore, focusing on the Nifty as an index.
Okay, all right. What about individual stocks?
On the stock side, again, I have one buy and one sell call. On the sell side is Atul Limited, continuously making newer lows. Sell here with a stop at 61.30. Look for a target of roughly around 59.50 to begin with, and maybe even lower levels. This is one stock which has been underperforming, as well as the chart structure remains slightly on the weaker side. And on the buying area is Bharti. It's come off the day's high, but the structure is much better over here. So Bharti can be bought with a stop at 1657 for targets of 1700, and then above close above 1700 would be even better.
Okay, all right, got that. Thanks very much, Mitesh. We'll come back to you for some more trades and some ideas in a bit. Let's now also welcome in Dilip Bhatt into the conversation. Dilip, great to have you on. Speaking after a while, good to have you on Closing Bell. So let's get your stance on banks and financials straight away. I mean, the market's clearly disappointed, but I don't know if it was that bad a policy. Your thoughts and what would you do with financial stocks? Any buys?
Good afternoon, Surbhi. I think as far as the financials and the banks go, I think we still remain pretty neutral even after the budget after the policy announcement by the RBI. Very frankly, I think, as what we all know, that this 25 basis point was factored in. But in my opinion, apart from the fact that the liquidity is the need of the hour, which is very, very loud and clear, and there was a very nice article written by Mr. Puri the ex-CEO of HDFC Bank, on how to improve the liquidity. I think that, of course, that point is very well taken. But in my opinion, the disappointment for me would be that RBI also feels that next year the GDP growth will be around 6.7%. In my opinion, Surbi, that if it is going to be around sub 7% or even just closer to 7%, it's not going to bring back the corporate earnings in any serious or in any big way. So we will be back to those pick and choose, and by and large there will be pains, and to use my very common word, it will be schizophrenic in nature, the economic performance. So coming to banks and the finance, I would still say that, yes, they look defensive from the current levels, but not too ready to commit to the banks or financials, or rather even to the markets at the moment. I would say that we will have next 5 to 6 weeks, which possibly will see more volatility and possibly will give some good opportunities.
Okay, that's as far as the take on banks is concerned. Dilip, then let's get your view on perhaps what has been the biggest debate of the week, and the stock of the week for me has really been Trent. Whether the best is over and done, whether it's time to unload positions and move out, or whether these are the kind of dips which you should buy into if someone is looking at keeping Trent in the portfolio from a medium term. What would your advice be? I'm sure lots of people have exposure to the stock, whether in their mutual funds or even directly.
So I think going by the performance and going by the way they are going to fare over this year and over next couple of years, clearly they are trending upwards without any doubt. And I think that momentum will be maintained. But challenge, Surbi, of course, will always remain the valuations. How do you value the stock, especially at these valuations? Of course, it has corrected. It has seen a lot of volatility right now. And if you personally ask me, I will stay away from Trent for the time being. I would not be in a hurry to buy, because for me, I think the valuations look pretty exorbitant, pretty expensive. And despite the fact that the momentum will be maintained, the growth rate will be maintained, but not the valuations continue to remain very challenging. And so I would prefer not to look at the stock at the moment.
Okay, all right. Dilip, I wanted your view on ITC. That's one of the big drags on the word go itself. The stock has gone through that split where you have the separate listed ITC hotels, and that will be excluded from the Nifty. So we'll see some kind of outflow towards the end of trade today. But what's your view at around 430? Everyone thought that maybe no negatives in the budget. Valuation-wise, it's pretty okay. Things should look up, but actually it's seeing a lot of selling pressure.
Nigel, surely ITC is one of those stocks which probably has had a very good run-up, and maybe in the last 6 months or so, it has not done anything great, or maybe more than that, a little more than that. And possibly, I think over the next 6 to 8 months, possibly will not do much. Because if you see that the ROCs are good, the cash flows are good, without any doubt, all those things are in place. But once again, when it comes to valuation, I think the growth is a factor, because the growth is not going to be all that robust, especially if you see the cigarette growth. This time the cigarette growths were a little more healthier than what we normally expect. But on an overall basis, if you see some of the other verticals of the company, I don't think that they will really push the momentum of growth northwards in any decisive way. So for me, ITC, personally, I would say that one should hold on to the stock, keep on eating all the dividends that they give, and possibly wait for some more, the things to improve internally on the company's front as well as on the external front.
All right, Dilip, I request you to stay with us. Let's get the management of solar industries. The stock is quite nervous, post the con call. So let's clarify a couple of issues. We have with us Mr. Manish Nuwal, the Managing Director of the company. Hi, Mr. Nuwal. Good afternoon, and thanks a lot for joining in. Well, the street has got very, very nervous post the con call. Give us a couple of numbers. Your volume growth, now you're guiding for around 8 to 10%. Could you confirm that? And also, could you tell us, on this base, what kind of growth are you looking at for FY26? And what does it mean in terms of revenue growth? So let's get this out of the way. Volumes and revenues for this year and for the next.
If you talk about the revenue, if you look at my Q1 numbers, we grown by only 0.7%. And after the Q1, in Q2, we grown by 27%. Q3, we have delivered 38% growth. Q4 also, we are going to deliver 30% plus growth. So if you take all these quarters together, so our growth will be around 23% in revenue terms.
Okay, revenue. And what about the following year? 23% revenue terms, 8 to 10% volume terms for FY25. For FY26, what kind of growth can you deliver? And also give us an understanding about margins, because that's held around 27%, 26, 27%. So can you maintain this?
So if you talk about the margins, then at the start of the year, we said that we are going to achieve better margins, which means that in last year, we did 23.3% EBITDA margin. This year, we were expected to deliver around 25% something percentage in EBITDA margin growth level. And we said that we will do 25-26%. Actually, we are delivering around 27.5% as of now. And we believe that the same traction will continue in the next quarter and next year as well.
You didn't give us the revenue number, sir. So we'll say that from 26.5% you'll improve, but revenue growth for FY26, we missed that number with the volume growth?
Yes, for the next year, we are firmly believing, and based on our current statistics, we believe that next year the volume should grow more than 15%. And on revenue terms, now defense is unlocking, international subsidiaries are doing better. We should do 30% growth in the next financial year.
30% growth in top line in FY26 and 15% growth in volume terms in FY26. So those are the two big numbers to focus on. Can you, since you're talking about defense and the export market opportunities opening up, let's talk about this Pinaka multiple launch rocket system order, because this is what's generated so much of buzz, right? Now, the total quantum obviously is large. It's huge, over 10,100 crores, but this is over many years, I'm guessing. So how does it start flowing into the P&L? When do you book revenues? Just give us some more details around this. And apart from Pinaka, you had also very, very recently announced, a big MOU with the Maharashtra government, again, for defense projects. So I don't know if there's some linkage between Pinaka and this, or if they're separate. Just tell us a little more on how the revenue booking will be.
So in last 12 years, we were spending a lot for defense vertical, and we have expanded our product portfolios, which includes Pinaka as well. So after so much of hard work, we have received the contract yesterday, and the total contract is worth 6,084 crores. And it has two variety of Pinaka. And for each variety, there are different timelines for deliveries. So we believe that based on the contract, 80% of the value should be delivered in next 8 to 9 years, and rest all we will deliver in next 5-6 years. So in P&L side, it will start giving impact in the next financial year.
Next financial year, if you...
26.
Okay, so I'm just repeating the numbers. The total value that will come your way, you said over 8-9 years, is about 6,084 crores, correct?
No, the total contract is 6,084 crores. Out of that, almost 80% will be delivered in 8 to 9 years.
No, is that entirely your share, or is it being split between... That's entirely your share, right? 6,084.
Solar's share.
Okay, got it. So, to what extent will the revenue recognition be in FY26? I'm guessing it starts slow and then kind of builds up. And if you could just clarify on this Maharashtra MOU as well on the defense side.
I think based on the contract in next financial year, we are expecting that it will be slow start in the first 1 or 2 quarters. From Q3 will pick up, and we should do around 300 crores in next years. And then from 27 FY, we should be doing around 500 crores plus every year for 8-9 years. And as far as the MOU with the Maharashtra government is concerned, like you are aware that our company has participated in many development programs. We are developing programs or products on our own. And recently we have successfully tried to a very large extent Bhargavastra. So we are working on anti-drone systems. We are working on variety of rockets to meet all those upcoming demands for next 5 to 10 years. The company has thought that we should expand our facilities, and that's why we have signed an MOU with Maharashtra government, which is around
just a quick question on defense. I believe defense is about 21% of your total sales mix right now. Now, with all these high-profile orders coming in, Pinaka, the other stuff you're doing with Maharashtra government, what will defense be as a percentage of your revenue, say in FY26? And then what does that do to the margin? I'm interested in knowing whether with these high-profile defense orders, whether your margin improves from 27% or is it margin dilutive, these large government orders?
Last year, our defense sales was only 7%. And in this year, now it is 17%. And as a result, the margin has increased to 27.3%. As we move forward, as defense sales goes up, definitely contribution from defense will be much better. And our international subsidiaries are also doing quite better than what we were doing in a couple of years back. So I believe that 27 to 28% EBITDA margin should not be a problem for our company.
Final question, Mr. Noval, before we let you go. The problem for the company is that the market capitalization has become so huge, right? So then justifying valuations becomes an issue. But I'm looking at an ICICI Securities note, and they are saying by the end of this year, you'll do around 1,250 crores, very approximately. But then because of this ramp up in business, they are expecting that in the next 2 years, that's by FY27, they are factoring in more than 2,000 crores of net profit. Is that gettable?
Sir, if you just connect these two dots, what I said, that in next year, our defense will pick up from the current level of say around 1,500 crores on annual basis level. If it picks up and expand more than 2,500 crores in next year, and our domestic and international market doing better. So if you club these two things with EBITDA margin of 28% approx, then definitely our profits will be around those levels, what you have said just now.
All right. You know, Mr. Noval, normally we would connect the dots, but since we have you on the channel, we rather confirm about that. So thanks a lot for joining in. You've clarified on a couple of issues. The stock had come off from the top because, the street's expectation was you would grow far higher in FY25, but you're saying FY26 will be even better than FY25. For the time being, the stock is more or less flattish. We'll watch out for these revenues, margin scaling up, and the big number, 2,000 crores of profitability possible in the next 2 years. That's FY27. Dilip Bhatt is still with us. Dilip, any view on this one? Solar Industries, the stock the last few years did very, very well, but from the top, actually, it's corrected a little bit.
Nigel, I think first and foremost, this company is really very well managed. And I mean, Mr. Manish Nuwal and his father, I think both of them have really managed the company exceedingly well without any doubt. And I think full credit goes to them. But I think, Nigel, valuations remain a challenge. But if one were to, we'll have to do a little more research on that. But if it's really talking about from, say, they're going to achieve 2,000 crores over next 2 years, I think this stock definitely merits a buy because their defense share is going up. The EBITDA is, the blended EBITDA is also going up, and they're also showing a very smart growth. So possibly that will justify some kind of increased valuation. So I would say, yes, this stock certainly looks pretty good, pretty interesting, and one can have it in the portfolio.
Okay, all right. On one hand, one would say that on a trailing basis, multiples actually are expensive. Even at 2,000 crores, I think it trades at around 40 times. But return ratios are good, and it appears that business potential as well is there. So the verdict, we'll have to see. But Dilip believes that maybe he's fairly positive on this one. Thanks a lot, Dilip, for joining in and giving us your take on all the stocks that we just discussed. Well, it's now time for the Growth Court, a special initiative by Grow and CNBC TV 18 designed to provide you with valuable insights and strategies to navigate the market and make informed trading decisions. Today, we unpack the risk of speculative trading and the lessons learned in the aftermath of the infamous 2001 Ketan Parekh scam.
Speculative trading creates artificial demand and can inflate prices, often resulting in market bubbles. But one small prick and the entire illusion vanishes in an instant. Speculation is the reason 90% intraday traders end up with net losses.
Speculative trading dominates the market despite its risk is because of the lure of quick gains, lack of common sense, and there's obviously a lot of greed as well. Time after time, we have seen this cycle repeating. Right now, the money at stake is far higher and is of great concern at the moment.
The 2001 Ketan Parekh scam exposed the perils of unchecked speculation. Fueled by insider information and excessive leverage, Parekh manipulated stock prices to siphon off over 40,000 crore.
One of the biggest things that happened in Ketan Parekh's scam was a kind of a narrative that got built. The hype was built so much that it ended up brainwashing the retail investors and traders. The biggest problem here was that while they were investing, the pump and dump scheme was happening simultaneously.
The crisis forced a reckoning, with the market regulator implementing sweeping reforms. Circular trading was abolished. A central fraud registry was created, and stock options were introduced for the first time.
The scam definitely highlighted the risks of speculative trading and thereafter shifted the investors' focus to relatively safer and established companies. Investors became far more aware of the risks in speculative trading and the pump and dump schemes. Though the markets post-2020 also need similar kind of awareness.
While the scam helped correct systemic issues, traders also learnt about the risks of speculative trading. Learnings from the Ketan Parekh scam helped India build a stronger, more resilient market.
Welcome back. Well, the markets have recovered a little bit from the low point of the day, so I think we should get the intraday chart up there. I think we are 50 points off the day's low, and the good news is the mid-cap index is almost in the green as well. So you like that in terms of a screen movement. Also, ITC is under pressure, but ITC hotels, keep an eye out on that one. We've been making this point briefly on closing bell itself that the volumes are very, very high. It appears those sellers, that got the stock by default, they appear to have cleared out, and that stock has now moved to the high point of the day. As I said earlier, it will be excluded from the Nifty as well, effective today. So some outflows, but it appears for time being, it's already getting lapped up. Let's focus on another, a big news point that came in today. SEBI has cracked down on Finfluencer. Ashmita Patel, Yash joins us to fill us in with more details on that. Yash.
Nigel, the order after the FAQs were released last week has come practically in no time. This particular order again is a crackdown when it comes to influencers and their unregistered investment advisory. The person involved here this time is Asmita Patel, or as she would call herself, the she-wolf or the options queen as well. This is an interim order come show cause notice from market regulator SEBI against Asmita Patel as well as Asmita Patel Global School of Trading along with 4 proprietary entities. The order comes after about 42 complainants send their complaints with SEBI. All these 42 people had taken the courses which were sold by Asmita Patel and their proprietary entities, felt cheated, reached out to SEBI with everything that happened to them, after which SEBI has taken this big crackdown on another influencer. What are the allegations? Unregistered investment advisory and research analyst services. Second, violation of prevention of fraudulent and unfair trade practices, which is known as PFUTP regulations. Defraud in connection with dealing with securities and mis-selling of services related to securities market. Imagine the extent of money which was being taken from all these people who subscribed to the courses. The money which was being collected was to the tune of about 8.5 lakhs, including GST, for a course which would span across 7 months, which gave them training in the securities market. As far as the order itself is concerned, SEBI has said that an amount of 54 crore will have to be impounded by Asmita Patel and the related entities. Importantly, the show cause notice doesn't end there. It takes the order a step forward by saying that please tell us and show us a cause. Why should we not ask you to disgorge an amount of 104 crore rupees? So an important step by SEBI as far as the Finfluencer regulation and unregistered investment advisory is concerned.
Okay, all right. It's quite an amount as well that needs to be given back. Thanks, Yash, very much for that. With that, let's get back to the market. We have our next guest joining in. Rupen Rajguru, Head of Equity Investment Strategy at Julius Baer, is with us now. Rupen, great to have you on. So the market's been kind of, it's been a slightly disappointing day for the bulls because we had a flurry in the middle of the week where the market was taking aim at higher levels. We had 23,000, almost 700 on the screen. But there's not been much follow through. And now we've got both the, the stimuli, the fiscal as well as the monetary today. Where does it leave the market trajectory? What's your call?
Yeah, hi. Good afternoon, Subi. In fact, as I spoke with you last time around, this would be the year of consolidation and contra. So we would want the stock market, which was in a relentless bull run between 2020 and 2024, to take a pause. So earlier what was happening is that every positive news used to get amplified and used to get rewarded, and people used to ignore negative news. As we speak, what's happening is that any negative news gets amplified and any positive news gets easily forgotten. Why is this happening? 2 reasons. One, if you look through, at the end of the day, what does market look into? Market look into the earnings growth, and then it looks into valuation. So on both the accounts, we definitely require a pause, and hence I said consolidation. While you're absolutely right that the economy, which is witnessing, I would say, a little bit of cyclical slowdown with all the measures, be it on the budget side, to boost the consumption as well as by the RBI by a rate cut today, will help the earnings grow, but it will happen probably after a lag of 4 to 6 quarters. Till such time the earnings growth doesn't catch up, I think we would be into the zone wherein probably at every rise there will be some bit of selling which would be happening, and that's why probably market will remain in this range.
Okay, all right. Hi, Rupen. Good afternoon. Good to see you, Win. What are the top sectors, though, you're betting on? I think you were fairly positive on financials, banks, insurance. Tell us more and try to give us a hint in terms if you're talking about banks, then what do you like from the banking space? The larger names?
So, hi, afternoon, Nigel. In fact, if you look through the entire correction which we witnessed in January, banking and to some extent IT were the sectors which were probably, so to say, the best performing sector. And from a standpoint of valuation, definitely banking is the sector which is trading at a valuation which is much lower than its historical average. And also vis-a-vis the Nifty, it is trading at a much lower level, both on the earnings and the price to book side. And we saw through the results, I think a lot of the big boys, be it the largest private sector or the largest public sector banks, they have demonstrated that the margin pressure is there, but not as much as what Street has expected. And at the same time, the asset quality, specifically on the retail side, I was also very positively surprised by the way the largest public sector bank, the retail credit stood out. So the underwriting skill also is far superior. So in uncertain times wherein growth is difficult and the credit cycle is probably not on your side, we would stick to the largest players out there, in that segment. So that's the segment. Secondly, yes, insurance is a sector which we like. And, the life insurance companies, while there was a lot of regulatory noise over last probably many quarters, we believe majority of the regulatory noise is now behind us. And the growth numbers have been pretty strong. And what are the type of companies we like? Companies which have a good, decent product set, has a very wide distribution network. So a lot of the insurance companies which have a strong banker partners. And at the same time, now if you look through, the non-par products, which is a high margin product vis-a-vis the ULIPs. With this rate cut, which we have seen, the relative attractivity of those products will come back. And we believe that, over next year, a lot of these companies will have some of these products which might kind of contribute meaningfully to their revenue, which will be aiding their margins as well. And also the protection, also growth is pretty strong. So all in all, insurance is a sector we like. And finally, I would say consumer discretionary, particularly after, the kind of fillip which we have seen. And if you look through in the budget, the maximum delta will come to people who are earning between 12 lakh and 25 lakhs. And that's the bracket wherein, will be having more money at their disposable. While they can consume, they can also save and invest. Here, the companies which are in that segment, be it the hotels, be it, the QSRs, and to some extent jewelry companies, all will benefit from that. So I think consumer durables as well. So that's the segment which we like, particularly after the budget boost.
Okay, all right. So that's a thought. So Rupen, leave us with some ideas. It's a difficult environment, slightly confusing, tough market. What would your biggest overweights be? And if you were to deploy some money now, first of all, would you go all in? Would you stagger it? And then the themes that you're most confident on for, say, the medium term, at least the next 6 months to 1 year?
So, Surabhi, in the current context, frankly, if you ask me, is there like a no-brainer buy or a sector or a theme which kind of looks completely like, decimated and, worth warranting a buy? The answer is no. But at the same time, within the sectors also, and hence when I said the two themes, one is consolidation and second is contra. So within each sector, there would be stocks which are trading, probably at like within banking also, there are a lot of private sector banks which are now trading at, say, a 1P multiple, one price to book multiple over next FY27 book, closer to that. So when the environment improves, historically, those were trading at a closer to two multiple, now at 1. So those are attractive. Within pharma also, if you see, there are some companies on the CDMO side which are looking pretty interesting, very high growth. That looks good. And, difficult to pinpoint a particular sector per se, but one segment, which is beaten down, probably seeing some recovery, I would say, is chemicals. So Post-COVID, I think, well, all these stocks had variety of issues, be it issues around higher raw material prices, higher inventory, China dumping, and all those they have seen through those cycles. And probably this quarter we have seen the earnings probably growth to be pretty good for them. And that segment is something which we believe can see a little bit of re-rating because it has seen a significant de-rating over the last 3 to 4 years.
Okay, all right, Rupen, appreciate you joining in. Thanks a lot for giving us your view on markets and all those stocks and sectors that we did discuss. Have a good Friday evening, good weekend, and we'll catch up with you rather soon. Well, let's focus on the other sector that's bounced back in today's trading session and tell you why metal stocks are shining yet again. First up, the RBI cut rates, the repo rates, that's likely to help the economy. So that's point number one. The second factor is the indications are that the rupee is slipping a little bit and it'll be allowed to find its own feet. A depreciating rupee actually is not so bad news because it restricts some imports and it helps the metal industry actually. So that's point number two. Point number three is ArcelorMittal, the listed stock overseas. Well, that one was up close to around 12-13% overnight. And their commentary was very, very good. They have mentioned that the steel industry is at cyclical lows. They're also forecasting that, that demand X of China, well, that could grow by around 2.5 to around 3.5% in 2025 in comparison to 2024. And for India, they were factoring in 6 to 7% growth. So that's good news. They believe that demand will be much better in 2025 in comparison to 2024. So that's the third point that we're talking about. Point number four is, again, there is these reports that are coming up that China is going to do something about their property market that has been very, very weak. And the commentary that came out there is that they're looking to get the real estate investment momentum back to speed as soon as possible. So that optimism on China is another point out there that worked in their favor. And finally, there is hope of some kind of protection that's coming in there for the steel industry. Some kind of anti-dumping duty, some kind of protection from imports as well. We have had Mr. Sajjan Jindal talk about it. We had Mr. Jayant Acharya that voiced his opinion as well. And the hope is that somewhere in the middle of February, we could hear something. So because of that, the steel stocks are doing well. So a few short points out there. If there is some duty that comes in there, you could see a price increase that comes about. In January, prices were still more or less flattish. In February, there's an attempt to push up prices. And keep in mind, global steel prices as well will have to recover from here on because those Chinese producers that are not integrated, at these sort of spreads, they can't make any money. So the hope is both globally and domestically, things should look up, which will result in an EBITDA per ton expansion as well. Explains why metal stocks are twinkling today.
Green, plenty of green on those names, Nigel. Thanks for that explanation and context as well. For the timing, let's focus on Mahindra and Mahindra. Good show, steady quarter. Let's go across and listen into the management.
Needed price correction. We took something on 3XO, which was the first increase we took after launch. We also took something on XUV 700. So, we had a couple of price increases and we didn't really discount. Apart from that, as Amar said, there are multiple initiatives that we always do to get cost out, including material cost, and then that starts playing out. So it's a combination of all of these. Plus, of course, operating leverage because it's a strong volume growth.
How's the discounting scenario now in Q4, the first month?
But there's no difference in the discounting except that we always have to run something on a 2024 win. Which is a standard thing anytime as you get into January. So if dealers are carrying some inventory of 2024, which is bound to be some inventory, so obviously there will be discounts running on that, but there's no other material change in discounting.
Understood. If I can squeeze in one more question.
Yes, please.
Mr. Barua, you mentioned that commodities have been benign, but steel, especially steel, now the government of India is looking for some kind of protective measures for the Indian industry. At least a study is going on. If that happens, just trying to understand steel as a cost of your overall expenses, what would your exposure be?
So I don't have an exact percentage, but what I can tell you is within steel also there are multiple grades, right? And the measures that might come into might not be as relevant from an overall, because there's a overall steel oversupply situation right now. So what is meant for more construction activity might not necessarily be the impact that we'll see in the automobiles. But I don't know, Rajesh, if you have a different...
I'll add something to that. 93% of our steel is procured from within the country.
And
right, sir. I think I should clarify what I meant by the question is if some duty measures come in and steel prices in the Indian markets also correct on the upwards trajectory. Just trying to understand to that scenario, what kind of exposure would you have?
Yes, and I was getting to that second part later, which is our sense is the government will look at the impact on all user industries of steel, which will be across the board, and ensure that the specific problem which is around dumping, which is being looked at, is addressed, but the dumping problem shouldn't really translate into higher prices that impact all industries, because that will essentially take inflation up and take away some of the good work that's been done right now to provide a demand stimulus for the industry, for the economy overall. So that's the expectation that we have in terms of that balance, and we shall see how that plays out.
Thank you, sir. Mr. Jejurikar, if you can just help me with a number in terms of steel as a constituent of your bill of materials.
I think it's it'll firstly be very different for auto and tractors. Yeah, for on the auto side.
Thank you.
Swaraj, you had a question, and Hormaz also you have a question.
Thanks. The rate at which M&M is growing in the PV segment, it looks like you'll be fast running out of capacity.
That's a good problem to have.
Any plans of hiking it further from here on?
Yeah, so just to Swaraj, recap what we've said so far. We were at 49, we said end of last quarter, then we said we're increasing it by 5 for rocks. So that took us to about 54. Then we've added the capacity for electric SUVs, which takes us to whatever, let's say another 8,000-10,000, so mid-60s. And I think that now that is a good number as an overall SUV capacity. Now, like I said earlier, we have some specific product / aggregate capacities to debottleneck. So we definitely need more gasoline capacity on 3XO than what we have. We do need to increase some capacities on Thar and the 3XO portfolio. And these are small incremental capacity enhancements we'll do over the next 3 to 6 months. But right now we're not looking at any significant expansion capacity till we really see what is the balancing that will happen between ICE and EV volumes. We'll get a feel of that over the next 3 to 6 months.
And the arrangement, the contract manufacturing arrangement between MEAL and M&M, does this mean that M&M standalone will not make or sell electric passenger vehicles, and that will be, all such products will be the exclusive business of MEAL from here on? No electric PVs will be made within M&M?
No, the electric EVs will be manufactured within M&M and sold to Mahindra Electric. That's the contract manufacturing. So Mahindra Electric is outsourcing manufacturing to M&M on a contract manufacturing basis. They will be sold exclusively through MEAL, through the dealer network. Does that clarify?
Yes, okay. And just last question on the long stance that M&M has held on hybrids. Are we still sticking on to it, and that as and when the opportunity, if there is there, we can look at it? Or has there been a change of stance on that?
We are still sticking to it.
Thank you.
Hormaz, Nihal will come back to you. There are quite a few. Yeah?
No, XUV affordable right now is still in M&M AD. Is not being sold through MEAL at this point of time. In Q4 as well. It's in M&M, not in MEAL. Hormaz?
Hormaz, do you have a mic? We'll come back to you after that. Yeah, thanks.
All right, that's Mahindra and Mahindra, the management there. Mr. Jejurikar fielding lots of questions. It's been a steady quarter for the company. Okay, let's go forward and quickly review the situation as far as the screen is concerned. It's not that bad. There's actually a good recovery in the market, you'd have to say. Look at the Nifty. It's trying to get back towards the positive side of the screen, this is not something to write off just like that. When we started the show, we were at the lowest point of the day. Bulls are fighting back. They want to have a good Friday. Let's take that break. Come back with more in just a bit.
Welcome back. Well, as we have been saying, the markets have seen some bit of a recovery. Let's get in Mitesh back on the show. Mitesh, good recovery is what you're seeing. That 23,400 mark that we were talking about, that's got protected at least for today. Give us a couple of stock picks.
So, I think that remains a very important level, and I think, I still hope that that level kind of manages to sustain. As long as that happens, good chance that we will have seen some volatility and we will be ready for some kind of move next week. On the stock side, BTST on Eicher Motors with a stop at 53.60 for targets of 54.20, and Colgate Palmolive is on the negative side. It's trading near the day's low as well. So STVT here. Keep a stop above levels of 26.30 and a target of 25.80.
Hey, all right. Got that, Mitesh. By the way, the top volume traded stocks in the last 20-30 minutes is ITC Hotels. Massive volumes, more than 3.5 crore shares getting traded out there. And it's going to be excluded from the Nifty today. That's the changes that will take place. The passive index adjustments, that's already been completed. But Nuvama, they have put out a note and they're saying, according to Nuvama alternate research, the outflow is expected to be approximately 90 million USD, which is approximately 46 million shares. And that's close to around 2 days volume impact. So for the time being, the volumes have gone berserk, but it seems as of now, at least all of that is getting absorbed because the stock, pull up the intraday chart of the stock, you'll see that it went up, I think, to around 177 odd mark, and then quickly it went to 170 as well. So bulk of this volatility is because it's going to get excluded today. So that's why there is that adjustment that's taking place. Slip into that break, come back, we'll wind down the markets for you. Don't go anywhere.
Welcome back. You're with us as we enter the last leg of closing bell, and it's turned out to be a remarkable fight back by the bulls, but still red is the color. That's what we have. We have Sudeep Bandyopadhyay joining in to take us through the last leg. Sudeep, great to have you with us. Let's talk about the best result reaction on the Nifty tally today, and that has to be Bharti Airtel. Stock's doing well. Bharti Hexacom, which reported numbers, is also doing very well, 11% up over there. So what do you make of it? Finally, the tariff hikes have happened and they're showing up in those ARPU numbers, Sudeep. What's the call on the stock?
No, absolutely, Surabhi. I think it takes some time to flow into the P&L, and it has started flowing in, and it's very heartening to see that ARPU hike and ARPU is giving to a better P&L for the telecom operators. Of course, I think in the commentary they were very clear that more hike in pricing is required to ensure long-term sustainability of the industry, and so which is a very clear signal that more hikes may be around the corner. That second thing which I noticed about Bharti is that the subscriber numbers which they are gaining, last quarter was not good for them, but this quarter the number of customers, incremental customers which they have got is very interesting, good number. So all the parameters, you look at any of the parameters, they have performed well. So of course, market is cheering the results. Also, I must say that the strategy of Indus Tower and moving assets back to Indus Tower is a good strategy because it keeps businesses clean and gives Indus Tower and Bharti also flexibility. So I think overall it is a good set of numbers, good corporate action, and even the commentary was pretty good. So all in all, I think is a good set of numbers. And to conclude, Bharti Airtel, even at current price, does look good considering all the components have started performing.
Okay, all right. Sudeep, short chat. Thanks a lot for giving us that take on Bharti Airtel. By the way, before we wind up, we just need to pull up Kotak Mahindra Bank. I think in the last 5 years, the stock has not even moved 20% in all of 5 years. And just take a look at the stock. In the last 1 month, it's up closer to around 10%. As we speak, that one is flying away, firing all cylinders. So that one, in fact, is calling for attention. There's a massive volume burst out there. That's the stock you should be keeping on your radar. Big move on Kotak Mahindra Bank, and it's helped the Nifty as well cut some of those losses. So that's the stock of the final hour. But let's run you through about market action today. ONGC is under the weather. Mr. Trump is talking about keeping a lid on crude oil prices. That's not very good news for them. That stock was down close to 3%. ITC valuations attractive, but no respite out there. SBI yesterday got away with a cut of only around 1%. Today the markets, the Nifty Bank was underperforming actually, and that one participated on the downside. Britannia as well, not such a good day. The stock was down close to around 2%. What did well? There's optimism. Something is going to come for the steel industry from the globe or from India as well, and that's why you have Tata Steel that's up close to around 4%. JSW Steel was higher in today's trading session. Hindalco, not non-ferrous, but maybe in fact liquidity will drive that stock up as well. So that as well did well. And a couple of good earnings reactions. Bharti Airtel, Mahindra Mahindra, thumbs up, and Trent, after getting beaten yesterday, bounced back in trade.
Absolutely. On the mid-cap screens, some of the stocks that have really soared today include a Bharti Hexacom. Godfrey Phillips had a great outing. I don't know if it's just a rub-off on those good volume numbers from ITC or something else, because there's too much happening otherwise at a corporate level as well with this company. JM Financial, 6.5% higher. So that was up and about as well. Then you had names like Astra Micro doing well, Gulf Oil Lubricants reacting to numbers in the commentary, about 8.5% higher on that stock as well. Actually, even Castrol had a great day yesterday and a good week. So some of these lubricant stocks have had a good week, so to speak. However, on the losing side, First Cry saw a deep gash today. Brainbees Solutions, 9.5% gone from First Cry. MCure Pharma, a stock we don't talk about too often, down about 6% as well. BKG was definitely not tasting too good today, 10% lower over there. And NCC was another big result disappointment that was playing out today. To complete the picture, Zomato about 2% higher, Swiggy about 2% higher, 2% lower, and PG Electroplast, great numbers, but how much is already in the price? That was the question. Stocks ending with a gain of about 3%. So the bell has gone. The week has ended with the Nifty around the 23,560 mark. A week of consolidation, digesting big events like the budget as well as the RBI monetary policy. That's where the team of Closing Bell will take your leave, but don't go anywhere because we have Editors Roundtable coming up after a quick break.
Yeah. Yeah, I can hear.
What's it? Oh, baby's coming?
No, not today.
He's coming to office? Ritu? Ritu? They're eating pizza?
They can, yes.
The Lal Street Post, minor gains this week, ending higher for the second week in a row. Pharma, metals back for the bulls, but FMCG takes it on the chin. Well, on today's edition of Editors Roundtable, we'll take stock of the week's market action. We'll decode RBI's monetary policy and its market impact. And we'll tell you why QSR firms are making a comeback. I'm Reema. With me are Surbi, Nigel and Mangalam. Hi. Hi, guys.
Hi, folks. Thank God it's Friday.
And you can finally say that because we couldn't say it last Friday. But let's also welcome on the show Ramesh Mantri, CIO, White Oak Capital AMC. Ramesh, hi.
Hi.
Well, what a week this has been, right? It's been extremely long. There was Saturday, and that Sunday felt like it was nothing. It was just...
Thanks to Donald Trump and the tariff news and the earnings.
To come back, and then so many earnings. I think about 15 or 16 nifty companies reported their earnings this week.
And across all sectors.
I think the biggest debate this week has been about the Indian consumer. And I think Mangalam's going to talk about this, whether there's a slowdown, no slowdown, has the budget addressed it or not, has the RBI addressed it or not. I think that was a central
I don't know whether
focus.
who's addressed it or not. What I'll talk about is something a lot more delicious than just the consumer. It'll be specifically quick service restaurants, but Nigel, the market.
Yeah, so let's take stock first of the market. You know, one positive that I've learned in life is if there is a problem, you need to address it. And I think that's precisely what the government of India as well as RBI have done. The government of India in budget 2025 they have given that consumption boost. So the economy was in need of something, and they've given that. Point number one. Point number two is that, in fact, in the RBI, they were bracing for a 25 basis rate cut, and that's precisely what's happened. And in addition to that, they also had done those various liquidity measures. So both those two, they have addressed a problem out here. Next up, the bulls, I believe that in the near term, it appears that 22,800 odd mark, they believe that that should get protected, which was the panic low that we saw closer on 7 to 8 trading sessions ago. The uncertainty really is going to be on Trump's tariffs, right? What is he going to do next? For the time being, the global markets, they believe that he's going to use it as a negotiating tool. Nothing big is going to happen, but it's going to be a negotiating tool. At least that's what, the indications are. If you look at the dollar index, if you look at the way the global markets panned out as well, there's going to be uncertainty as well from the Fed as well as the Bank of Japan. What those two big central bankers are going to do, which will have repercussions for the global markets as well. And that's going to be important. The FIs were a pleasant surprise this week. After a while, after 23 sessions, they went ahead and they bought at least one out of one, but that's okay. At least one out of, and if you take the cumulative number for the week, it's much lower than the previous weeks on an average. So I'll take that as a positive as well. But a few stocks I just want to talk about, and there's no room for error on stocks that are trading at elevated multiples. Trent, the numbers didn't look that bad, but the stock got clobbered. For the week, in fact, it was down closer around 11% or thereabouts. Some of those stocks that have underperformed, suddenly they've started performing. If you look at Bajaj Finance, right, that didn't do much for the last few years. In this year itself, it's up closer around 8 to 10%. And in fact, in this week, it was up closer around 5%. IndusInd Bank as well. Big underperformer, maybe valuations are pretty okay. So that one as well was high. And there's no room for these high flyers. Mangalam, you have Easy Trip, the one that, the big story that was playing out. Swiggy, from it listed, it went all the way to 600. Today, it's below the IPO price as well. So there's no room for error. I think in the near term, there is, we're in that broad band of 23,200 on the downside to around 24,000, which incidentally is the 20 as well as the 200 DMA. So, the markets saw a good recovery this week and we ended more or less flattish. Let's get in Ramesh Mantri and let's see how he's feeling. Hi, Ramesh. Good to see you on the show. What are you making of market setup right now? You have support coming in from the RBI as well as from the government of India. How are you feeling right now?
No, I think we're clearly seeing a slowdown in the economy, in the earnings, and you have now two levels of support both on what's happening to the consumers and the RBI. So, and also you want to see now the capex that has not been spent this year, the orders that are not coming, need also to come in. So you need economic pickup, and I think some measures have been taken clearly in the last week to support the economy.
All right, so that's about the budget. But, after the budget, this Friday, we had the RBI policy as well. The street was hoping for a 25 basis points rate cut. That's exactly what came by. What do you made of that?
The street was still not happy enough, right? They wanted a tax cut, they got it. They wanted a rate cut, they got it. But the market's still kind of ambling along. So what does it tell us? I mean, on the RBI policy, I kind of listed out actually 6, positives, which were there, but the market was still not happy enough. And I think largely because it was a ye dil mange more kind of a policy. You've got 25 basis points, but there was no immediate hint of further policy action. There was no sort of, barrage of dovish commentary that's telling you next cut is sure shot on its way, or, that there is a big liquidity bonanza that the RBI is handing out. However, here are the positives, and we should not lose sight of that. Number one, the fact that the decision was unanimous. So there's no discrepancy between the MPC members. All 6 voted in favor of a rate cut. Number two, the governor is pointing sufficient liquidity support to the market as and when needed. Number three, look at the inflation projections. For FY26, CPI inflation is projected at about 4.2%, which is so much better than 4.8. That's the revised estimate for FY25. Number four, the GDP forecast at 6.7%, which is towards the higher end of the forecast that we had from the from the economic survey, which the upper end of that band was 6.8%. So GDP forecast for FY26 not too bad. And last but not the least, the market's been very nervous about a couple of these regulatory changes that have been pending. LCR guidelines and of course implementation of ECL norms, project financing. What did the governor say? In clear terms, he said that all of this cannot be implemented in a rush. In fact, on LCR, he's made it very clear that it's not coming in till FY27, 31st of March 2026. It's not happening before that. And similarly, the others are more a consultation process right now, which is the ECL norms. And again, that seems to be off for at least another one whole year. Yet the market was not pleased. Why? Now I come to the so-called negatives, and negatives in quotes. What do I mean by that? The stance, number one, is still neutral. So if people expected a shift to accommodative, that didn't happen today, and there was no hint of that. And largely, from a stock market point of view, the immediate trigger, look at what the governor and the deputy governor have said on unsecured lendings and also risk weight to NBFCs. Remember, a lot of these stringent norms came in a couple of quarters back to sort of regulate the lending happening in the unsecured place. I just want to highlight these two quotes. What did the RBI governor say? The RBI governor went on to say that we're satisfied with the slowdown in unsecured loan growth as of now. The DG, Mr. Swaminathan, he said that we don't think there is any reason to review any measures on unsecured loans at this point in time. Doesn't get clearer than that. And even on NBFC lending, remember the risk weights had gone up. The loans that banks are giving to NBFCs. Is the RBI going to change that so quickly? I don't think so. If you go by the commentary, look at the RBI governor's statement, and I quote, "We've raised risk weights for bank lending to NBFCs due to concentration risks." So he's going into the reasons and why he still thinks, that was a valid move. So I guess this was a bit of the disappointment that played out. But let me take this to Ramesh. Ramesh, at times the market can be a little nearsighted, short-sighted. How would you classify the policy and your take on financial stocks from here on?
First, interest rate movements, there are no correlation with markets. What matters is significant surprises. This is policies as per expectations. So expectations generally don't impact markets. What is broadly expected? I think the deferment of some of the tightening and regulatory measures is a good thing. You need to support the economy now. And I think particularly the steps that RBI had taken on unsecured lending, I would say they were pretty visionary. They looked like conservative a year ago, but they have made sure that the risks in the financial system has been contained. So I think in some ways, RBI has been an extremely prudent regulator, unlike a lot of other central banks. So I think all credit to RBI for that.
Okay. Ramesh, hi. So Trend was the top Nifty loser today. It rebounded on Friday, but still ending the week down close to about 11-odd%. So it's a part of your fund, your flexi cap fund, a part of your mid cap fund, etc. What is your thought on these, companies which were considered sexy till like just a few months back, but now have seen some growth deceleration? Numbers are fine, 35% top line growth, but it's just slower than what the market was used to in the prior quarters. What is your approach to these stocks?
Yeah, see, first of all, when these kind of stocks, expectations are a treadmill, right? So if you miss a little bit of expectation, there is often violent reaction, both on the upside and downside, right? And here, let's understand there is a slowdown in the economy. And, in India, 35% growth, when growth is difficult to find, is still extraordinary. In fact, an absolutely outlier in the consumer space in India. So let's, we can focus on what the market did in the last week. But I think the growth that some of these companies are delivering is still very stellar, right? And in fact, very rare in this Indian consumer space in India.
Right. Speaking about consumption itself, Ramesh, you do have Zomato in your portfolio. It's a left field question because it's a left field development. They've named their company Eternal. What do you make of that? And, what do you make of Swiggy's numbers? Do you think that there is a valuation discount play here?
Now, first, the rebranding, I think they want to grow beyond the Zomato brand, which is one of their offerings. They believe the company is bigger than one of their offerings, which is, of course, their core offering where they started. So I think it's thoughtful to rebrand it because now Zomato is much more than the food delivery business it is. I would not comment specifically on any company's results, but I think the quick commerce is a uniquely Indian retail solution. It is going to be very large. And because the total addressable market is large in India, everybody is jumping into this. So it's going to be a difficult 2025 for the space. It is going to be heightened competition in the space. There is going to be red in P&Ls. This is assured in 2025. But because the market opportunity is large, still the ultimate winners will create a lot of value. So we have to stay focused on companies that are executing well. The numbers, the P&L is going to look red in this year for sure. It's going to get reversed actually as we go by.
All right, we take that point. In fact, I'll take a cue from that itself because, we've been talking about out here that over the period of time, burgers were falling out of favor and as were pizzas.
Yeah.
And we had people playing the platform companies. But with a shot in the arm that the government has given for consumption, the question is, where is that extra money going? Could that go to quick service restaurants? Something tells me maybe, because we've seen that in the numbers. So I'll just walk across the wall and tell you that if you look at the government giving 1 lakh crore as a boost to consumption during the budget, and look at quick service restaurants itself, and you look at some of the numbers that have come by so far in the third quarter. We have Westlife, the one who operates McDonald's. Look at this. We've seen the same-store sales growth decline for about 4 quarters until the third quarter, where there was an uptick that we saw. Similar is the case for Sapphire Foods, which operates KFC and Pizza Hut. So you look at Sapphire Foods, you'll have KFC as well, which is reporting a negative like-for-like growth, but it has shown an improvement in the third quarter. You look at Burger King, which is listed under Restaurant Brands Asia. There was decline, and then there is some improvement. This decline was obviously on a high base. The improvement comes on a higher base as well. Earlier, we were talking about pizzas versus burgers. Looks like pizzas are making a big comeback as well. From Sapphire Foods itself, we saw Pizza Hut. Pizza Hut, was reporting negative same-store sales growth. It's been on an uptrend, and this quarter, it turned positive 5%. Domino's, the leader out there, for the longest time, it was negative or feeble numbers. This quarter, it's actually reported a 12.5% like-for-like growth in its pre-quarter update itself. And all of this, tie that down with Zomato. Earlier, the narrative was that maybe platform companies are growing faster than quick service restaurants. Actually not. Platform companies have seen their gross order value decline. Zomato's gross order value in the food delivery business, growth was 16.8%, much lower than we've seen earlier in the past itself. So let's address what the problems were earlier and what the trend is now. The problems earlier for quick service restaurants was normalization after the post-COVID boom. Secondly, there was structural decline in dine-in revenue. People weren't going into these restaurants. Then there was competition coming in from the aggregator apps, competition from local chains itself, Lapinos, etc., many people springing up, and stocks had run up, and valuations had surged to record highs as well. Now, after the underperformance, what has changed? Inflation has shifted urban consumption towards affordable treats. Companies have increased their value offers on dine-in, so that has arrested the same-store sales decline that we're seeing in dine-in. The companies have also rationalized their stores from earlier dine-in to now delivery only. Add to that, new store additions are happening not only in metros, but they are happening in towns beyond Tier 2, so that has a lot of latent demand itself. Companies have their own delivery fleet. Jubilant FoodWorks always had that. McDonald's has added that as well, that waves off delivery charges. And then everyone's been talking about high markups on platforms like Zomato and Swiggy. All of them have innovated on menu launches. There's McSpicy chicken, McSpicy paneer, cheese volcano pizzas, etc. And 80 to 100 local pizza outlets in Ahmedabad have closed in the last 10 months. There are multiple news reports talking about that. So local competition is also abating. And they say you buy these stocks when they're off their highs. Are these stocks off their highs? Yes. Restaurant Brands down about 35% of its highs, 20% down for Devyani. Jubilant FoodWorks itself, after a 62% rally from its lows, is down 14%. What are the analysts saying? Look at what the analysts are saying. On Restaurant Brands, 50% of them have a buy rating. Sapphire Foods, 8 out of 10 analysts have a buy rating. Devyani, 69% have a buy rating. Jubilant FoodWorks and Westlife, because they've seen a rally already and haven't fallen as much from their highs, not all analysts have a buy rating. But still, you have an upside potential basis their consensus prices of anywhere between 10 to 22%. And if these stocks, start to re-rate because of growth uptick coming in the next few quarters, who's to say QSRs may make a big comeback?
Very interesting data, and I must say the pictures look so.
It's whet my appetite completely.
Manglam, you're hungry. Manglam,
anything, Manglam, whatever you say.
I was taught, ask and you shall receive. So what I did was whether QSRs come back into fashion or not. I've done my bit. So what we'll do is. Just grab a couple of burgers, equal opportunity offenders. So there's pizzas and
amazing. Now we're talking. Wow, thank you. Thank you.
I love this.
I'll tell you what, I think what we should do
we
is...
have to take
we
a
need to
break
take
now.
that break right now.
Well, yes, what we'll do is, while we munch onto these pizzas, burgers and fries, we'll just take a quick break, come back, we continue our conversation on Editors Roundtable.
Welcome back. You're watching Editors Roundtable. We have with us Ramesh Mantri from White Oak AMC. As you can see, we were just talking about QSRs. We're eating them. We're talking them. Ramesh, unfortunately, we can't share it with you, which is why you need to come. You need to come down to our office so you could be a part of this feast. But tell us, QSRs, are they a part of your portfolio? Is it time to look at it more aggressively if you already own it, or if you were shunning it so far because of the kind of weakness in the numbers? Are you going to take a look at it?
So one, QSR is a large structural opportunity in India. But in India, this is not so structural. It is cyclical within a secular opportunity. And I believe because of the advent of these large food delivery platforms in India, a good portion of value has shifted from QSR or restaurants to actually these platforms. So I would say the better way to participate, at least that's our view, is through the food delivery platforms rather than investing directly in some of these QSR chains.
But Ramesh, I want to kind of zoom out to a larger question, going back to that Trent example, or for that matter, staple stocks. My question is very, very simple. For stocks that have traditionally traded at really high multiples because you're getting better growth, and Trent was a classic example of that, right? You can go up to 80 times forward earnings, 100 times forward earnings, but you're getting that kind of compounding growth. Similar could be applied to the EMS space as well. But now, given the market environment that we are in, which are the kind of companies or the sectors or the stories for which you would still be comfortable paying, maybe 70, 80, 90 times, if at all?
So clearly you want to see first very large markets, whether it's, food delivery, branded apparel, a variety of sectors on the consumer side. Number two, you want to invest in market leaders. Clearly people who already demonstrated the track record of execution. That's the kind of multiple that's only you can pay only for a market leader or someone who is significantly gaining market share. And please understand, in 2021, 22, 23, actually broad-based economic growth came back in India after many years. Now in the last 6-7 months, growth has again become scarce. When growth becomes scarce, actually growth stocks become more valuable.
All right. Ramesh, just before we let you go, in the result season so far and the environment that we are in right now, what is it that you like? The couple of ideas which you believe that, are worth holding on to even in this environment, and perhaps stuff that will make you money over the next couple of years?
I think this is a time to go back to more quality businesses, more sustainable businesses. So I would say, I think financial services continues to deliver very stable performance. There are still no broad-based credit quality issues. Valuations are very reasonable. So I would say frontline banks, even within that, if you look at NBFC, maybe affordable housing, where growth is still very strong, valuations are reasonable. And then also look at some very high growth opportunities, let's say in the digital transformation space, where India has still started the journey. Those are the attractive spaces. I'm always a perennial bull on pharma and healthcare because I believe it's a sector that's more stable than even consumer staples. People never cut back on pharma or healthcare consumption. So these are the spaces that I find very interesting today.
Okay. All right, Ramesh, that's really helpful advice. Thank you so much for joining us on the show today.
Nigel is still eating.
And,
he said pharma and health. The minute he said pharma and health, the people I was
Nigel, last word from you?
The consumption story is strong.
You asked him for the last word, he'd be like, I can't do it.
And thank you, Manglam, for making it very exciting. You should come more often on here. All right, folks.
Imagine if he does a story on Trent.
What
will we get?
We're good with food.
Let's call it. It's a wrap. Nigel,
on that note, I'll tell you guys, we'll wrap up on this edition of Editors Roundtable. Thanks a lot for watching. More news and updates on the other side.
लाइट ठीक कर दो.